Hi friends, this is just an initial intro video of 2 minutes from my side. Before you go through this topic called ratio analysis in depth, we're going to learn it in depth, my regular class videos, so that you understand how different formulae have been coming in this chapter, and you will also learn that how do you cover the entire topic of ratio analysis without even remembering one formula. Every formula we will explain the logic, understand the logic of that formula category, and you'll be able to reproduce it in exam. We will see a lot of questions, how to link multiple ratios together. All concepts would be discussed in depth, and as I did in standard costing, I will be giving you detailed timestamp. So if you are a person who just want to go through concepts, just click on the concept part, just go through concept. If you want to practice questions along, do questions practice also. Everything we are giving it to you, only questions possible, only concepts possible, but go through this in depth. If you have already done ratio analysis and not getting a grip, go through this video, but at a faster pace, maybe 1.5x speed you can do, or even a 2x speed you can do, and practice along with the videos. I'll be sharing the link of the material used here, and we have used wonderful charts to explain the subject. So entire ratio analysis is being given to you. Go through it, provide your view on this. In case you need any support on any other chapter, we'll try to help you out. I'm planning to upload one more chapter in costing and one more chapter in financial management. You can comment in case you need any other chapter to be uploaded by us. The detailed video, this is a detailed video, around 11 to 12 hours it will be there, but you see how beautifully the entire ratio analysis is covered, and this will give you the comfort to face any type of question in exam. And one question is anyway 100% going to come from ratio analysis. Just go through the video. After that, you don't do anything. Just go through the video fully. Do questions along with me. Do questions along. When I say go through the video, you'll have to do questions along with me in the video, and you are done. You are done. No separate practice, nothing is needed. So now I take you to the video site, the detailed video where we will first initially explain what is ratio, then we'll link it to various category of ratio. Everything would be explained. Now to the normal video. Thank you, friends. Good morning, friends. Okay, today we are going to start with your chapter 3 as we have done when we were doing costing. I'll first spend a little bit of context setting and then we get into specific discussion. So we are going to an area called ratio analysis, which is a part of a bigger area called financial analysis and planning. Now, in big corporates, there will be a separate department called as FP&A, financial planning and analysis is a separate segment where they will be doing forecasting of performance, and somewhere ratio analysis is an important tool in forecasting the performance. So why are we learning the ratio analysis? Let's understand that. Now whenever I look at a balance sheet or a P&L on a standalone basis, when I look at, I will not be able to tell whether the company is doing well, not doing well, unless I do a comparison. For example, if I say Bharadwaj Institute has 400 students, now this 400 student, is it a good number, bad number, difficult for me to tell. But we have 400 students is the number I get to know. Second information I get to know is they have 10 teachers. Moment I get this two information, practically I can calculate a ratio called student teacher ratio, which happens in schools. Many a times when you go to school for your LKG, UKG admission, parents will ask how many students and how many teachers will be there in a class. Student teacher ratio, something they track. That is also a ratio only. A student teacher is a ratio which people track in a school industry or in an education industry. Like this, a ratio basically compares two numbers which are related in some manner. There should be some logic of these two numbers. India's GDP with the population. I link them together and maybe calculate something called as a per capita income. So there will be some linkage that per capita income is also a ratio. It is a ratio. Why are we doing this ratio analysis? Because without ratios being in place, it is very difficult for us to understand certain numbers. So to give more value to the numbers which are being presented, we convert them into ratio. Ratio is going to compare two numbers which are logically connected in some manner. For example, now let's take the example of Tata Consultancy Services. Now, this is the P&L of Tata Consultancy Services. The sales has been growing year on year, but now this 255,324 was the sales of March 2025, and they made a profit of 65,331, profit after tax of some 48,797. Now, is this profit a good number for the sales which has been done or not? I can calculate using a net profit ratio, and then I can observe the trend in the net profit ratio. So you will see a ratio being calculated. So we have multiple ratio. Okay, net profit ratio is not given, but some other ratios have been given in this screener.in. But these ratios will give me an understanding as to whether the company is doing well or not doing well. For example, here on the profit side, there's a ratio which they have calculated called as OPM percentage, operating profit margin percentage. We'll be learning all of that when we do this analysis. But this percentage has been around 26, 27, 28, 27, 26. So that is the operating margin percentage. Now I can compare this percentage parallelly. I open another company, Infosys, which is both are into same business. Infosys and Tata Consultancy Services both are into IT business. And now if I see their profit and loss account, their ratio is around 24%. TCS ratio is around 26%. I can say TCS is performing better as compared to its closest rival, which is Infosys. Like this, many companies can be there. I can take another company in the same industry, Tech Mahindra. Tech Mahindra has a operating profit margin of only 13%. So something has been going wrong there. What is going wrong? We'll have to check. Or maybe they have multiple other segments also, because their operating profit margin has been 14, 15, 18, 15, 18. Never they have touched those 24, 25 percentage. So could be some reason. I'll have to analyze that reason later. First part is ratios will tell me whether the company is doing well, not doing well. If I'm forecasting the performance, ratios will help me in validating the forecast which I have done. Whenever I do any forecasting, if somebody says India's per capita income will grow by 10% over the next 5 years. Now, when you make this estimate, you may have to estimate the GDP first, you have to estimate the population growth, and then calculate the per capita number. Or somebody will say, I'll directly calculate the per capita number. After you do that, to validate whether my answer is right or wrong, I may calculate GDP and see the GDP growth. So purpose of ratio is very limited. It gives some meaning to the numbers which you see. The numbers on a standalone basis may not give me any clarity. But moment I have current assets so much, current liability so much, good, bad, okay, current ratio can be calculated. The current ratio will give me some meaning to the numbers which are there. I can see the trend in the current ratio. I can compare my current ratio with the peers current ratio. So I can try doing those extra computation. With the extra computation, I will get clarity as to whether the company is in the right direction or not. This is the primary purpose of ratio. Now, ratio analysis is linking of two items which are connected in some way. There should be some logical connect between the two numbers. Bharadwaj Institute, revenues, number of student, there is a logical connect. If students increase, revenues can increase, and I can calculate revenue per student. I can calculate a number called revenue per student, or revenues number of teachers. If I feel that increase in the teachers can increase the revenues for Bharadwaj Institute, revenue per teacher can be calculated, cost per teacher can be calculated, cost per student can be calculated. Wherever we have done in costing also, you would have done cost per unit calculation, that is a ratio. Wherever you would have done cost per unit, it is basically a ratio. We used to do an item called OAR, where we were linking budgeted overheads and budgeted suitable fees. That is also a ratio. Wherever you link two items which are logically connected in some manner, it is called as a ratio. Now, you would have seen this ratio analysis at earlier levels. So I will be able to pass on the discussion what you had earlier. Maybe in your 11th, 12th, or in foundation you could have seen, or in your college you could have seen. The ratios we are going to see is predominantly from the financial statement. We are not going to talk about non-financial statement ratio. What is a non-financial statement ratio? An example for Bharadwaj Institute is student teacher ratio. This is a non-financial statement ratio where number of students don't come in our financial statement. Number of teachers is not an information in financial statement. Or number of enquiries compared with the number of admin team we have. Number of admin team we have, I can link that as a ratio called enquiries handled per admin person. So that is a ratio I can calculate. Like this, multiple ratios can be calculated by us. They are either from financial statement or not from financial statement. We are focusing now only on those items which come from financial statement. Clear? So this is basic background on ratio analysis. These two items can be from P and L. What is the formula for GP ratio? Do you remember GP ratio formula? Gross profit by sales. So the two items which we are using, it is linking of two items. The two items can be from P and L. If they are from P and L, an example is GP ratio. An example is GP ratio. Like that, you have NP ratio, you have operating profit ratio, you have COGS ratio. The two items can be from balance sheet. The two items can be from balance sheet. Classic example is current ratio, which is, what's the formula? Current assets by current liability. And sometime one information can be from P&L and one information can be from balance sheet. An example is debtors turnover ratio. You could have come across the formula later, but take any all formula, we'll discuss it again. The formula for this is sales divided by debtors. Now here alone, I will have to take average data for the P&L item, average data for the, sorry, average data for the balance sheet item. Please correct it. Average data for the balance sheet item. Sorry about it. Take average data for the balance sheet item, not the P&L item. Take average data for the balance sheet item. Let me explain this part again. There's an error there. You first correct the error. Now let's understand this. What happens here? Listen, I calculate debtors turnover ratio. The formula is sales divided by debtor. Sales information is a full year information starting from day 1 till day 365. Debtor is an as on date information. Debtor is a as on date information. When I do current ratio, current asset as on date, current liability as on date. When I do GP ratio, GP for the year, sales for the year, current asset as on date, current liability as on date. But when it comes to debtors turnover ratio, sales is for the year, but debtor is as on date. Debtor is as on date or as on 31st March, because debtor is only a single day figure. Now, on the balance sheet date, if at all an event happens, an event like COVID happened in the month of March. So what will happen in the company's balance sheet is sales was not affected for the full year, but debtor collection did not happen in the last month because COVID happened in the month of March. And on the balance sheet date, huge debtor figure is there. Huge debtor figure is there, but sales was not impacted. Sales happened for 12, 11 months properly. 1 month alone sales did not happen properly, but debtors got affected on the balance sheet date. To avoid this impact, we take average. Average means average of opening and closing. Can that remove the full effect? No, it cannot remove the full effect and all, but still better than taking as on date figure. Ideally, I should go ahead and take average of every month, but that information and all you will not have in the practical world. You can have an opening balance sheet and closing balance sheet. Opening means last year balance sheet and current year balance sheet, and in your practical world you will have to do a comparative data, last year data, current year data. So because of that, 2 year opening closing information will be available, but I cannot have January datas, February datas, March datas, April datas, May datas. If that information is possible, I will go ahead and say take average of every month. Practically not feasible, practically not feasible. So that is why we take the average data for the balance sheet item. This also, if information is available when you do problem solving, many problems information will not be available. I want to take average debtors turnover ratio formula is sales by average debtor. You have average debtor, take it. You do not have average debtor, take closing debtor. Wherever information is available, we'll have to take average for the balance sheet item. If a ratio takes a balance sheet item and a P&L item. If you are going to do current asset by current liability, don't take average current asset, average current liability. Why no? Because if current asset got affected on the balance sheet date, current liability will also be affected on the balance sheet date. Both would have got affected on the balance sheet date is the logic. The logic is on the balance sheet, two items both from balance sheet, average not needed. Two items from P&L, average not needed. Two items from P&L, average not needed. Two items from balance sheet, average not needed. But one item from P&L, one item from balance sheet, we will need average, and multiple ratios are there. So basic background is set. What we have learned is ratio analysis is going to link two items which are connected in some manner. There should be some link between the two items. The link could be because of multiple reasons. The link could be because of multiple reasons. They should be linked in some manner. It could be an item like current asset with a current liability. It could be an item like quick asset and a current liability. It could be an item like fixed assets and current asset. If you feel there is a link, between current asset and fixed asset, how can there be a link? Fixed asset means plant and machinery. More plant and machinery, more production, more stock, more data. So I'm linking fixed asset and current asset. If you feel there is a link, if you feel no, there's no link between fixed asset and current asset, don't use that ratio. So ratio analysis basically says if items are connected in some manner, convert that into a ratio. If it is not connected in a manner, don't link that as a ratio. These two items, the ratio, the two items can be from P&L, can be from balance sheet, one from P&L, one from balance sheet. Clear? Now, these are the category of ratios we are going to see. There is something called as liquidity ratio or short-term solvency ratio, capital structure, long-term solvency, profitability ratio related to sales, coverage, asset or investment, owner's point of view, market and turnover ratio. Now, whatever category you see, we'll see one by one each of the category, look at the various sub ratios, and then do a problem, then go to the second category, third category. So today's session we will try to understand more about the every ratios which are there. Next class, or maybe today's the second session part, we may get into advanced discussion on the ratio, but today primary focus is to get some clarity on each of the ratios which are there. And all of this you have seen earlier, doesn't really matter whether you remember what you did earlier or not. We are going to take it like a fresh discussion. So the first category of ratio is liquidity ratio. The term liquidity, what is liquidity is ability to repay short term liability, ability to repay short term liability. For example, I need to pay 1 lakh tomorrow. I need to pay 1 lakh tomorrow. I am having lot of wealth, but everything is locked in fixed deposit and I cannot break the FD. Assuming I cannot break the FD, I've created fixed deposit of 2 crore rupees. I have fixed deposit of 2 crore rupees. Huge money is available with me, but I'm not able to pay this 1 lakh tomorrow. I'm not able to pay this 1 lakh tomorrow. Reason is I do not have any liquid money. I do not have any liquid money which can take care of this liability which is coming tomorrow. Tomorrow I have to pay 1 lakh rupees because of certain reason, but I do not have the, a company is extremely strong. My financials are extremely strong. 2 crore rupees I'm having. Extremely strong finance. If I prepare my balance sheet will say capital 1 crore 99 lakh. Liability only 1 lakh. Asset side FD 2 crore. This is my balance sheet. But still I'm not able to pay this 1 lakh tomorrow. Reason is my liquidity is under stress. My liquidity is under stress. And if you calculate current ratio for me, it is 0 times. Current ratio will be 0 time because no current asset, but I have current liability. I have current liability. So liquidity ratio will tell whether you have the ability to repay your short term liability, short term solvency. Another one is called long term solvency. I have FD, I have long term loan and FD, no problem. Long term loan I'll be able to repay because long term loan not immediately to be paid. Maybe at the end of the year I have to pay something. Next year I have to pay something. Next to next year I have FDs which will mature and I can pay it. Long term solvency, no question mark for me, but short term solvency is a question mark. And this is a trouble which happens with many people in the practical world also. At an individual level, these trouble can happen, and at a company level also it can happen. I don't know how will I pay the salary to my employees tomorrow. That is the problem I'm in today. Salaries have to be paid. I have FDs and all, but I cannot break it. Debtor money is not coming in. Sales is not happening. So how will you pay your current liabilities? What this ratio is going to look at. Clear? This is the context. Ability to repay the short term liabilities of the company. Ability to repay the short term liabilities of the company is going to be analyzed through liquidity ratio or short term solvency ratio. The ratios will be more or less self explanatory. Current ratio is current assets by current liability. Now, there's nothing called as an ideal current ratio because this is a usual interview question. I myself have asked many candidates this question: what is an ideal current ratio? There's nothing like that. There are different views of different author. Less than one is bad, more than one is good. That also is not right. For example, companies like Hindustan Unilever Limited, which is a very big company, FMCG major, these companies may work with a negative working capital. What is negative working capital? Is more current liability, less current asset, but still no problem for them because they will have certain other money which is available, but they may work with a negative working capital cycle. In a negative working capital cycle, what will happen? Your current ratio will be less than 1 time. What is negative working capital? Current assets less, current liability more, and FMCG companies like Reliance and all, they may work with negative working capital. How can they do negative? HUL says I will not give any credit to my dealer because I'm a big company. I will not give any credit to my dealer. Debtors is very less. Wherever I am buying raw material, I tell them give me 60 days credit. I am a big company. I will put pressure on you and you will have to give me 60 days credit, 90 days credit. I do not maintain much inventory because my product is very fast moving and I don't want to maintain inventory. So I can work with a negative working capital cycle also, but that does not mean I am under trouble. So first thing you understand is ratios. Whenever you look at in a practical world, it is has to be looked at in the context. Context means you need more clarity. From our point of view, ICA will not ask you to comment on the ratio. They only want you to calculate ratio. So first ratio is current asset by current liability. What are current asset? I want participation, guys. What are current asset? You'll have to tell me. I have no idea. Okay, cash, bank. Any definition of a current asset? Is there any definition of a current asset? You'll have to be louder. I'll have to hear you guys. I cannot talk like this. You'll have, yeah, assets which can be converted into cash within a period of 12 months. Within a period of 12 months is a current asset. Examples you have already given me: cash, debtor, inventory, technically prepaid expenses, bills receivable. All of this will form part of current asset. What are current liability? Definition: liabilities that are to be paid within a period of 12 months. Within a period of 12 months is basically your current liability, and current assets are those items which can be converted into cash within a period of 12 months. So this checks whether do you have the ability to repay your current liability. Then a variant of current ratio. A variant of current ratio is quick ratio. Now what is the variant here? In the current ratio, I have various items in current asset. What are the items you said? Please tell again. I want participation, guys. Initial class, see, you will have to get used to, because when we were doing costing, initial participation was there. I want participation initially. Tell me the examples of current asset. Stock, debtor, cash, bank, prepaid expenses. Just give me a minute. Debtor, prepaid expenses, cash, bank. A variant of your current ratio is called quick ratio. Another name for that is acid test ratio. You can go to this place and write the other name in the site. I did not have space to write the other name and all. Acid test ratio, quick ratio. Other name is acid test ratio. Acid test ratio. Okay, now let's understand why this variant came. Debtor, I gave credit of 30 days and all. I can try and collect the money. Cash is anyway in the form of cash only. Bank is already there in the form of cash only. Some short term investments are there. All these are easy to convert. But stock, first it has to be sold, then converted into cash. So I expect it will happen within 12 months. That is why it is a current ratio. But for quick ratio means quick asset by current liability. The concept says for quick ratio, you can ignore two items. One is stock. Reason for removing stock is converting this into cash may take little longer time. So I don't want this to be part of quick asset of an organization. It can be part of current asset of an organization. This will tell me, the quick ratio will tell me the items which can be readily converted or which can be converted faster into cash, and then I'll pay my current liability. Another example item is prepaid expenses. Can you give me an example of a prepaid expense? Give me an example of a prepaid expense. What can be prepaid expense? I paid, okay, rent. Prepaid rent. I paid rent for the next 1 year. I paid rent for the next 1 year. Can this rent become cash for me? Is it possible? Very rare possibility, unless I tell the landlord that I paid you 1 month rent, 1 year rent. I paid in advance. Can you return me 6 month rent and I'll give you every month the rent? Very rare possibility. I paid internet for 1 full year. I paid internet for 1 full year. Converting that into cash is next to impossible. Next to impossible. You paid it for the 1 year. How will you get it is an asset only. I'll get the benefit for the next 1 year. Every month I get internet facility. Every month I get rent facility. That is, every month I use this building. So I'll get the benefit of it. But converting into cash is a question mark. Converting that into cash is a question mark. So it is ideally, according to me, even in current asset it has no utility. Even in the current asset it has zero utility, because you can never convert that into cash. But in current liability there are outstanding expenses, so here I want to write prepaid expenses. But logic is converting this into cash and all is next to impossible. Next to impossible. You have paid rent for 1 full year, get the benefit for 1 full year. You stay in the property for 1 full year, nobody is going to stop you. But converting that into cash, impossible. Converting into cash is impossible. Prepaid. Bharadwaj Institute paid me remuneration for the next 1 full year. So they will record in the balance sheet as current asset. But they cannot recover this money in the next one. In the next 1 year, what will happen? I'll keep taking classes. They'll not pay me extra. But converting into cash for Bharadwaj Institute is impossible. So this is what the concept is. So in this, I remove stock and prepaid expenses. I remove stock and prepaid expenses. Clear? This is the second item. The second ratio is quick ratio, quick asset by current liability. I don't expect you to remember any of the formula. Understand logic. Day before exam, you quickly go through the charts, automatically things will register for you. Absolute liquidity ratio. This is extreme form of liquidity ratio. What is absolute liquidity ratio is, you are saying you have cash, you have debtor, you have inventory, you have prepaid expenses, you have lot of items. In this liquidity ratio, I want to consider items which are like cash, You could have come across a definition in your accounting standard called as cash and cash equivalent. What is cash equivalent is, or okay, you will, for people who are yet to do group 1, you will come across this definition when you go through in accounting. What are cash equivalent is? Items which can be converted into cash readily. There's a definition there which is less than 3 months time. But here in the ratio analysis, these are items which can be readily converted into cash. What are those? Cash in hand, cash at bank, and maybe short-term investments. Short-term investments which are marketable securities. We call it as marketable security. Consider that as the numerator. So for all of this, this is current asset. I compare this with current liability. This is quick asset. I compare with the same current liability. And this is cash and cash equivalent. This is cash and cash equivalent, and I compare with the same. So current asset looks like bigger than current liability more than 1 time. This looks maybe almost the same, so could be equal to 1 time. And this looks lesser, so could be half a time, 0.75 time, whatever it is. Basic logic is, you are comparing current assets with the current liability, quick assets with the current liability, and cash equivalent with the current liability. Cash and cash equivalent with the current liability. These are the 3 ratios. Clear? Then there are 2 variants. One is called basic defense interval. What is basic defense interval is, I want to know how many days of safety I have in my business. What is safety in business? COVID happened. COVID happened. Moment COVID happened, extra sales is very difficult after this. Many manufacturing company said we are not going to sell anything beyond the sales is kind of impossible for us. But I still have to pay my salary. I still have to pay my rent. I still have to pay some maintenance charges. So what basic defense interval says is, if your daily expense is 10 lakh, how much cash you have along with receivable. Why receivable is considered? Assuming you will be able to collect. You are not able to do any extra sales, but assuming you will be able to collect the receivable, which during COVID was even a question mark. Even collecting money was a question mark. But what does basic defense interval says? How many days can I survive without doing any extra sales? Without doing any extra sales, how many days of survival is possible? How many days of survival is, for example, I want to know what is my basic defense interval. How many days can I survive without earning any extra income? I don't earn anything from Bharadwaj Institute, don't earn anything from outside. If my income is zero, can I survive another 3 months, 6 months, 9 months, 12 months, 15 months, 18 months is what basic defense interval is saying. Many times what can happen in a practical world is suddenly an organization may lay off employees. So when this layoff happens, an employee now has no income. He is not going to have any income, but still he has to manage his expenses. So a lot of people say that 3 months of your expenses, 6 months of your expenses, at least have it in the form of cash or FD, short term FD, so that you can manage the show when suddenly something like this happens. So at an individual level we do it, at a company level also we can do it. At a company level it's called basic defense interval, where we consider cash, we consider cash equivalent, and we consider receivable. Anywhere the short form you want to write explanation, you write it, because in the chart I do not have space to write. So CE means cash equivalent, CA means current asset, CL means current liability. If at all you want to write, up to you. Okay, QA means quick asset, CL means current liability. In the side you want to write, you write it. You don't want to write, don't write it. If you're okay, don't write it. If you want to write definition, explain, that is bigger explanation, please write. So basic defense interval will tell how many days can I survive without doing any extra business, without doing any extra business. I take cash equivalent, and I take receivables. I take receivable. These are the three items I take: cash equivalent, receivable, both same numerator, but one addition here is receivable. One addition is receivable, with the logic that I'll be able to collect it. If somebody says no, you will not be able to collect it, ignore this also. Ignore this also. Divided by daily expenses. Daily expenses. My expenses are 5,000 per day. I have in my bank account 5 lakh rupees. Another 100 days I'll survive. Another 100 days I will survive. After 100 days we'll see what to do, but another 100 days I do not have any problem. I do not have any problem. Many of the startup calculate this, because they don't earn any income. They don't earn any income. They are only doing, as of now, many startup will be burning money. They call it as burning money. So what they will do, they will see how many days of interval we have, or how many days of runway we have. They also call the technique, they keep using different names, but how many days can I survive without earning extra income, without earning extra income. And the last ratio here is called net working capital. Working capital you could have come across earlier is called current asset minus current liability. Same thing only, but there can be two purposes of calculating working capital. One purpose of calculating working capital is normal working capital, which is current asset minus current liability. Another purpose is to take loan from the bank. To take loan from the bank. So I'll go to the bank and say I need loan against my working capital. Bank, while calculating working capital, will consider operations related working capital. What is operations related? Operation means debtor is operation related, inventory is operation related, creditor is operation related. But if you take any short term loan, it is finance related. It is not related to operation, it is related to finance. It is related to financing activity, or related to finance. Financing activities, again, something we learn in cash flow statement in accounting, but related to finance and not related to operation. So the formula says current asset minus current liability, but in the current liability you can exclude short term loan. You can exclude short term loan. So I have looked at 5 ratios as of now: current ratio, current asset by current liability; quick ratio, quick asset by current liability. In the quick asset I remove 2 items. One is stock, another one is prepaid expenses. Third is absolute liquidity ratio, cash and the cash equivalent divided by current liability, divided by current liability. Fourth is basic defense interval, which is cash equivalent and receivable. Cash equivalent and receivables divided by daily expenses. And net working capital is not technically a ratio, it is an amount. It's not a ratio. Ratio means normally you will divide by one number with the another number. Here we are not dividing, we are just subtracting current asset minus current liability, but in the current liability exclude the non-operations related item, technically called short-term loan. Any doubts on this? Any doubts on this? I give you a minute, go through this chart, and then we discuss some MCQ and proceed forward. A minute for you. Okay, now whatever we have seen here, let's check the understanding with the examples which are given below. MCQ examples I give. These MCQs will help us in getting understanding of the ratio, and then we'll do descriptive question. Cash and cash equivalent 1000 lakh, receivables 500 lakh, inventory 300 lakh, daily expense 10 lakh. How much is basic defense interval? What is the formula for basic defense interval? I want participation, guys. Cash, cash equivalent, receivables. Inventory will not form part of basic defense interval calculation. So 1000 plus 500, 1500, daily expenses how much? 10 lakh. So we get 150 days I can survive. I can survive 150 days. Current asset 20 lakh. Current asset 20 lakh. These are good MCQs. You may write along with me few MCQs. Quick asset 4 by 5 of current asset. Quick asset is 4 by 5 of current asset. Tell me what is the quick asset figure then? 16 lakh. Cash and cash equivalent half of quick asset. Half of quick asset. So how much is cash and cash equivalent? Participate, guys. I want everyone to participate. 8 lakh. Current liability 2 lakh. What does absolute liquidity ratio? Tell me the formula first for absolute liquidity ratio. Cash and cash equivalent divided by current liability. What is cash and cash equivalent? 8 lakh. Current liability 2 lakh. How much this is? 4 times. Current ratio of a company is 3 is to 1. Current ratio of a company is 3 is to 1. What will be the impact on current ratio on collection of money from sundry debtor? Collection of money from sundry debtor. Let's take an example. Current asset is 300. Current liability is 100. Current asset is 300. Current liability is 100. I collected money from debtors. I collected money from debtors. Will anything in the current liability change? No. Okay, let's leave it. Will anything in current asset change? Will it change? No change. Why no change? Debtors, the components will change, but debtors will now become cash. Debtors will now become cash. Debtors will go down, cash will go up, total will remain 300. Total will remain 300. Unless they say you collected the money and bought something else, that's a different story. As of now, collected money, debtors go down, cash go up. Debtors go down, cash go up. Debtors go down, cash go up. Answer is no impact. Answer is no impact. So this is a basic understanding. I have not given every ratio, some basic understanding, some examples just to quickly understand the ratio. And now we will be getting into descriptive question to fully test our understanding of the ratios. Any doubts on this? Any doubts? So we have seen 5 ratios till now. Current ratio, current asset by, I want participation, current asset by current liability. Quick ratio, quick asset by current liability. In quick asset, what are the items removed? Stock and prepaid expenses. What is the third item? Absolute liquidity ratio is equal to cash and cash equivalent divided by current liability. So all the three has current liability denominator. Then we saw basic defense interval. Basic defense interval. What is the formula for basic defense interval? Cash, cash equivalent and receivables divided by daily expense. Purposes in case my business stops or I'm not able to earn anything for some time, how many days can we survive? And last one was net working capital, current asset minus current liability, but in the current liability remove short term loan. Remove short term loan. Clear? Any doubts on this? Any doubts on this? Okay, let's see question number 1, which is on liquidity ratio. Calculate current ratio, liquid ratio, absolute liquidity ratio, basic defense interval from the balance sheet of ABC Limited as at 31st March 2015. Liabilities lakhs, assets in lakhs. Equity share, preference share, securities premium, general reserve, P&L, 10 lakh, 12.5% convertible debenture, bills payable, trade creditors, outstanding expense, provision for tax, total, land, plant, furniture, stock, debtor, cash, bank, bills receivable, daily expenses can be taken as 10 lakh. Now, this is a concept related question. I don't see exact same question all getting repeated in exam, but these are concept related questions just to get quickly whatever you learnt in the phi ratio, we are going to put it here. Clear? Nothing much for you to read. I'll directly start solving the question. Let's start. Current ratio is equal to current ratio is equal to current ratio is equal to, tell me the formula. Current assets by current liabilities. Current assets by current liabilities. Assets by current liability equal to. Tell me what item should I include in current asset here. I want participation, guys. Unless you tell, I'll not proceed. Tell. Starting from land, is it part of current asset? No. Plant, furniture, stock, debtor, yes. Cash, yes. Bank, yes. Bills receivable, yes. So 5 items are part of current asset, 3 items are not part of current asset. So in the calculation, 1060 plus 940 plus 130 plus 600 plus 270 divided by, you can write like this itself, or you can write the overall total, that's your wish, but I feel better to write it this way. 1060 plus 940 plus 130 plus 600 plus 270. What are the items of current liability here? Starting from bills payable, trade creditors, outstanding expenses, provision for tax. So denominator is 160 plus 280 plus 120 plus 440. Tell me the total of current asset. 3000. Okay. Current liability 1000. Okay. 3000 by 1000. 3000 by 1000. 3000 by 1000. Now you can either call it as, right, 3 times, or another way we call it as 3 is to 1. 3 times or 3 is to 1. Both way you can answer this. You can call it in times, or you can call it as 3 is to 1. Some question will say 3 times, some question will say 3 is to 1. Both are same. Any doubts on this? Clear? Second ratio, quick ratio. Quick ratio. Quick ratio. What is the formula for quick ratio? Quick assets by current liabilities. First question I'm writing detailed calculation, detailed formula. Later on up to you. Quick assets by current liability. What is quick asset is? Current asset minus inventory. In this question, minus inventory, okay? Or you can write current asset minus inventory minus prepaid expenses. Minus inventory divided by current liability. 3000 minus current asset is 3000. 3000 minus, how much is the inventory? Guys, I'm asking a very simple question. First problem, you will have to participate. Minus 1060. I want participation in the initial classes, then only you will get used to this area. Minus 1060 divided by 1000 1.94 times or 1.94 is to 1. 1.94 times or 1.94 is to 1. This is the second ratio, quick ratio. 1.94 times or 1.94 is to 1. Clear? Can we proceed? Third ratio, absolute liquidity ratio. I want participation. You will have to tell me the formula. You will have to tell me the calculation. What is the formula? Cash and cash equivalent divided by current liabilities. These are initial question to get started with the concept. Cash and cash equivalent divided by current liabilities. How much is cash and cash equivalent? What are the items of cash and cash equivalent? Cash 130, bank 600. Bills receivable is not part of cash equivalent. Okay, you cannot say when it will be collected and all. So 130 plus 600 divided by 1000. 0.73 times R. 0.73 is to 1. No need to write both and all. First question I'm writing both ways. Okay, mostly I'll write only as times. Okay, but either ways it can be written. 0.73 times or 0.73 is to 1. Any doubts on this? Was the fourth requirement? Basic defense interval. Basic defense interval. This will basically tell me how many days can we survive in case new income is not coming, in case you are not able to generate new income. What is new income? Inventory sales cannot be done. You cannot sell your inventory. So this is cash, cash equivalent and receivables. Receivables will include debtors also. Receivables, it is receivables. It should include debtors also. Receivable have two items, debtors and bills receivable, divided by daily expenses. 130 plus 600, which is your cash and cash equivalent, along with that receivable. Receivable means debtor as well as bills receivable. Debtor as well as bills receivable. Debtors is how much? Bills receivable. The only difference between the two is bills receivable means there is a guarantee 100% money will come. Debtor, I am still at the mercy of the client. He may delay it, because bills receivable is paid by the bank. In case the customer does not pay, bank will be forced to pay. That's how bills receivable work. For us, both are same. Bills receivable and debtor is same. Divided by what is the daily expenses? What's the number you get? 194 days. This is answered in days. I can survive 194 days without any extra inflow of money, without any extra inflow of money in form of sales. Okay, debtor money has to come, but in form of sales, no extra money coming. 194 days survival. Any doubts on this? One thing which they have not asked, we will do it still. Net working capital. Current assets minus current liabilities in bracket excluding short term loans. Current assets minus current liability in bracket excluding short term loan. Excluding short term loan. Excluding short term loan. Current assets minus current liability excluding short term loan. What is the total of current assets? In the current liability, is there any short term loan? First check and tell me. In the balance sheet, is there any short term loan? Bills payable is not a loan, trade creditor is not a loan, they are related to operation, outstanding expense, not a loan, provision for tax, not a loan. So minus 1000 lakhs as it is. 2,000 lakhs. 2,000 lakhs. Any doubts in this? Nothing much in the question, but still I give you a minute time. You go through it with the concept book, with the question, whatever you want to do, and let me know if you have any doubt in the this category of ratio. The first category ratio is over 1 minute for you. Okay, now I move to the second category of ratio, which is called capital structure ratio or long-term solvency. Now let's first understand what does the term capital mean. Capital, as far as financial management is concerned, means long-term money, not your accounting definition. Accounting capital means owner's money. Here, even long-term loan is part of capital only. We call equity capital, preference capital, debt capital. Debt is also part of capital. Capital means long term money. So, what does this ratio measure is my ability to repay the long term liability, ability to repay the long term liability, or it measures the composition of this long term money. Composition of this long term money. Infosys do not have any major loans in their balance sheet. If you look at Infosys balance sheet, this is Infosys balance sheet. In their balance sheet, equity capital 2073, reserves 93,745. Borrowing is technically zero. This is some accounting related adjustment which is called lease liability, but they have not borrowed any money. They have not borrowed any money. So that is a company with zero debt. If you are a company with zero debt, obviously there is no major problem in repaying your long term liability. So, what does this ratio measure is ability to repay the long term liability, or it measures the composition of the long term money of an organization. It measures the composition of long term money of an organization. Now, how do I check the long term money? Let's see first a term called capital employed, and then I come back to the various formulae. A term called capital employed. What is capital employed? Capital used in the business, or the term capital means long term money. First formula is total assets minus fictitious asset minus current liability. Total assets minus the fictitious asset minus the current liability. For example, the question which we did some time back, the total asset is 7,000. In this, any fictitious asset is there in this 7,000. What is fictitious asset? P&L debit balance, miscellaneous expenses not written off. Is there anything like that? From this 7,000, if I remove current liability 1,000, 6,000 is the capital employed. 6,000 is the capital employed. This is one way of looking at. What is one way of looking at is all assets, remove the fictitious one, remove the current liability. Another way of looking at capital employed is equity share capital, reserves, preference share capital, long term loan, and obviously remove the fictitious asset. Remove the fictitious asset. So, another way of looking at this, can you put a total of all of this? Please put a total. Equity, preference, securities premium, general reserve, P&L, debentures, put a total of all of this. Same 6,000 you will get. Same 6,000 you will get. So, what is capital employed? Capital employed means capital used in the business. Capital used in the business. How do I calculate capital employed? Very simple. Either go through asset side route or go through liability side route. Asset side route what? All assets. Remove the fictitious one. Remove the current liability. Liability side route what? Add up all the long term liability. What is long term? Equity capital, preference capital, retained earnings, reserves and surplus, securities premium, long term debentures, long term loans, and obviously in the asset side, if any fictitious is there, you will have to knock off. You will have to knock off. Clear? Any doubts till this? Any doubts in this? Now, in this 6,000, I want to check the composition. What is composition? How much equity? How much preference? How much debt? which is what this ratio is going to do. The ratio is going to do. So first is capital employed. What is capital employed? Asset side root is there, liability side root is there. Asset side root, total asset minus fictitious asset minus current liability. Our liability side root is equity share capital, reserves, preference share capital, long term debt minus fictitious. In many places I've used short form. I have not expanded them. You want to expand it, please expand it whenever we are discussing them. Clear? Okay, this we have understood capital employed. Then let's understand what is equity. What is equity? Because we have capital employed is one thing. Equity means equity capital owner's money. Equity capital owner's money. What is equity is? All of this. Equity share capital, reserves, preference cannot come, long term debt cannot come, minus fictitious asset. Minus fictitious asset. Clear? Any doubts till this? Equity share capital, reserves minus fictitious asset. But how is preference treated in ratio? How is preference treated in ratio? Now, this is a very important term. Equity means the other name for equity is net worth. The other name for equity is net worth. How is preference treated in ratio is preference in the practical world. In the practical world, there's nothing like preference capital. Either preference is part of equity or preference is part of debt. Most of the company balance sheet, you will not find preference capital. You will either find debt or you will find equity. Even if preference is there, I used to work in a rating agency earlier. We had certain policy that preference capital, we were either adding it to equity value or adding it to debt value depending on the nature. What is nature? Companies issue 0.01% convertible preference share. What is 0.01%? No dividend is paid. 0.01% is very limited. Convertible, it will get converted into equity. So what we were doing in our accounting analysis, or in our analysis, not accounting, in our analysis, this preference was removed and added to equity. Was removed and added to equity. Another company, 12% redeemable preference share. 12% redeemable preference share. You could have as well made it as 12% loan, because 12% is like a loan, and redeemable means you will have to repay also. Convertible means you are not going to repay also, and the rate of interest was, or rate of dividend was 0.01%. So looking at the nature, organization will either take it as part of equity or take it as part of debt for our problem solving also. First of all, 90% of the question preference capital will not be there. But if it is there, you can either add it to equity or add it to debt. One exception is there. I'll explain that as we proceed. Either add it to equity or add it to debt. I'll explain again the two important terms. Capital employed. What is capital employed? Is long term money used in the business. Long term money used in the business. Keep the concept book with you, and whenever you want to make some note in the side, for example, capital employed, I use the term long term money. You want to write it. Keep the concept book. Don't be here, because in the charts in the side, make notes, because most of it will be charts discussion only. Extra notes I have not given. So please make your notes if you want. So capital employed is long term money. In the charts, obviously space will be there, so you make notes if you want. Long term money used in the business. This long term money can be computed through asset side, can be computed through liability side. What is asset side calculation? I add total assets. From the total asset, I remove what? Fictitious asset. Participate. Remove the fictitious asset and remove the current liability. Remove the current liability. Other option is add equity capital, reserves, preference capital, long term debt, and remove the fictitious asset. A part of the capital employed is equity. A part of the capital employed is equity, which is equity share capital plus reserves minus the fictitious assets. But then there is this item called preference. This item called preference. Preference can either form part of debt or equity. Most of the question I'll add it to equity. Exception, one formula is there. Okay. Now let's look at the formula. These are now going to be self-explanatory, because I wanted to spend time. First ratio is debt ratio. What is debt ratios? Debt as a percentage of capital employed, or debt as a proportion of capital employed. That is, in the 6,000 lakh, debt is 2000 lakh. Debt is 2000. 2000 by 6,000 you can express in times or in percentage. Debt as a proportion of capital employed. Debt as a proportion of capital employed. If in my capital I have huge debt, 90% debt, I'll become little worried now, because reason is there is no equity at all in the business. If my equity is not there in the business and only debt is there, business fails, I'm not worried about it. Even if business fails, I'm not worried that much. So banks look at this ratio and check whether debt is very high proportion of capital employed. More than 0.5 and all, bank will become very finicky and say, I will not give any loan beyond this and all, because already debt is very high part of capital employed. If I give more loan, the ratio will further deteriorate. So debt as a proportion of capital employed. What is equity ratio? Equity as a proportion of capital employed. Equity, that is why I spent time on capital employed first, okay? Equity as a proportion of capital employed. What is debt to equity ratio? Debt divided by equity. Debt divided by equity. But the definition of debt, ICS, says three things you can use. One, you can use total debt. What is total debt? Short term plus long term. Another one, you can use long term debt. Another option is total outside liability. What is total outside liabilities? Include sundry creditor, include bills payable, include outstanding expenses, include provision for tax, include all liabilities, all outside liability, include all outside. Outside means other than owner, other than owner. First ratio is debt ratio, debt by capital employed. Equity ratio, equity by capital employed. Debt to equity ratio, debt by equity, but it can be total debt, it can be long term debt, it can be total outside liability. What is total outside liabilities? All liabilities of the company in this question, everything starting from convertible debenture till provision for tax. Convertible debenture till provision for tax can form part of total outside liability. I used to work in a rating agency. We were using the formula total outside liability by equity for this ratio. Some banks will use the formula total debt by equity. Another point is ratio can be customized according to your need. You can change the ratio, you can change the formula slightly up and down depending on how you want to calculate it. Debt to asset ratio, as the name indicates, total debt by total assets. Total debt by total assets. Proprietary ratio, these two are interlinked, okay? Debt ratio, debt by capital employed. Equity ratio, equity by capital employed. Debt to asset ratio, total debt by total asset. Proprietary ratio, equity by total asset. Equity by total asset. Debt ratio, equity ratio, denominator is capital employed. Debt to asset ratio and proprietary ratio, denominator is total asset. Denominator is total asset, numerator is same. Another thing here is preference is either part of debt or part of equity in both the ratio. Preference is either part of debt or part of equity. Most of our question, preference will not be there, and in fact I'll be happy. I don't want that headache itself, because in practical world I can customize, because I know what to do. Because when I used to work in a rating agency, we were looking at the nature, taking it as either part of debt, taking it as either part of equity. You will not have extra information and all, and you will not know what to do. So assumption will be taken, assumption differs, all that headache I don't want. Preference not that great, but if it is there, it's either part of debt or part of equity. So what we have looked at: debt by capital employed, equity by capital employed, debt by total assets, equity by total assets, or debt by equity. Another ratio is a variant of this ratio called capital gearing. It's a variant of debt to equity. Only point here is preference will be part of the numerator. In this ratio, capital gearing ratio, it's called fixed capital by equity. The definition is fixed capital by equity. For this ratio alone, preference will always be added to debt. Preference will always be added to debt. Preference will always be added to debt. I'll repeat, 6 ratios are there. but nothing much for you to understand. Important part is this: what is capital employed? What is capital employed? What is capital employed is either you go through liability side route or you go through asset side route. Will both give same answer? Yes, it has to give same answer. What is asset side route? Total asset minus the fictitious asset minus the current liability. That is, when I look at my balance sheet looks like this. Either you add up all of this and remove this, or you directly add this part, directly add the liability side part, or consider the total asset and remove the current liability part. Both technically are same, both are same. So once you get the capital employed, then you get the equity. What is equity? Adding the equity capital, reserves, adding your, or reserves can have multiple items like your reserves and surplus, retained earnings, or you can have securities premium, in whatever names it is, minus the fictitious asset. Then what do I do with preference? Add it either to debt or equity, and one ratio alone, no choices available, which is called exception. It will be added to debt for capital gearing ratio. It will be added to, that's why I said I'll explain later. Now what are the 6 ratios we have? Debt ratio, debt by capital employed. Equity ratio, equity by capital employed. Debt to asset ratio, debt by total asset. Proprietary ratio, equity by total asset. Debt to equity ratio, debt by equity, debt by equity. And another ratio called capital gearing ratio, capital gearing ratio. Ideally I should have arranged it in this manner. Maybe debt to equity and capital gearing should be together. Debt to equity and capital gearing should be together. Both are, debt ratio equity ratio is similar, debt to equity and capital gearing ratio is similar, debt to asset ratio and proprietary ratio is similar. Debt ratio, debt by capital employed. Equity ratio, equity by capital employed. Debt to equity ratio, debt by equity. Capital gearing ratio is also debt by equity, but preference will be added to debt. Preference will be added to debt. Debt to asset ratio, debt by assets. Proprietary ratio, equity by assets. Clear? Any doubts on this? Any doubts on the ratios? Understand the logic, understand the linkage. Any doubts on this? Okay, I give you a minute, you go through all the formulae and then we discuss some MCQ and then do question. 1 minute for you. Okay, any doubts on this? Let's see some MCQs. I'll stop doing MCQs after 2-3 concepts, then you will have to only do at home. Initially I want to do so that you get used to the MCQ way of learning concepts. Net worth 15 lakh, net worth 15 lakh. Net worth means equity. Reserves and surplus to share capital is 0.5. Reserves and surplus to share capital is 0.5. How much is the share capital? The requirement is to calculate, no ratio calculation, requirement is to calculate share capital. Now listen, reserves and surplus divided by share capital is 0.5. Reserves and surplus divided by share capital is 0.5. So I can say reserves and surplus is 0.5 of share capital. I can say reserves and surplus is 0.5 of share capital. Reserves and surplus divided by share capital is 0.5. So reserves and surplus is 0.5 times of share capital. What is net worth? Net worth is share capital plus reserves and surplus. Share capital plus reserves and surplus. So 15 lakh is equal to share capital plus 0.5 share capital. 15 lakh is equal to share capital plus 0.5 share capital. Share capital plus 0.5 share capital. Tell me what is the share capital figure? Share capital is, any doubts on this? These are just concept MCQs. This will help you in many questions later on. Okay. Net worth is equal to share capital plus reserves and surplus, and share capital is, I don't know, reserves and surplus is 0.5 share capital. Reserves and surplus is 10 lakh. Reserves and surplus to shareholder funds 0.4. How much is the shareholder fund? How much is the shareholder fund? What a shareholder fund is? Again, net worth. Shareholder fund is net worth. Now this is little different. They are saying share capital 10 lakh, reserves and surplus to shareholder fund is 0.4. Reserves and surplus to shareholder fund is 0.4. How much is the shareholder fund. How much is the shareholder fund? Again, I'll be doing initial MCQs. I do it fully. It says reserves and surplus by shareholder fund is zero point 0.4. Then I can say reserves and surplus is equal to zero point 0.4 shareholder fund. What is shareholder fund? Shareholder fund is equal to share capital plus reserves and surplus. Share capital plus reserves and surplus. Shareholder fund is equal to 10 lakh plus zero point 0.4 shareholder fund. 10 lakh plus zero point 0.4 shareholder fund. Shareholder fund is equal to 10 lakh plus 0.4 shareholder fund. Can you tell me what is shareholder fund? 10 lakh plus zero point 0.4 shareholder fund. Tell me the answer for shareholder funds. 16 lakh 66,667. Able to understand the concept? This is how our concept MCQs will be. Okay, this you will write it. Okay, then only you'll understand. Capital employed 50 lakh. Preference share and debentures to capital employed is 30%. Reserves and profit and loss to issued capital is 25%. How much is the equity share capital? How much is the equity share capital? Now write capital employed 50 lakh. This can be broken down as equity, debt and preference. Equity, debt and preference. Why I'm clubbing debt and preference together? Because they've given it together here. Debt and preference. What did they mention is debt and preference to the capital employed. To the capital employed is how much? 30%. Preference share and debentures to the capital employed is 30%. What is the capital employed? 30% of this is how much? Which means equity is, you can call this as equity, you can call this as net worth, you can call this as shareholder funds. Different names are there. Okay, so net worth is 35 lakh. Net worth is 35 lakh. Any doubts on this? Another ratio they have given is reserves and profit and loss, or reserves and surplus to issued capital. Issued capital means share capital. Reserves and surplus to share capital is 25% or 0.25. 25% is 0.25. Next, right? Reserves and surplus to share capital is 0.25. Reserves and surplus to share capital is 0.25. This means point 0.25 share capital. Reserves and surplus is 0.25 share capital. And this 35 lakh is share capital plus reserves and surplus. Please get the share capital. 35 lakh is share capital plus reserves and surplus. 35 lakh is share capital plus reserves and surplus. 35 lakhs is share capital plus reserves and surplus. Share capital plus reserves is net worth. How much is the net worth? 35 lakh. Tell me the share capital figure. Share capital is 28 lakhs. This is called issued capital or share capital. Question requirement is how much is the equity share capital? 28 lakh rupees. Any doubts on this? Any doubts on the concept here? Capital 100 lakh, P&L 20 lakh, intangible asset 10 lakh. How much is the debt equity ratio? How much is the debt equity ratio? This you need not do. What is the debt value? Can you tell me what is equity value here? You will have to add few things and deduct few things. What is equity value? Capital, assuming that is the equity capital. Okay, that's my assumption. Okay, I'm not sure what is it. I assume it is equity capital. Capital plus P&L minus intangible asset. I can deduct intangible asset if I feel it is fictitious. If I feel it is fictitious, if you feel no, it is not fictitious, then don't deduct it. That is an assumption based area. I don't know what is done in the solution. I can deduct it. I need not deduct it also. Both choices are there. Both choices are there. But I feel it will be subtracted mostly. It will be subtracted mostly. If I subtract it, it becomes 50 by 110. Do you have any of the option for 50 by 110? 0.45. If none of the option was there, then I would have done 50 by 120. I would have done 50 by 120. And if both options are there, then we are stuck. We can't do much because it's an assumption based area. Intangible asset, an example of an intangible asset is a software. Software could be a real asset also. For Swiggy, software is a real asset. No need to remove it. But some other company, software, they capitalized it, but it was not giving any benefit and all. Then, first of all, your accounting will not allow you to capitalize it. A lot of restrictions are there, but you still went ahead and capitalized it. You may remove it. You may remove it. Have been assumed to be fictitious in nature. Have been assumed to be fictitious in nature. Debt 10 lakh. Equity 20 lakh. How much is debt ratio? What is the formula for debt ratio? Debt by capital employed. Debt is 10 lakh. Capital employed is 10 plus 20. Capital employed is 10 plus 20. That's why initial part I will do MCQs first, and then this MCQs you get good grip. Answer is 0.33 times. Total debt 40 lakh. Total asset 60 lakh. How much is the proprietary ratio? What is the formula for proprietary ratio? Equity divided by total assets. Equity divided by total asset. How will I get equity here? Total asset minus total debt. Balance is equity. Total asset minus total debt. Balance is equity. Balance is equity. 20 lakh by 60 lakh. 20 lakh by 60 lakh, which is 0.33. Now, are these the only ratio? No end to this, okay? I have seen exam question where they'll suddenly say asset to debt ratio. They can change the ratio name. Asset to debt ratio, call total asset by total debt. Asset to owner's fund. Asset divided by owner's fund. You can change the ratio the way you want, okay? Again, I'm saying question may give a, if the question does not give any new names, then they may, if they use the word debt ratio, then you have to know the formula. But they can say capital employed by debt. They'll say capital employed divided by debt of the company is 5 times. Then you use that ratio, that's all. You use the ratio as it is. Clear? Any doubts on the concept? So we have gone through 6 important ratio: debt ratio, debt by capital employed; equity ratio, equity by capital employed; variant of this, debt to equity ratio, debt by equity; variant for this is capital gearing ratio, debt plus preference divided by equity; and debt by asset, equity by asset. Debt by asset is called debt to asset ratio. Equity by asset, the only ratio I feel challenge can be proprietary ratio. Reason is you may not remember the formula. Other ratio, no problem. If I tell you debt ratio, debt, capital employed; equity ratio, equity, capital employed; debt to equity ratio, name indicates debt by equity; capital gearing ratio, again debt plus preference by equity. All ratios students will remember. Sometimes students forget the formula of proprietary ratio. Proprietary ratio is proprietor funds. Its normal formula is proprietor funds. Proprietor means owner fund. Owner means equity capital plus reserves and surplus. And what is capital employed? Asset side root, liabilities. Participate. Asset side root, liability side. Asset side root, total assets minus what? Fictitious assets minus the current liability. Liability side root is what? Equity capital, reserves and surplus, preference, long-term debt minus the fictitious assets. And how is equity calculated? Consider only equity capital plus reserves minus the fictitious assets. And in this, how preference is treated can be added with debt, can be added with equity depending on your assumption. And exception is preference will always be added to debt in capital gearing ratio. Any doubts on this? Any doubts on this? Now we'll start doing questions. Any doubts on this part? Okay, I'll come to question two, but before I come to question two, question one, I want this to 100% happen. Please, I have told this in costing also, don't know how many of you done. Please mark easy, moderate, difficult, write one of them, your wish. I had told you to do it in costing. I am not sure how many of you have done it, but in FM, don't miss it out. Okay, I will not keep telling every question. Mark easy, moderate, difficult. Your wish. Okay, I am not going to say in your book. In your book, write either it is easy or moderate or difficult. Please write it in your workbook itself. No need to write it in your notebook and all. In the workbook itself, write easy, moderate, difficult. So when you revise, if you see the word easy, please don't do it again. Please don't see it again in your revision phase. Moment you see the word easy there, if you write the word moderate or difficult, then you may have to see it. Easy ones not to be seen, moderate ones first revision, difficult ones second revision. Day before exam, difficult questions only. Day before exam, difficult questions only and concepts only, nothing beyond that. Easy, moderate, difficult, I had told you there also. Not very sure how many of you continue doing it. Here also I will stop telling at some time because I cannot keep remembering and then tell you. So you mark it, okay? Easy, moderate, difficult. Let's come to question 2. ABC Limited presents to you the following balance sheet as on March 31, 2015. Equity capital, preference capital, general reserve, profit and loss account, 14% debenture, sundry creditors, total. Fixed asset, less depreciation, investment, stock, debtors, less provision, bank, preliminary expenditure and fictitious asset, preliminary expenditure. P&L include 200 lakhs made this year. They are separately saying will be of no much use. Debt equity ratio, capital gearing ratio, proprietary ratio, debt ratio, equity ratio, debt to total asset ratio. In this, because there is an assumption which is involved, I have told what assumption I have taken in the answer. Same assumption I am going to take. One, preference will be part of equity shareholder fund. One ratio it cannot be added. Okay, one ratio it cannot be added. Then consider total debt and total outside liability as debt for computation of debt equity ratio and debt to total asset ratio. There are two ratios I am saying. Debt equity ratio, total debt will be debt. Debt equity ratio, total debt will be debt, and debt to total asset ratio, total outside liability will be debt. This is what I have told to solve the question, because debt can be understood as total debt, long term debt, and total outside liability. Total outside liability. So I don't want to deviate from the printed answer. I have given my assumptions. In FM, many places I would have given the assumption because otherwise answer will keep changing. So one is for equity, preference will be added, and second thing is total debt will be taken as debt for debt equity ratio. And when you do debt to assets ratio, when you do debt to assets ratio, we normally take only debt, but here I've told that you have to take what? Total outside liability as the debt. Clear? Go through the question for a minute. Go through the question for a minute. Okay, they've asked us to calculate all the 6 ratio. First thing we will do is calculate capital employed, calculate equity, and then start answering everything. Okay. Note 1, computation of capital employed. Computation of capital employed. Capital employed in bracket asset side root. Asset side root. Total assets minus fictitious assets minus current liabilities. I will be doing both the approaches. First question. Later both approach and all is not needed. Capital employed, total assets minus the fictitious asset minus the current liability. Minus the current liability. Tell me the total of assets. Balance sheet total is how much? 1710. Any fictitious asset do you find? Preliminary expenses minus 85. Any current liability? Sundry creditors minus 300. Tell me the value. 1325. This is one way of doing it. Or capital employed. First question, I'm doing both the approaches and all. Later, any one approach is fine. Liability side. Liability side route. Equity plus reserves minus fictitious assets plus preference plus debt. Equity, reserves. It's basically equity plus preference plus debt. Equity plus preference plus debt. Equity includes reserves and fictitious asset. Equity includes reserves and fictitious asset. How much is the equity value given? Sorry, participate guys. 500. We'll add it as it is. Okay, 500 preference 100, 400 of general reserve, 210 of P&L, 200 of debenture. One item to be subtracted. What is that? Preliminary expenses 85 minus 85. You should get the same number 1325. 1325. This is in lakhs. Okay. Any doubts on this? This is on the capital employed. Clear? Can we proceed? Any doubts on capital employed? What the ratio is going to measure is what is the proportion of this capital employed? How much has come from debt? How much has come from equity? How much has come from preference? That composition is what is analyzed here. Any doubts on this? Note 2, computation of equity. Equity in bracket including preference, because preference is part of equity is what the question has assumed us to do. Equity including preference. What is the equity capital? 500 plus what else will come? Reserves is 400 plus P&L 210 minus 85, and I'm adding preference as part of equity. There will be one ratio where preference will not form part of equity, which is called capital gearing ratio. There it will not form part of equity, but otherwise I'll consider this part of equity. 500 plus 400 plus 210 minus 85 plus 100. How much? 1000. To put it very simply, in 1325, 200 is debt, balance is equity. 200 is debt, balance is equity. 200 is debt. What is debt? 14% debenture. 14% debenture. Preference is added to the equity. Preference is added to the equity. Any doubts on this? Next, ratios computation. Ratios computation. I'll go in the order I had explained it itself rather than the order they have asked. In exam, obviously, we'll have to follow this or whatever they have asked. Debt ratio. We'll go in the order I had explained you. Debt ratio. What's the formula for debt ratio? Debt by capital employed. Debt means normal debt. There'll be an exception in one ratio they have said to add total outside liability something. Debt by capital employed. How much is the debt of the company? 200. Capital employed? 1325. Get the answer in times. 200 by 1325. 0.1509 times. I can do 2 decimal or 4. 4 is what I normally prefer. 0.1509 time. What this means? Debt is 0.15 times of the overall capital employed. If 1 rupee is the capital, borrowing is 15 paise, looks manageable. Looks manageable. Equity ratio. Equity ratio. Equity by capital employed. Equity by capital employed. Equity by capital employed. How much is the equity? 1125. Capital employed is 1325. 0.8491 times. Put together it is 1 time. Debt is 15%. Technically, if I do in percentage, I can even express in percentage also. Debt is 15%, equity is 85%. Debt is 15%, equity is 85%. Debt to equity ratio. Debt to equity ratio. Debt to equity ratio. In this ratio, I have given a note. For debt to equity ratio, consider total debt as debt. For total debt means long term, short term put together. Long term and short term debt put together. There's no short term debt here. There's no short term loans and all. So consider total debt as debt for computation of debt equity ratio. But when you do debt to assets ratio, total outside means creditors will also form part of it. Total outside liability. So debt to equity ratio, total debt by equity. 200 by 1125. 0.1778 times. Debt to equity ratio 0.1778 times. Total debt by equity. Then capital gearing ratio. Capital gearing ratio. In this ratio, preference will be added to debt. We'll have to remove it from the equity. Debt by preference. Debt plus preference by equity. Debt plus preference divided by equity. How much is the preference? 100, and remove that 100 from the denominator. Remove that 100 from the denominator. What this means is, for every 1 rupee of my money, I have taken borrowing of 17 paise, 0.1778. Or every 1 rupee of my equity, I have taken 30 paise of debt and preference put together. Debt and preference put together is 30 paise, and debt alone is 18 paise, 0.1778. Then debt to assets ratio. Debt to assets ratio. For this ratio, total outside liability, this is what I have written in the note. Total outside liability divided by total assets. Total outside liability divided by total assets. Outside liability will include creditors, bills payable, outstanding expense, everything. Total outside liability divided by total assets. Outside liability divided by total assets. 200 plus, what is the outside liability we had? 300. No preference addition here and all. Preference we have assumed it is part of equity only. One ratio exception was there. 200 plus 300 was the total asset. Not 1710. Minus 85. 85 is not a real asset itself. So you will have to remove it from the asset side. Ideally, this preliminary expense should not have come here. What it should have done? I should have removed this and reduced it from general reserve or P&L. I should have removed it from general reserve or the balance sheet total is not 1710. That is wrong. because we are writing preliminary expenses. So asset side denominator is 1710 minus 85, minus 85. 0.3077 times. Any doubts on this? In the denominator, I have to remove the preliminary expenses. It is not part of the assets of the company. It was just a fictitious asset which is written there. Debt to assets ratio 0.3077 times. Any doubts on this? And the last ratio was proprietary ratio. The formula, technical formula is proprietor funds divided by total assets. Proprietor means owner's funds. Proprietor funds by total assets. Proprietor is nothing but equity which we have calculated. How much is the equity value? Divided by 1710 minus 85. 0.69 6923 times. I'll explain this now. We have calculation is one part of it. Logic, well, let's try to understand little bit. Debt and equity ratio put together will be one time. Whatever capital employed is there, either it's come in the form of debt or comes in the form of equity. Preference we don't. If somebody says no, preference is a standalone item, then there is a debt ratio, equity ratio. Like that, preference ratio can also be calculated. Debt to, so 1 rupee of my capital, 15 paise from debt, 85 paise from equity. If I compare debt with the equity, for every 1 rupee of equity, whatever is the denominator is 1 rupee. For every 1 rupee of equity, 18 paise is the borrowing, and for every 1 rupee of equity, 29 paise is debt plus preference. For every 1 rupee of asset, 31 paise has come from borrowing and 69 paise has come from my own funds. So whenever, for example, I buy a property and all, property is an asset. Where does it come from? Is it your money or bank money? So here 31 paise of my balance sheet has come from borrowing and 69 paise of the balance sheet is my own money. With this understanding, it is easy for me to compare now my company with another company or my company with last year. Otherwise, standalone basis numbers don't make you understand anything. That is why ratios came into picture. Any doubts on this? Any doubts on this? Clear? Okay, let's take a break now of 10 minutes. Okay, I'll go to the next category of ratio, which is profitability ratio related to sales. Now, related to sales basically means I'll be calculating lot of different variants of profit and linking it with an item called sales. Example, GP ratio, GP by sales, NP ratio, NP by sales, operating expense ratio, operating expense by sales, COGS ratio, COGS by sales. So now nothing to remember in the formula. COGS ratio, COGS by sales, GP ratio, GP by sales, operating expenses ratio, operating expenses by sales. I'll spend some time on what are operating expenses sometime. Operating profit by sales, pre-tax profit, PBT by sales, net profit, PAT by sales, financial expenses ratio, financial expenses by sales, operating ratio. This is maybe, this alone you may have to know. Operating ratio means it includes all expenses. So technically COGS plus the operating expenses by sales. So operating ratio is technically COGS plus operating expenses. COGS plus operating expenses. Denominator sales. Denominator everywhere is sales. COGS by sales, GP by sales, operating expenses by sales, operating profit by sales, pre-tax profit by sales, post-tax profit by sales, financial expenses by sales, and COGS plus operating expenses by sales. Now, this is the format of income statement which will help us in doing all this analysis. I'll start with sales, deduct cost of goods sold, Nothing but items which come in trading account. In trading account, we write opening stock, purchases, closing stock, direct expenses. Deduct that, you will get gross profit. From the gross profit, I deduct operating expenses. Now, what are operating expenses? If you go back to costing, below COGS, certain items were coming: administration expense and selling expenses. Administration expense and selling expense will form part of operating expenses. Will form part of operating expenses. We get operating profit. We get operating profit. After this, I deduct certain non-operating expenses. Interest is not related to my operations, it's related to financials. It is related to how my capital structure is. The last ratio we learned, the capital structure can be debt, equity and preference. So how the capital structure is will decide the interest cost. Then add non-operating income. If at all you have any non-operating income, you'll get PBT, deduct tax, PAT. The first ratio, COGS by sales. Second ratio, GP by sales. Third ratio, operating expenses by sales. Fourth ratio, operating profit by sales. Fifth ratio, PBT by sales. Sixth ratio, PAT by sales. Seventh ratio, financial expenses by sales. Eighth ratio, COGS plus operating expenses by sales. Nothing much for me to explain. Clear? So multiple ratios are there. We'll directly see MCQ now. 1 to MCQ we will see. Calculate operating expenses from the information given below. What is operating expenses? Is your administration and selling. Sales 75 lakh, rate of income tax 50%, net profit to sales 5%, COGS 30 to 90, interest on debenture 60,000. You will write it along with me. This example we will do it along. Particulars amount. Let's write the usual format: sales less COGS, gross profit less operating expense, operating profit. From this we deduct interest expense, and if at all any other non-operating expenses is there, which will be very rare, and add interest income. Income and all is not there. Less interest expense, PBT less tax, PAT. Sales less COGS is gross profit, less operating expense, operating profit, less interest expense, PBT, less tax, PAT. This is the usual format. In this format, in the question, they have told sales. Sales is how much? 75 lakh. Rate of income tax 50%. I write here. What does rate of income tax mean is, if PBT is 100, tax is 50, PAT is 50. Tax is 50 and PAT is 50. Rate of income tax 50% on PBT. We don't know the PBT and all. We'll see. Net profit to sales 5%. Net profit is 5% of sales. Net profit is after tax. Okay. So come down. PAT divided by sales is 5%. PAT by sales. Net profit to sales. Net profit is after everything. PAT by sales is 5%. PAT by sales is 5%. How much the sales number? Sorry? Sales. 75 lakh. PAT is how much? 3 lakh. If 50 is equal to 375, what is 100? 7 lakh 50. We got PBT. PBT is 750. 750. 50 equal to 3 lakh 75. Another 50 is also equal to 3 lakh 75. Put together 750. One more item is given in the question. I think two more items. What else they have given? Interest is how much? 60,000. And COGS is how much? Let's go from the top now. Tell me the GP number. How much? 42 lakh 10,000. Now let's go from the bottom and tell me operating profit. Reverse working 750, reverse 60,000. 8 lakh 10,000. Operating expense balancing figure. So there can be a pure play ratio calculation, or there can be a missing information. That is how ratios help us. It can also be done for forecasting, which you'll understand later. So 34 lakh is the operating expenses. 34 lakh is the operating expenses. Any doubts on this? Okay, this is little trickier one. Net profit to capital is 1 by 5. Fixed asset to capital is 5 by 4. I'll be telling you to do certain things. You will have to tell me, okay? Net profit to capital is 1 by 5. Fixed asset to capital is 5 by 4. Fixed asset is 40 lakh. Can you use this and tell me capital? Please calculate capital. Fixed asset to capital 5 by 4. Fixed asset 40 lakh. Calculate, write in your notebook. You may think it is division, it become multiplication. So you write and then give me the answer. Fixed asset divided by capital is 5 by 4. Fixed asset is 40 lakh. Fixed asset by capital is 40 lakh. Write in your notebook. Tell me the fixed asset figure. You write and then do. Don't think in your mind and all. You will end up making mistake. How much is capital? 32 lakh. Fixed asset by capital 5 by 4. 40 by capital is 5 by 4. 40 into 4 divide by 5. Capital 32 lakh. Now use net profit to capital and tell me. Yeah, net profit by capital 1 by 5. Capital you said 32 lakh. Tell me the net profit number. 6 lakh. Any doubts on this? Any doubts on this? Clear? Can you proceed? And now I can say net profit by sales is equal to 20%. If you do into 100, you should not write 20%, you should write 20. Into 100 moment you do, it becomes number as 20. We present it as percentage. So let it be, whenever percentage is there and you do reverse working, don't write into 100 in the formula. Net profit by sales is 20%. Tell me the sales figure. 32 lakhs. Clear? It's a good question. One by one you have to do the calculation. Any doubts on this? Now this will come as part of a bigger question with 20 more ratios. Then this is where the difficulty comes, because here I know what ratios to focus on. We focused and got the answer. Following is the information relating to a company: reserves, share capital, net profit margin 10%. How much is the sales of the company? How will I calculate here? Yeah, tell me, how will you calculate using reserves? Not exactly. He's saying reserves is 10%, not exactly. Why are they giving 2-year data? Increase in reserve is the profit for the year. Increase in reserve is the profit for the year. Net profit is equal to 5 lakh. 5 lakh equal to 5 lakh by sales equal to 10%. Net profit margin 10%. 5 lakh divided by sales is equal, no major calculation, nothing to be done. If calculation is there, I'll tell you to do. 5 lakh divided by sales is equal to 10%. Sales is how much? 50 lakh increase in reserve, not the full reserve, not the full reserve. GP is 30% of sales, operating expenses 12% of sales. How much is the operating ratio? You need not do be in listen mode, okay? How much is the operating ratio? Let me write some number. Sales 100 is my assumption. 100 is my assumption. Less COGS, GP is 30. GP is 30, which means COGS is 70. COGS is 70. Nothing for you to write. If there is to be written, I would have told you. Less operating expenses. How much operating expenses? 12. Operating profit 18. Look at the formula for operating ratio. You look at the formula for operating ratio. What is the formula? COGS plus operating expenses by sales. 70 plus 12 by sales, 82%. 70 plus 12 by 100. 70 plus 12 by 100. Operating profit ratio, operating profit by sales, 18%. Operating profit by sales. Operating ratio is COGS plus operating expenses. COGS plus operating expenses. Clear? Any doubts in this? Okay. This is, you try this example. You try this example. It's almost similar only. You try this example first. Next example, you try it. You try it. Mostly you will struggle in doing it, but I want you to give it a try at least. If anybody got the answer, let me know. Anyway, I'll explain. Little trickier one. Okay, I'll now explain it. Whatever stage you are in, you can now listen. It's exactly similar to this example. Only thing is, I did not give closing reserves directly. I said no issue of shares, and closing reserve is what? 20% of net worth. What is net worth? Is share capital, reserves, and surplus. I don't know the net worth figure. Share capital is 1 lakh, and reserves is 20% of net worth. Reserves is 20% of net worth. If you bring it here, zero point 0.8 net worth is 1 lakh, and net worth is 1 lakh 25,000, which means reserves has increased from 20,000 to 25,000. Reserves has increased from 20,000 to 25,000, which is a 5,000 increase. Which is a 5,000 increase. 20 has become 25, which is a 5,000 increase. Answer is over. 5,000 increase. 5,000 divided by 10%, 50,000. right? It's exactly similar to that example. Only thing is data was not given directly. In a roundabout manner, I'm giving you the information. Any doubts on this? That's all. MCQ discussion is also over from this area. Any doubts on this part? Any doubts on this? Clear? Can we proceed? Any doubts on this? Next is coverage ratio, which is again discussed as part of that question. Coverage ratio, let's first understand what is coverage ratio is. Any expense I incur, there is always a source for meeting that expense. Any expense we incur in the practical world, there has to be a source for meeting the expense. For example, you want to calculate your expenses coverage ratio. Denominator will be your expenses. Numerator is the pocket money which you get from your parents. That's all. That is your source of income. The income is, or the inflow for you is only parents will give you, and that is your inflow. With that, you have to meet your expenses. What is the coverage available on the expenses? My expense coverage ratio, income from Bharadwaj Institute, plus I work in a firm called LKR Advisors, so there I get some income. I do some consulting work. All these are my income divided by my expenses. That is my in expense coverage ratio. This ratio should be as high as possible. If it is high, it means you are comfortably able to meet the expenses. And if it is low, then you will not be comfortable to meet the expense. First is interest coverage ratio. We wrote a P&L sometime back. Can you look at that P&L and tell me above interest what item is there in the P&L? The P&L which we write in your notebook. In your notebook, above interest what item was there? Sorry, operating profit. Interest is paid out of operating profit, which is otherwise called as EBIT. Operating profit is otherwise called as EBIT. Operating profit is otherwise called as EBIT. So interest coverage ratios, interest is paid out of EBIT. In that income statement, tell me what item is there above preference dividend in the income statement? Profit after tax. Preference dividend is paid out of profit after tax. What item is there above equity dividend in the income statement? EAES by equity dividend. The source is the numerator, and the denominator is that item. Somebody wants to know COGS expenses coverage ratio. COGS is paid out of sales. Sales by COGS is the formula. Sales by somebody wants to know what is the formula for operating expenses coverage ratio. Operating expenses paid out of gross profit. Gross profit divided by operating expenses. So we will not calculate all that, but we normally calculate these three: interest coverage ratio, preference dividend coverage ratio, equity dividend coverage ratio. Interest is paid out of EBIT. No need to remember the formula, okay? Preference dividend is paid out of PAT. Equity dividend is paid out of EAES. Any doubts till this? Any doubts till this? Now, what are these three? These three are nothing but we learned capital structure. No, capital structure as equity, debt, preference. How comfortably can I meet their expenses? Because they need something. No, nobody will give us free money. Equity guys want equity dividend. So what is the coverage ratio? Preference guy want preference dividend. What is the coverage ratio? Debt guy wants interest. What is the if the coverage ratio is low, low is less than 2 times is normally little tricky. If it is more than 3-4 times and all, very comfortable. My expenses is 1 lakh rupee. My income is 5 lakh rupee. No problem. My income is 1 lakh 50. Expense is 1 lakh. It is little worrying. Why? Because income 150, expense 1 lakh. Income goes down little bit, I can get into trouble. I can get into trouble. Whereas if my income is 5 lakh, expense 1 lakh, income goes down by 1 lakh also, I'm not worried. I'm not worried. I can meet my expenses. So we have three ratios. One is interest coverage ratio. Interest is paid out of EBIT. Preference dividend coverage ratio. Preference dividend is paid out of PAT. Equity dividend coverage ratio. Equity dividend is paid out of EAES. Apart from this, there are two more ratio. One is called DSCR. You may have to write the full forms at few places. This is called debt service coverage ratio. DSCR is debt service coverage ratio. Now, what is this debt service coverage ratio? Listen, interest coverage ratio focuses on only interest part. DSR says you have to pay interest as well as principal. You have to pay interest as well as principal. This is a practical world most commonly used ratio by the bank before giving a loan. Before giving a loan, most commonly used ratio is DSCR ratio, debt service coverage ratio, where the denominator is interest plus installment. What is numerator? Numerator is profit after tax, add back depreciation. Reason is it is a non-cash item, and add back interest. Why am I adding back interest? Because interest is there in the denominator. You are finding out what is available to pay interest and installment. In profit after tax, interest was subtracted by us. That is what accounting says, which is right. No problem with that. Formula says what is available to pay interest and installment, profit after tax, add back depreciation because it's a non-cash item, add back interest because that is what I'm going to use and pay the interest and installment. I'm going to use and pay the interest and installment. Clear? Able to understand? PAT, adding back depreciation, easy to understand. Why am I adding back interest? Very simple logic, because interest is what we are going to pay. A proxy for this is called fixed charges coverage ratio. I don't really agree to this formula. I see as very rarely tested in exam, but it is there in your institute study mat. Here, instead of using PAT, we use EBIT. We use EBIT. If you use EBIT, obviously you cannot add back interest, because in EBIT interest is not even subtracted. So EBIT plus depreciation divided by interest plus installment. What is the difference? The difference is here is after tax. This is before tax. Why after tax is good? Reason is installment payment is not a tax deductible item in your income tax. Interest payment is a tax deductible item. For interest, you can use EBIT, but for installment, EBIT is wrong, because EBIT cannot be fully used to pay installment. From the EBIT, you have to pay interest. You also have to pay income tax. You also have to pay income tax. Get PAT. You can use PAT to pay the principal. And after that money is available, pay preference guys and equity guys, or you may even not pay them. That is all depends on money availability or not. So 5 ratio, interest coverage ratio, self-explanatory. EBIT by interest. Preference dividend coverage ratio, self-explanatory. PAT by preference dividend. Equity dividend coverage ratio, again self-explanatory. EAES by equity dividend. Where is this coming from? I had already done this format. We had done this when we were doing question, and from this format only it is coming. From your PAT, you deduct preference dividend, you get EAES, you deduct equity dividend, you get retained earnings. Then DSR says I will consider PAT, add back depreciation, non-cash item, no problem, right thing to do, and add back interest also, and divide by interest plus installment. Fixed charges coverage ratio says no, let's not use PAT, let's use EBIT, add back depreciation. I have not seen practically any company using this. I have not seen any company using fixed charges coverage ratio. Your study material has, I didn't want to remove it. Until now, no question has come from fixed charges coverage ratio till now in any of the exam. But study material has a formula. I didn't want to leave it, so I've written it. EBIT plus depreciation divided by interest plus installment. Clear? Any doubts in this? Let's see some MCQ now. PAT is 10 lakh. Preference dividend is 2 lakh. Company paid equity dividend of 25% on equity capital of 10 lakh. How much is equity dividend coverage ratio? You need not write. You be in listen mode and tell me if something is to be written. I'll tell you. What is the formula for equity dividend coverage ratio? ED coverage ratio is EAES by equity dividend. What is EAES? Is profit minus preference dividend. Profit minus preference dividend. Profit is 10 lakh. Can you tell me how much is the preference dividend? 10% of 2 lakh, 20,000. How much is equity dividend? 25% of 10 lakh, 2 lakh 50. Calculate, that's all. This much is the equity dividend coverage ratio. 3.92 times. Kind of little comfortable only, not much to worry about. Any doubts on this? Is there a doubt here? Then PAT 8 lakh, depreciation 2 lakh, interest 3 lakh, principal 2 lakh. How much is debt service coverage ratio? Please write the formula and tell me the answer. PAT plus depreciation plus interest divided by interest plus installment. Write the formula, tell me the answer. PAT plus depreciation plus interest divided by interest plus installment. You write it. Nothing much to do, but it's a self explanatory. Still write it. DSR PAT plus depreciation plus interest divided by interest plus installment. Interest plus installment. 2.6 times 8 lakh plus 2 lakh plus 3 lakh divided by 3 plus 2. 3 plus 2. 2.6 times. Any doubts on this? Any doubts on the category? Very simple, straightforward category this is. I still give you a minute. Go through this and then we do the question. 1 minute for you. Let's come to question 3. Here we will have multiple category of ratios discussion, including profitability, and some other category will also happen. First, let's discuss the profitability part. ABC Limited, your question 2, you should have marked easy, moderate, difficult. I'll not keep telling you, you should have marked easy, moderate, difficult. I'll remind you sometimes, but you should have done the marking easy, moderate, difficult. Question 3, ABC Limited has the following P&L for the year ended 31st March 2015 and the balance sheet as on that date. P&L for the year ended March 31, 2015. Particulars: amount, opening stock, add manufacturing cost, less closing stock, COGS, gross profit, admin expense, selling expense, depreciation, interest, income tax, net profit. Then a balance sheet is given, which will not be useful for the ratio we are going to do now. It will be used later. Equity shares, preference share, reserves and surplus, long-term loan, debenture, creditor, bills payable, accrued expense, provision for tax. Other side, plant and machinery, depreciation, net plant and machinery, goodwill, stock, debtors, prepaid expense, marketable security. Company has declared a dividend of 10% on preference share capital, 20% on equity capital. Company has repaid loans of 0.50 lakhs in the last year. They have asked us to calculate these ratio: GP margin, NP margin, pre-tax profit, operating profit, COGS ratio, operating expense ratio, operating ratio, financial expense, and the other categories related to the next category of ratio. Totally 8 categories are there. 2 category. First category 1 question, second category 1 question. Third, fourth and fifth category only 1 problem. Third, fourth and fifth, all 3 categories only 1 question is there, which is what we are going to discuss now. Please go through the question. I give you a minute or two. Go through the question. Okay, let's start doing it. They've asked for those 8 ratios we have discussed, but we'll convert the P&L in the format which we did for the MCQ, starting from sales, less UGS. We'll write it in that format and then start doing it. I can do even without that P&L also, but I'll feel comfortable to do it in that way. Let's start. Question number 3. Working note 1, income statement. Income statement, particulars and amount. Income statement, particulars and amount. Starting with sales. The problem is in lakhs, so amount in lakhs. Tell me the sales number. How much? 15. Cash, credit, all put together. Sales. Sales is 15. Sales is 15. Less cost of goods sold. Gross profit. Gross profit is available in the question. How much? for COGS is balancing figure. COGS is balancing figure, which is 11. Can I calculate COGS? Yes, it is opening stock, manufacturing cost, less, okay, COGS is also given, but this is how it will be calculated. Opening stock, manufacturing cost, purchase all cost, minus the closing stock, minus the closing stock. They have given the COGS also in the question. We got GP less operating expenses. In bracket 0.35 of admin, 0.25 of selling, and depreciation will also come, assuming it is related to operation. Ideally it will be related to operation only. It will be related to operations, so it's a non-cash item and all, but it should be related to operations of the company. How much? 1.01. We get operating profit. Operating profit 2.99. Add non-operating income. I don't think so anything is there. Any interest income, dividend income, anything there? 0. Less non-operating expenses. Normally only one item, interest. If somebody says depreciation is not related to operation, which is very rare, then it can come here, but otherwise only one item. What's the depreciation figure? Sorry, interest figure. 0.7. You get profit before tax 2.52. Profit before tax 2.52. Any doubts on this? Less income tax. Less income tax 1.26. Profit after tax, which is given in the question, 1.26 in the P&L. Why we are redrafting it? Becomes easier for us to do all the calculation. Okay, profit after tax 1.26. After this the income statement is over. I'll be doing other ratios later, so I need some more data also. Less preference dividend. From the profit, I'll have to pay preference dividend first. I'll have to pay preference dividend. Preference dividend is 10% on 2 lakh. Preference dividend is 10% on 2 lakh. Less preference dividend 10% into 2. 10% into 2 into 2, 0.20. Earnings available to equity shareholders. It's called EAES. Earnings, whatever profit we generated, it is not available to equity, guys. It is not available to equity, guys. From the 1.26, 20,000 will have to first go for preference dividend. Balance is called earnings available to equity shareholder, which is how much? 1.06. Earnings available to equity shareholder 1.06. Any doubts on this? Then less equity dividend. Some data is given on equity dividend. How much the equity dividend paid? 20% on equity capital. How much is equity capital? 3.5 into 20%. 0.70. Retained earnings. What is retained earnings? Is this much will be added to reserves and surplus. Retained earnings. Retained earnings is 0.36. Retained earnings is 0.36. Any doubts in this? Clear? Can you proceed? Any doubts on this? Done? Can we? Okay. Now, I am not doing it. You are going to do. I keep this in front of you in the screen. Please keep doing every formula. Keep writing the answer. You write the formula, write the answer. Everything is there in your notebook. I don't want to spend time on these 8 ratio. You complete this, then we will discuss the balance parts. Some 4-5 minutes for you. They have asked for all this ratio. COGS is 11 by 15. 11 by 15 into 100 into 100, which is 73.33%. 4 by 15 into 100, 26.67%. Operating expenses is 1.01 by 15. 1.01. How much? 6.73%. Operating profit 2.99 by 15. 2.9. How much? 19.93. PBT is 2.52 by 15. 2.52 by 15. 16.8. Net profit 1.26 by 15. 8.4. Financial expense was 0.47 by 15, which is 3.13%. COGS 11 plus 1.01 by 15. 11 plus 1.01, it will be, sorry, 80.07 or 06, whatever, 80.07%. Any doubts on this category of ratio? Fairly simple, straightforward category. Any doubts on any of these ratios? Any doubts on any of these ratios? Can we proceed? We are yet to complete the entire question. I will be doing this after discussing the next category. Come back again to the problem. Next category, come back again to the problem. Clear? Any doubts on this category of ratios? Okay, coming back to the same question. Let's do those 5 ratios here. Let's do the ratio. Interest coverage ratio is equal to, interest coverage ratio is equal to EBIT by interest. EBIT by interest. EBIT is nothing but operating profit. How much is the EBIT? 2.99. Interest is 0.47. Two decimal answer. 6.36 time, which means we are comfortable in meeting the interest. We are comfortably placed to service the interest. 6.36 times. 6 times of interest is my income. So even if income goes down little bit, I will not, in fact, it even goes down by 50% also, I will not have a problem. Any doubts on this? Next, preference dividend coverage ratio. Preference dividend coverage ratio. Packed by preference dividend. The numbers are there in your income statement only. Packed by preference dividend. 1.26 divided by 0.2. 6.3 times. Packed by preference dividend 6.30 times. Then equity dividend coverage ratio. Equity dividend coverage ratio. Equity dividend coverage ratio. EAES divided by equity dividend. EAES by equity dividend. Divided by equity dividend. How much the EAS? 1.06. 0.70. This will be little uncomfortable kind of a ratio. We are not very safe here. 1.51 times. 1.51 times. Any doubts on this? Debt service coverage ratio. Whatever ratio we learned, we are just applying it here. That's all. Debt service coverage ratio. Debt service coverage ratio. PAT plus depreciation plus interest. PAT plus depreciation plus interest divided by interest plus installment. PAT plus depreciation plus interest divided by interest plus installment. Interest plus installment. How much is the PAT? Depreciation 0.41, interest 0.47, interest 0.47. How much the principal we have repaid? 0.5. 2.21 times. Debt service coverage ratio 2.21 times. This is an important ratio used in the practical world. Not that much tested in exam, but yeah, practically this is used a lot. Any doubts on this? Can you proceed? Fixed charges coverage ratio. Fixed charges coverage ratio. Fixed charges coverage ratio is equal to EBIT plus depreciation, interest plus installment. EBIT is 2 point, how much it was? Sorry, 2.99 plus 0.41 divided by 0.47 plus 0.50. This will obviously be better than debt service coverage because here tax is not subtracted. 3.51 times. 3.51 times. Any doubts in this? Clear? Can you proceed? Any doubts in this? We are yet to complete one more category of ratio in this question. We do the explanation and then do that. Then only this question will get over. Any doubts in this? Clear? Can we proceed? Let's move to the next category, which is profitability related to return on asset or investments. What is return on asset or investment is, as a businessman, when I give money to a business, I want the business to earn returns for me. Now, this is technically called as what is earned divided by what is invested. When I create a fixed deposit, it earns me 10,000 rupees and I invested 1 lakh rupee, 10% is my return. 10% is my return. It gave me a profit of 10,000 on 1 lakh. I invested in stock market. It gave me a profit of 50,000 on an investment of 2 lakh rupees. 50,000 by 2 lakh is the return I generated. If somebody says I made a profit of 50,000 on stock market, now I don't know whether it is a good profit or not so good profit without knowing how much was the capital used. If you earn 50,000 by using 50 lakh rupees, it's only 1%, nothing much. So that is why percentages make difference, or the return calculation by comparing two items. So here we have first ROA, return on asset. Asset is basically total assets of the business. Whatever assets we are using, it is used in the business and it generates profits for the business. ROA can be pre-tax or post-tax. Pre-tax means PBT by asset, post-tax means PAT by asset. PBT or PAT divided by assets. So if the question asks return on asset and they don't mention anything, we'll do two things: pre-tax ROA, post-tax ROA. ROE is return on equity. Return on equity. Any place you want explanation more, please write it. Short forms are used at all the places. Return on equity return on asset. What is return on equity? Let's understand this. An equity guys contribute their capital, reserves and surplus, all is belonging to them. That is my denominator. What is earned divided by what is invested. ROA, PBT is earned, investment is asset. PAT is earned, investment is asset. ROE, equity guys get EAES, earnings available to equity shareholder. That is what they get, divided by equity, divided by equity. Preference and all is not considered in this ROE formula. If you want to add preference in the denominator, you can. Then it will be PAT, not EAES. Why PAT? Because PAT now belongs to preference and equity. Logic is very simple. What is formula? What I get back divided by what I give. What I get back. Equity guys give equity, capital, reserves and surplus, and they get back EAES. You want to add preference in the denominator, add it. Then in the numerator you will have to add preference dividend also. In the numerator you will have to add preference dividend also, which is nothing but technically your profit after tax. There can be a variant. There can be a variant called as return on proprietor funds. What is return on proprietor fund? Is profit after tax divided by proprietor funds, which should be same as ROE, but there can be an exception also. If there is a preference, you can add preference in the denominator and you can add the reward to the preference in the numerator. Reward. Then ROI or ROC, return on investment. Investment is not asset side investment, okay? Return on investment or return on capital employed. What is capital employed? We have already seen. So what is capital employed is debt, equity and preference. What do debt guys get? What do we pay to the debt guys? Interest. Equity guys, equity dividend. Preference guys, preference dividend. So the bigger part is you are starting with EBIT. From EBIT you pay interest, then you pay tax, then you pay preference dividend, then you pay equity dividend. So the bigger part is EBIT. So ROI or ROC formula says you should use EBIT by capital employed or EBIT into 1 minus tax rate by capital employed. Pre-tax, post-tax. Pre-tax and post-tax. Why EBIT? Because EBIT belongs to equity, debt and preference. That entire amount belongs to only 1% can come in between, which is the government, which is tax. That is why we have two formula. EBIT by capital employed. Ideal formula is EBIT into 1 minus tax rate divided by capital employed. EBIT into 1 minus tax rate divided by capital employed. Clear? Able to understand this? So here what we are saying is what is earned divided by what is invested. What is earned divided by what is invested. What is earned can be EBIT, can be EBT, can be EAT, can be EAES. Different formula. EBIT is used in ROI and ROCE. EBT is used in ROA pre-tax. ROA pre-tax. EAT is used in ROA post-tax. EAES is used in ROE. And EBIT into 1 minus tax is used in ROI. Again, EBIT in 1 minus tax. ROI or ROC denominator is CE. ROE denominator is E. ROA denominator is A. Denominator is A. So very simple. Return on asset, denominator is asset. Return on equity, denominator is equity. Return on investment, denominator is investment. Return on capital employed. Investment is not asset side investment. Okay, be very clear. Investment basically means capital employed. What is used in the business? What is used in the business? ROI or ROCE, ROE, ROA. Three formulae we use. Can I have any other formula? Your wish. You can do anything. There was one exam where they asked return on proprietor funds, and they said proprietor funds includes equity and preference. So denominator was equity plus preference, and numerator was PAT. Numerator was PAT because PAT belongs to equity and preference, guys. Equity and preference, guys. Any doubts on this? Any doubts on the concept here? Let's see some example. Gross profit 25,000 in bracket 10%. Total asset 50,000. Net profit margin 2%. What is return on asset? I'll tell you to do certain things. You keep doing it. Use this and tell me the sales figure. Gross profit 25,000 in bracket 10%. 10% means 10% of sales. Tell me the sales figure. Write in your notebook. Tell me the sales figure. GP margin is 10%. 2 lakh 50,000. GP is 10% of sales. 10% is basically on sales. Anywhere they give percentage, it is on the sales only. How much the sales you said? If sales is 2 lakh 50, use net profit margin and tell me net profit. Net profit is 5,000. Return on asset is net profit by asset. Net profit by total asset. Return on asset is net profit divided by total asset. No pre-tax, post-tax and all. There's no tax rate data and all. Net profit by total asset, which is 5,000 by 50,000. How much? 10%. Can you proceed? This you will write along with me. I'll discuss it and then we write. EBT is 10 lakh. Company has 12% debt of 50 lakh. It also has equity capital of 25 lakh. Reserves of 15 lakh. What is the return on capital employed? Is there a tax data in the question first of all? No. Then I can use only one formula. Tax is there. I can use two formula. EBIT by capital employed. EBIT into 1 minus tax rate by capital employed. Now write ROC is equal to, right. ROC is equal to EBIT by capital employed. EBIT by capital employed. EBIT by capital employed. EBIT by capital employed. What is the EBT given in the question? They have given EBT. EBT is 10 lakh, add interest on top of this. 10 lakh plus add interest. 50 lakh into 12%. 50 lakh into 12%, 6 lakh. Capital employs debt plus equity plus preference. Debt plus equity plus preference. 50 lakh plus 25 lakh plus 15 lakh. Tell me the ROC number. How much? 17.78%. 16 lakh divided by 16 lakh divided by 90 lakh. 16 by 90. Sixteen by 90. 17.78%. Any doubts on this? Any doubts on this? We have discussed three category of ratio. Now listen, one important another point. PBT is a P&L item, balance sheet item. P&L asset. If at all available, you'll have to take denominator average. If at all available, denominator will be average. Till now, I did not discuss another category because either it was two balance sheet item or two P&L item. In this ratio, if available, you will have to only keep in mind if available, you will have to use average. I have not written average and all. So sometimes I say EBIT by capital employed. Sometimes I'll say EBIT by average capital employed. Average capital employed. Average means opening you have to calculate, closing you have to calculate, and then take the average. Clear? Any doubts on this? We'll now go back to that question and then close it. Okay, they've asked for ROCE, return on equity, and return on asset. All the three have been asked in the question. Let's start doing it. Pre-tax ROCE, pre-tax ROCE, EBIT by capital employed, EBIT by capital employed, EBIT by capital employed, pre-tax ROCE, pre-tax ROCE. What is the EBIT number? 2.99. capital employed is starting from equity, preference, reserves, long-term loan, debentures. Listen, goodwill, sometimes ICA knocks off, sometimes they don't knock off. Depends whether it is a real value or it is a fictitious asset recorded in books of accounts. Because sometimes when you buy a business, you will record goodwill in your books of accounts. It could be really giving some benefit, may not be giving benefit. I don't know what is there in the solution, because if I've written, no, I've not written the assumption here. Assumption is not written, so I don't know what is there in the answer. They may have removed it, they may not have removed it also. I'm not removing it, I'm assuming goodwill has some real worth. Okay, so denominator is 3.5 plus 2 plus 2 plus 1 plus 2.5, that's all, into 100. Denominator is 11, I think. 2.99 by 11 into 100. 27.18%. Again, I'm repeating, the denominator, you can remove goodwill if you want, if you assume it is fictitious in nature. That's an assumption based area. If you treat it as fictitious in nature, it has to be removed from the denominator. Any doubts on pre-tax ROCE? Clear? Then post-tax ROCE. EBIT into 1 minus tax rate divided by capital employed. What is the tax rate? They have not given in the question, but I can calculate. PBT was 2.52, tax is 1.26, half of PBT. Tax is half of the PBT. 1.26 on 2.52. 2.52 was there in your notebook. 1.26 on 2.52, half of the PBT, half of the PBT. So into 1 minus 0.5. 1 minus 0.5 divided by 11. The return will obviously become half of what we saw earlier. Pre-tax we are earning some 27%, but after income tax earning is only 13.5%. Pre-tax ROC, post-tax ROC. Clear? ROE, EAES divided by equity funds. EAES divided by equity funds. EAES is 1.26. Equity is, sorry, 1.06 divided by equity is 3.5 plus reserves is 2. That's all, nothing else we can do here. Into 100. 19 point. Clear? This is not asked in the question, but return on equity and preference, in bracket proprietor investment, assuming it is brought in by the same person. Proprietor investment, equity and preference, I want to consider both. Debt also you want to consider, then that is capital employed. Debt also you want to consider, that is return on capital employed. Only equity and preference I want to consider, that's called proprietor investment. Proprietor investment. PAT divided by equity plus preference. PAT divided by equity plus preference. Equity plus preference. What is the PAT figure? Denominator 3.5 plus 2 plus how much the preference capital? Yeah, 16.8%. There are different ways of calculating the return. You can calculate in multiple ways. 16.8%. We have assumed goodwill to be non-fictitious in nature. It is a real asset, is what we have considered. Any doubts on this? Pre-tax ROA. Pre-tax ROA, EBT by assets. EBT divided by assets into 100. Pre-tax ROA, earnings before tax divided by assets into 100. What is earnings before tax? 2.52. Any doubts? Is there a doubt? Is there a confusion? 2.52. What is assets total? 12.65. 19.92%. Post-tax ROA. Post-tax ROA, 9.96%. So there is an ROCE, there's an ROE, and there's an ROA. ROC denominator capital employed, EBIT is the numerator, ROE denominator is equity, and EAE is the numerator. ROA assets, denominator is very clear, the name indicates, and numerator for ROA is profit after tax or before tax, that is EBIT or EBIT into 1 minus tax rate, and EAES. Any doubts on this? Any doubts on this? So with this, this category of ratio gets over. In the solution, we have followed, we have not removed the goodwill part. I can remove goodwill also. I can remove goodwill also from the assets and from the equity, assuming it is fictitious in nature. Any doubts on this? Any doubts on this? Okay, let's take a break now. We'll resume at 10:15. Okay, we'll now go to the next category of ratio. We are done with 5 categories. Today, I hope to complete all the 8 categories, and next class onwards, we do detailed question on that. Next category is owner's point of view. We do not have a specific question on this, but we'll discuss first profitability ratio from owner. Owner basically means equity shareholder. When we did earlier, I had a format of profit statement which started with PAT. From PAT we deduct preference dividend. We used to call it as EAES. This is the earnings available to equity shareholder. If you divide this by number of equity share, you get earnings per share. If you divide this by number of equity share, you will learn this in accounting also. There is an accounting standard on this. EAES divided by number of equity share. Like there is an earnings per share, there is also a dividend per share. What is dividend per share? Is total dividend divided by number of share. And an item which links them together is called payout ratio. An item which links. Now, for example, this question which we were doing, this was the earnings available to equity shareholder 1.06, and we paid a dividend of 0.7. Assuming there were 10 shares, some number, I'm just taking a random number. 1.06 divided by 10 is called as EPS, and 0.70 by 10 is called DPS, dividend. Dividend as a percentage of earning, dividend as a percentage of earning is called payout ratio. What is payout? How much of the profits we have paid to the equity shareholder. It's not mandatory for me to pay the entire profits to the equity guys. So how much of the profit is paid to the equity shareholder is called payout ratio. Dividend as a percentage of earnings per share. Dividend as a percentage of earnings per share, and retention ratio is 100% minus payout ratio. Retention ratio is 100% minus payout ratio. So earnings per share EAES by number of equity share, dividend per share equity dividend by number of equity share, payout ratio dividend as a proportion of earnings, and the balance is called retention. The balance is called retention. What is retention? Is how much money we have retained in the business and how much money we have paid out as dividend. How much money we have paid out. For example, in this question, 0.70 of 1.06 is payout ratio and 0.36 of 1.06 is the retention. You can do at a per share level, you can do at a overall level, percentages will remain same. Earnings per share, total earnings divided by number of share. Dividend per share, total dividend divided by number of share. Dividend as a percentage of earnings, and 100% minus payout ratio is called retention ratio. Any doubts on this? This is the next category. I don't have any MCQ also to be discussed in this category. Next is profitably related to market. Market means stock market. Related to stock market. This comes into picture if you are a listed company. Listed is where trading and all happens in the market. We have few points here. First ratio is called PE multiple. What is PE multiple? Is name. P means price by earning multiple. Price by earning. P multiple means price by earning multiple. So price is the numerator, market price per share. Earning is the denominator, earnings per share. Market price divided by earnings price is called as P multiple. Is called PE multiple. What is P multiple? Is price by earning. Dividend yield, earning yield. Dividend yield and earning yield. I go back here. Yield means basically this. Profitability ratio related to what is earned divided by what is invested. What is earned. Yield means return. Return has a simple formula. What I get back divided what I give. What I give. When we did ROA, I give asset. When I did ROE, I give equity shareholders fund. When I did ROC, I give capital employed. Similarly, dividend yield means I get dividend, but I pay the market price. I pay the market. Dividend yield means I get the dividend on market price. Earning yield means I get the earnings on the market price. What I pay is denominator. What I get back divided by what I pay. What I get back divided by what I pay. MPS by EPS is called price earning multiple. Dividend yield DPS by MPS. Earning yield EPS by MPS. Next, MV to BV, as the name indicates, MV divided by BV. MV divided by BV, as the name indicates, market value to book value. Market value to book value. MV to BV is MV divided by BV. What does BV is? Equity. We calculated equity, sometime back. What was equity? Was equity capital, reserves and surplus minus fictitious asset divided by number of share. These are calculated at a per share level. All the calculations here are done at a per share level. Every item. If you see price earning multiple, price by earnings per share. Dividend yield, dividend per share by price per share. Earning yield, earnings per share divided by price per share. MV to BV, MV per share, BV per share. And last ratio I have not seen anywhere getting used in practical world. Not seen in any question by ICI, but it is there as part of your material. I don't even know the logic of the ratio, so that's why I'm not attempt to even explain this much. There is a ratio called Q ratio which they have given, where the formula is liability by asset. Liability by asset, but liability is not your book values, because if you take book value, then it is one time liability equal to asset. They are saying market value of equity and liability divided by replacement cost of asset. What is replacement cost? Is if you were to buy an asset today, what is the cost of that asset? Replacement cost of asset, not very critical, but because they are in the material, I could not remove it. So 5 ratios here. First is price earning multiple, price by earning. Price by earning. Second, earning yield is inverse of this, earning by price. Earning yield, you can look at P multiple and earning yield together. P multiple price by earning, earning yield inverse. EPS by MPS into 100 to express in percentage. Dividend yield, dividend by MPS into 100. MV to BV, MVPS divided by BVPS. And Q ratios, market value of equity and liability divided by replacement cost of asset, and BVPS has a formula which is equity, add the fictitious, so add the reserves and surplus, remove the fictitious asset divided by number of share. Any doubts on this? Let's see some question here. This is a good problem. From the following information, calculate the P ratio: equity capital, preference capital, profit after 35% tax, depreciation, market price of equity share. They have given four answers: 15, 16, 17, and 18. They wanted P multiple. P multiple has a formula called price by earning. Price by earning. Now write earnings per share. Right. Earnings per share is equal to PAT minus preference dividend divided by number of shares. PAT minus preference dividend divided by number of shares. PAT minus preference dividend divided by number of shares. How much is the PAT? 2,67,000. Depreciation has no utility. I'm not sure why they gave it also. 267. How much is the preference dividend? Sorry? 27,000. Number of shares is 80,000. 8 lakh divided by 10. 8 lakh divided by 10. 80,000. 267 minus 27 by 80,000. How much is the EPS? Then write P ratio is equal to price by earnings. PE ratio. PE ratio. P by E. Price is 48. Earnings is 3. Price is 48. Earnings is 3. PE multiple. Price by earning multiple. Price by earning multiple. Any doubts on this? Okay. Let's look at this. PAT 3,50,000. 10% preference share capital, number of equity share, market price of equity share. How much is the earning yield? Earning yield is technically the inverse formula of P ratio. Earnings yield is EPS by MPS. Can you calculate EPS and tell me how much? Earning per share, calculate and tell me. Earning per share is how much? Earnings per share. 3,50,000 minus 1 lakh divided by 25,000. 10 is the earning per share. Earning yield is 10 by 50 into 100. 10 by 50 into 100, 20%. Clear? Any doubts on this? So with this two categories done. I don't have a separate question to be discussed on this two category. Any doubts on the two categories here? Any doubts on the two categories? I go to the last category of ratio where we have a lot of questions to be discussed. Turnover ratio. Turnover ratio means, turnover means how many times are we rotating an asset. Now what does this rotating an asset means? Listen, to earn sales I have to do faster rotation of debtors. What is rotation of debtors is, I give credit, he pays me money, again I give credit, he pays me money. To rotate the inventory, if I rotate the inventory faster, COGS will keep going up. So what does turnover ratio is? It measures how effectively are we using the resources? If a shop has 20 times rotation in a year versus another shop has 40 times rotation in a year, the sales for 40 times rotation will be more. So here the formula is sales divided by whatever the item. What can be the relevant item? It can be total asset. So the formula is called total asset turnover ratio, sales by total asset. Total asset turnover ratios, sales by total asset. It can be fixed assets, which is called fixed asset turnover ratio, sales, how much time, fixed asset is the denominator, how many times did we rotate, fixed asset 10 lakh, sales 40 lakh, 4 times rotation, 4 times rotation. It can be current assets, sales by current assets. It can be working capital, sales by working capital, which is called working capital turnover ratio. It can be capital employed, which is called capital turnover ratio or capital employed turnover ratio. So 5 ratios are there here. First ratio is fixed asset turnover ratio, sales by fixed asset, current asset turnover ratio, sales by current asset, working capital turnover ratio, sales by working capital, capital employed turnover ratio, sales by capital employed, total asset turnover ratio, sales by total asset. Then there are another 3 ratio which are not based on sales but same logic only, but they are not based on sales. First is debtors, where you should use credit sales and not total sales. You should use credit sales because cash sales does not lead to debtor. So we use credit sales divided by debtor. Credit sales divided by debtor. Question doesn't have breakup, sales by debtor. Question doesn't have breakup, do sales by debtor. Creditors turnover ratio, again logical. Here we are going to use purchases and not sales. We are going to use purchases and obviously credit purchases. And inventory we use COGS. Inventory we use COGS. In all these ratio, the numerator is P&L item. The denominator is balance sheet item. This is one category where most of the times they'll give the 2-period data. We will be using average. We'll be using average in this category of ratio most of the times. Most of the times there could be information to do it. Information not there, it's okay. Debtors turnover ratio. The most important these 3: debtors, creditors, and inventory. Denominator will be average debtor, average creditor, average stock. Most of the times. Most of the time. Clear? Any doubts till this? Okay. I calculated debtor turnover ratio. I got an answer 10 times. 10 times. Which means 10 time rotation 365 days. 10 times rotation 365 days. One time rotation in how many days is called debtor days. That is technically called debtor days. What is debtor days? 365 divided by debtors turnover ratio. 365 divided by debtors turnover ratio. 365 divided by debtors turnover ratio. Or you can do another formula also, which I'll explain later. 365. Like debtor days is there, you can calculate creditor days. What is creditor days? 365 by creditors turnover ratio. Inventory days, 365 by inventory days. Fixed asset days, 365 divided by fixed asset turnover ratio. Like that you can calculate anything. Clear? So here logic is very simple. Sales divided by the relevant item. The relevant item can be any of the 5 items. It can be total asset turnover ratio, fixed asset turnover ratio, working capital turnover ratio, current asset turnover ratio, capital employed turnover ratio. Can there be anything else beyond this? Yes, there can be anything else also, but predominantly these 5. Predominantly these 5. Debtors turnover ratio only changes, use credit sales. Use credit sales. Creditors turnover ratio, use credit purchases. And inventory turnover ratio, use COGS. Inventory turnover ratio, use COGS. Once you have got it in times, you can convert into days. You can convert into days. How can you do? 365 divided by this, or you can inverse this formula. You can inverse the formula and multiply with 365. Both are technically same. You can inverse the formula because it comes in the denominator. Denominator means you have to inverse the formula, multiply with 365. Multiply with 365. Question asks, do it in months. Multiply with 12. Multiply with 12. Question says weeks. Multiply with 52. That is another option. So leave the 365 as it is and 1 by debtor turnover ratio into 365. 1 by debtor turnover ratio is inverse of debtor turnover ratio. Inverse formula. Inverse formula. What is debtor turnover ratio formula? Credit sales by debtor. What is the formula come here? Debtor by credit sales into 365, obvious average. Average has to be done for data. If at all data is there. Clear? Any doubts in this? So these are the various category of ratio. Let's see some question. A company has a average accounts receivable of 10 lakh, annual credit sales 60 lakh, average collection period would be, one is calculate debtors turnover ratio, then do 365 by this, or inverse the formula and do into 365, because they have asked average collection period, answer is in days. Collection period, answer is in days. I'll have to convert this into days. Now write debtor turnover ratio, right. Debtor turnover ratio is equal to, debtor turnover ratio is equal to, what's the formula I gave for debtor turnover ratio? Credit sales by average receivables or debtors. Credit sales by average receivables. Credit sales is 60 lakh. Average receivable is 10 lakh. Six times. Collection period means collection from debtor. That is why it's called debtor days. Average collection period 6 times. Any doubts on this? Average collection period is equal to 365 divided by 6. 60 point. Now sometimes doing this can lead to rounding off. That is why I normally don't prefer doing this calculation in case they ask days. You directly inverse the formula. What is inverse? 10 lakh by 60 lakh into 365. Sometimes rounding off impact can be there. Inverse the formula 10 by 60 and multiply with obviously 365. Any doubts on this? Both ways you can do. This question doesn't make any difference. Rounding off challenge is not there. Any doubts on the first example? Total sales 100 lakh, GP margin 40%, average stock 20 lakh. What is stock turnover ratio? What is the formula I said for stock turnover ratio? COGS by average stock. Now, right, stock turnover ratio is equal to, stock turnover ratio is equal to COGS by average stock. COGS by average stock. Sales is 100 lakh, GP margin is 40%, which means COGS is 60%, balance is COGS. GP is 40%, balance is cost of goods sold. So 100 into 60%. 100 into 60%. How much is stock value? 20. So 3 times. Very simple example just to get used to these workings. Any doubts in this? Equity capital 50 lakh, reserves 40 lakh, fictitious asset 10 lakh, debt 10 lakh, turnover 200 lakh. What is capital turnover ratio? Capital turnover ratio is sales by capital employed. You please do it. You know the capital employed calculation. Sales by capital employed. I've already taught you how to calculate capital employed. Numbers are there, you calculate. Sales by capital employed. Sales divided by capital employed. Sales is how much? Turnover is 200, that is sales. Capital employed is 50 plus 40 minus 20 plus 10. These are just kind of easier ones, but as we proceed, you'll understand. Gross profit 54,000, GP margin 20%, credit sales is 4 times of cash sales, debt collection period 1 month. Debt collection period is given in months. How much is debtor? How much is debtor? That is the requirement of the question. First, use this to information and tell me total sales. Calculate total sales. Yeah. Total sales. GP 54,000. GP margin 20%. 54,000 and 20%. Clear? Any doubts on this? 2 lakh 70,000. Okay. Credit sales is 4 times of cash sales. Now, total sales break into two: credit, cash. Credit, cash. Question said credit sales is what? 4 times of cash sale. So, credit is 4, cash is 1. Sometimes they'll say credit sale is 20% of total sale. From the total sale, directly take 20%. Credit sale 4 times of this, whatever way they give, we'll have to interpret. So credit sales is how much? I'm not bothered about the cash sales. We can calculate, but not bother about cash sales for debtors turnover ratio. Any doubts? 216. Now, debtor days is equal to inverse of the debtor turnover ratio. Inverse of the debtor turnover ratio, which is debtor by sales into 12 in this question, because they have given in months. Okay, into 12 I am doing debtor by sales into 12 months. Inverse of the debtor turnover ratio. Debtor turnover ratio, sales by debtor. Inverse of that, debtor by sales. Inverse of that, debtors by sale into 12 months. Into 12 months. Clear? How much is the debtor days given in the question? 1 month is equal to, this is credit sales. Okay, credit sale. Debtor by 2,16,000 into 12. Tell me the debtor figure. 18,000. Clear? Debtors is 18,000. Any doubts on this? I can also say this, you will understand as we proceed. Debtors is very simple. 1 month of credit sales. Credit sales 216 into 1 by 12. Direct answer I would have given, but it will be difficult for you to understand initially. Debtors is nothing but 1 month of credit sale. So credit sales into 1 by 12. Direct answer. I had to do it in a longer route because being the first initial set of question. Gross profit 1 lakh. Closing stock is 10,000 higher than opening stock. How much is the closing inventory if the stock turnover ratio is 4 times? Stock turnover ratio is 4 times. Let's do it and then we'll see to the answer. We'll see. They wanted us to calculate closing stock. What is the formula for stock turnover ratio? COGS by average stock. COGS by average stock, or equal to, can you tell me what is the sales? Gross profit 1 lakh and 25%. 4 lakhs. Clear? I'm not writing it again. But initial and all I was used to explain. Now you should have understood this. COGS is 4 lakh minus 1 lakh. 4 lakh minus 1 lakh, and denominator is average stock. Denominator is average stock. Opening plus closing by 2 is 75,000. We'll have to form some two equation. Opening plus closing by 2 is 75,000. This will give me opening plus closing is equal to 1 lakh 50,000. There's another point given in the question. It says closing stock is 10,000 higher than opening stock. So tell me, closing minus opening is 10,000 or opening minus closing is 10,000. What does that line mean? Closing stock is 10,000 higher than opening stock. Tell me, closing minus opening 10,000 Our opening minus closing is 10,000. Closing stock minus opening stock is 10,000. Closing minus opening 10,000. I add these two. Opening stock got cancelled. Two closing stock is 160. Two closing stock is 160. Opening got cancelled. Opening got cancelled. Again, very good questions. These are just to test your concept clarity. Again and again, I repeat that MCQs are the best way to learn the concept clarity. Ideally, doing descriptive doesn't serve any purpose, but yeah, I have to do it as part of bigger question. But this is what is sufficient. How much the closing stock? 80,000. Okay. Opening creditors 10 times, opening creditors 10 lakh, closing creditor 30 lakh, cash paid to creditor 100. How much is creditor turnover ratio? Now write creditor turnover ratio. Tell me the formula for creditor turnover ratio. Credit purchases by average creditor. Credit purchases by average creditor. Clear? I will come to credit purchases in a minute. Average creditor is 10 plus 30 by 2. 20 lakhs. Any doubts on this? Okay, now listen. Write this. Closing creditor equal to opening creditor. Closing creditor equal to opening creditor plus purchase minus payment. Tell me the purchase balancing figure. Closing creditor is equal to opening creditor plus credit purchases minus the payment made. Minus the payment made. Calculate the credit purchases figure. Calculate credit purchases figure. Closing creditor is equal to opening creditor plus credit purchases minus the payment made. Where did we learn? All this you have learned in accounting, but again logical. I have an opening creditor of 10 lakh. I purchased extra, made payment of 100 and closing is 30. Closing is 30. 126 times. 6 times. Clear? Okay, give me answer to this. We did a similar example. We have already done a similar example. Figures were also almost similar. Give me answer to this. GP 54,000, that example. Ignore the choices given. Okay, there is some error in the question. Ignore the choices given. I don't know what is the error. I don't know, but the answer will not be there in the MCQ options. Some error is there in the question. Not very sure what is the error. While drafting, I could have made an error. The answer to this is not there in the choices there. What's the answer you have got? If anybody has done 2,700, I'll explain it. Gross profit is given, GP ratio is given, sales is how much? 2 lakh. With 2,70,000, credit sales is, which is 54,000. I feel maybe this should have been cash sales is 20%. That could be the mistake from my side. 54,000. On that 54,000 into 18 by 360 is the debtor. 18 days, 18 by 360 is the debtor. I'm not sure. Yeah, credit, it should have been cash sales are 20% of total sales. That should have been the question. There is a mistake in that question. You can just change it as later on. Cash sales are 20% of total sales. Cash sales are 20% of total sales. Okay. Next example is a good one. I'll explain that. Fixed asset turnover ratio 3 times. Fixed asset equal to current asset. How much is the total asset turnover ratio? Fixed asset turnover ratio 3 times. Fixed asset equal to current asset. What is total asset turnover ratio? No figures, nothing have been given. Now write. Fixed asset turnover ratio is equal to. Fixed asset turnover ratio is equal to. Tell me the formula for fixed asset turnover ratio. Sales by fixed assets. Sales by fixed assets. Fixed asset turnover ratio, sales by fixed asset. How much is the fixed asset turnover ratio? I'm assuming fixed asset is 100, okay? Any number I can take. I'm assuming it to be 100. Any number I can take just to solve the question. Fixed asset is 100. What's the sales figure? Sales is 300. Sales is 300, fixed asset is 100, okay? Sales is 300, fixed asset is 100. Assumption, any number you can take. What is the ratio they've asked in the question? Total asset turnover ratio is equal to sales by total asset. 300 by fixed asset plus current asset. Fixed asset is 100, current asset is also 100. Both are equal. Both are equal. This is just an assumption. Any number you can take. That doesn't really matter. 100 plus 100. You can work with 100. You can work with 500, 1000. Any number you can take. Any doubts on this? So the answer is 1.5 times. Okay. Given data, gross profit 60,000, GP ratio 20%. Stock velocity means stock turnover ratio. Stock velocity is stock turnover ratio. And listen, sometimes they'll say 6 times means it is ratio. Sometimes they'll say 60 days. Then it is inventory days. It can be in days, it can be in times. Stock velocity 6 times. Find out the average stock. Please use the formula. Inventory turnover ratio is equal to COGS by average stock. Calculate and tell me the answer. Inventory turnover ratio, COGS by average stock. COGS by average stock. COGS by average stock. By now, the interlinkage part should be clear. When they give certain numbers, with that, how do we get the next number? You should be very, very clear. What is the sales figure? 3 lakh. So COGS is 3 lakh minus 60,000 divided by average stock equal to 6. Average stock is 240 by 6, 40,000. 40,000. This is again little good question. Cash sales 25% of credit sale. Cash sales is 25% of credit sale. Total sales is 10 lakh. Total sales is 10 lakh. Now write 10 lakh. Break it into 2. Cash, credit. 10 lakh, break it into 2. Cash and credit. Can you tell me how much is cash sales? How much? Okay. One answer I've got is 2 lakh. Is it 2 lakh 50 or 2 lakh? What is cash sales here? They have said cash sales is what? 25% of Credit sale. So credit sale is 100, cash is 25. Credit sale is 100, cash is 25. If that's at 25% of total sales is 100, cash is 25, credit is 75. So if 100 is credit, cash is 25, overall is 125. 125 equal to 1 lakh. What is 25? What is 100? 125 is equal to 110 lakh. What is 25? What is 100? I'll repeat. Cash sales 25% of credit sale. 25% of credit sales. So what do? We take the credit sales as 100, cash sales is 25, put together 125, put together 125. Again, finer concepts here and there, some subtle variation are there in every example. Any doubts on this? Cash sales is how much? 2 lakh. Credit sales, what's the formula for debt turnover ratio? Credit sales by average receivable. Credit sale by average receivable, this will give you average receivable. Credit sale by average receivable. Credit sales divided by average receivables. Pi equal to 8 lakh by average receivable. 1 lakh 60,000. Again, I keep repeating this. The best way to test your concept clarity is only MCQ form. You do MCQs properly. Descriptive part, even you don't do in the revision phase also, it's fine. But proper understanding of MCQs is needed. The exact question will not come. It will be part of a bigger question. Any doubts on this? Tell me the answer to this. Closing stock value you have to calculate. You do it, I'll explain anyway. Some of you may find it a little difficult. You give it a try, I'll explain. I will explain this. You first give it a try. Okay. Velocity of stock is 3 months. Stock velocity means inventory turnover ratio, but they have given in months. So it is inventory days. Inventory days. So what we can, there are multiple ways of getting to the answer. You will only end result is critical. I can go in different ways. So inventory days is equal to inverse of the inventory turnover ratio. What is inverse of the inventory turnover ratios? Normally do COGS by average stock. This is average stock by COGS into 12. We are doing it in months. 3 is equal to average stock. COGS is 80% of sales. 4,80,000 into 12. This goes to the other side, and average stock will become, what is the average stock figure? 1 lakh 20. Average is 1 lakh 20. Opening plus closing by 2 is 1 lakh 20. Opening 90,000. Closing is balancing figure. Opening 90,000. Closing is balancing figure, which is 1 lakh 50,000. 1 lakh 50,000. Any doubts on this? Any doubts on this? Clear? Can we proceed? Okay, KT Limited's opening stock is 2 lakh 50, closing stock is 375. Sales during the year, I'll take you through this, 13 lakh, GP margin 25% on sales, average accounts payable are 80,000, creditors turnover ratio, I'll take you through this, a little trickier one, creditors turnover ratio. Tell me the formula for creditors turnover ratio. Creditor turnover ratios, credit purchases by average, right, average creditors, credit purchases by average creditor. How much is the average creditor? 80,000. Now credit purchases is not given directly, but they have given something indirectly. Now what is this indirect? Is, listen, you would have learnt about this earlier. COGS is equal to opening stock plus purchases minus closing stock. You could have learnt this formula. Now right below, COGS is equal to opening stock plus purchases minus this. This links a lot of items. Okay, opening stock plus purchases minus closing stock. Can you tell me what is COGS figure? GP is how much? 25% on sales. GP is 25% on sales, which means COGS is what? 75% of sales. 13 lakh into 75%. Opening stock is given in the question. How much? 2 lakh 50. Purchase balancing figure. Closing stock, get the purchases figure. Get the purchases figure. Very well drafted MCQ. Includes a lot of adjustments. Any cash purchase, credit purchase breakup in the question? No, then use this as credit purchase. Use this as credit. If there is a breakup available, then consider that. Otherwise, use this. 11 lakh rupees the credit purchases. 11 lakh rupees the credit purchases. Any doubts on this? 11 lakh by 80,000. 13 point. Clear? We have done a lot of MCQs around this area. With this, my major MCQ discussion is over. I may not do more MCQ discussion. I'll only be discussing concepts now onwards. MCQ I may not discuss, but again I'm repeating. Whatever questions we are doing, if you do MCQs, it will give you the grip and full clarity on the concept. Multiple. These are like individual separate question. I'll have to do so many questions for you to give this much understanding on concept. Instead of doing so many questions, we have selected those critical adjustments and done it in MCQ form. Any doubts on this? Any doubts on this? I'll now get to descriptive question. Any doubts on this? Let's do question 4. Balance sheet of ABC Limited as on March 31, 2015 is given below. Liabilities amount, assets amount, equity capital, reserves and surplus, creditors, plant, furniture, stock, debtors, bank, and the total 90 and 90. Other details, total sales during the year is 100 lakh, out of which cash sales is 20 lakh. GP has been earned at 20%. Amount as on 1/4/2014, opening values they are giving to do the average calculation. To do the average calculation, opening values are given. Debtors 8, stock 14, creditors 3. Cash paid to creditors was 21 lakh. All these questions which you see I've already done in MCQ form, but we'll be doing it now fully. Debtors turnover ratio, working capital turnover ratio, creditors turnover ratio, fixed asset turnover ratio, stock turnover ratio, total asset turnover ratio, capital employed or capital turnover ratio, and current asset turnover ratio. All the ratios we are going to see, but most of it we have already seen in MCQ form. I give you a minute, you go through the question. Okay, we'll go each of the ratio and do it. Let's start. Debtors turnover ratio is equal to debtors turnover ratio, debtors turnover ratio, credit sales divided by average debtors, credit sales by average debtor, credit sales by average debtor. How much is the credit sales? 80 lakh, 80 lakh, 80 lakh. Average debtor, what is the opening debtor? 8, closing 12. Opening is 8. This data is given, not given, do it on the closing. Not given, do it on the closing. 8 plus 12 by 2 is the denominator. 8 plus 12 by 2. 80 by 10, 8 times. Debtors turnover ratio 8 times. 8 times is the debtors turnover ratio. Clear? Was the next ratio. Working capital turnover ratio. Total sales. All these are on sales only except those three ratio. Divided by working capital. Now listen. Working capital denominator, I can take average if I have data. What is working capital? Current asset minus current liability. Stock opening there, closing there. Debtors opening there, closing there. Bank, I don't know the opening balance. I don't know the opening. I cannot calculate and all. I don't know the opening balance, so I'll not take the average here. I'll not take the average. If I have information, I'll take the average. Working capital is stock, debtor, bank minus creditor. Closing, I know. Opening, I know stock, I know debtor, I know creditor. I don't know the bank balance. I cannot assume and all. I don't want to get into it. If information is not there, ignore it. So denominator is only working capital, no average. Total sales is 100. Working capital is stock 18 plus debtor plus bank balance minus creditor, minus creditor. 3.57 times. 3.57 times. Clear? What's the next ratio? Creditors turnover ratio. Creditors turnover ratio. Credit purchases by average creditors. Why average? Because I will take opening plus closing by 2. Credit purchases by average creditors. Credit purchases by average creditor. Below this, closing creditors is equal to opening creditors plus credit purchases minus payments. Plus credit purchases minus payments. Closing creditor is equal to opening creditor plus credit purchases minus payments made. Minus payments made. Minus payments made. Closing is how much? 12. Opening 3. Purchases is balancing figure. Payments made 21 lakh. Tell me the credit purchases. 30 lakhs. Any doubts on this? Clear? 30 divided by average. Creditors turnover ratio 4 times. 30 divided by 7.5. 30 divided by 7.5 4 times. Any doubts on this? Can you proceed? What's the next ratio? Fixed asset turnover ratio, self-explanatory. Sales by fixed asset, average and all not possible. Fixed asset turnover ratio, asset turnover ratio, sales by fixed assets. 100 divided by, what's the fixed asset figure? 45 plus 5, 50. 100 by 50, 2 times. Fixed asset turnover ratio, 100 by 50, 2 times. Moment I had explained the initial ratios and then the MCQ, it got over there itself. It's just a formality. 2 times. What's the next ratio? Stock turnover will take average. Stock turnover ratio is equal to COGS by average stock. COGS by average stock. COGS by average stock. Sales is 100 lakh. GP is 20%, which means COGS is 80%. So numerator is 80% of 100. Denominator, what is the opening stock? 15, 14, okay. Closing 18, opening 14, closing 18. 14 plus 18 by 2. 80 by 16. 5 times. Any doubts on stock turnover ratio? Very simple calculation once we understood the basic concept. Any doubts on this? What's the next category? Capital, the total asset turnover ratio. Total asset turnover ratio. Sales by total asset. Sales by total asset, 100 divided by 90. 100 by 90. 1.11 times. 100 by 90, 1.11 times. Total asset turnover ratio, 1.11 times. Then they have asked for capital turnover ratio. Sales by capital employed. 100 by capital employed is total assets minus current liability or equity plus reserves and surplus, whichever way you want to call it. 60 plus 80, 78. 1.28 times. Any doubts on this? And the last ratio asked was current assets turnover ratio. Sales by current assets. No average concept. 100 by, what is the current asset total? 2.5 times. Now, once the basic understanding is over, we'll be doing all these ratios as part of different question. Not one category will be asked. One ratio from category 1, one ratio from category 2, one ratio from category 3, and they may end up asking you to calculate those ratios. Any doubts on this? Any doubts on this? Moment we did the MCQ itself, this area was complete. Okay, we have done the questions just to get more clarity. Any doubts on this? Done. Okay. Now, what I will do is I'll give you 2 to 3 minutes. You will have to go through all the 8 category of ratios in the concept book. Go through all 8 category of ratio, and we are going to do questions. When we do question, it'll not be that it'll be from one category only. It can be from any category. So go through the entire set of ratios. Maybe you can take around 4 5 minutes. All the ratios, please go through once. Okay, I'll quickly discuss the all ratios again. Moment I complete the discussion, this chapter is technically over. I still have to do a lot of questions, but technically the chapter has got over the moment we completed all those 8 categories. And I just want to rediscuss it once, because when I would have started first time, you would have got few points, but now you would have got more and more clarity as we have done question. Now, what I'm going to do is I'll ask you a ratio name. You'll have to tell me the formula. Then I'll explain the formula if needed. But you will have to tell me the formula. You can close your books and all. Nothing for you to see in your book. Tell me the formula for earnings yield. You will have to tell me. I told you to go through the EPS by MPS into 100. Yield means what I get back divided by what I invest. So earnings per share on the earning yield divided by market price per share into 100. Fixed charges coverage ratio formula. EBIT plus depreciation divided by interest plus installment. This is a variant of another ratio which is important. This is not important. Debt service coverage ratio. What is the formula? PAT plus depreciation plus interest divided by interest plus installment. What is the formula for equity ratio? Equity by capital employed. Equity as a proportion of capital employed. A variant or another one is debt ratio, which is debt by capital employed. What is capital employed? There's an asset side formula, there's a liability side formula. What is asset side formula? Total asset minus fictitious asset minus current liability. I'm not expecting you to remember the formula, but logic should be there. I have not, today when I started, I did not even go through even one of the ratio. But if you ask me Q ratio formula, I don't know, because that I have not understood the logic. So if I have to tell you the formula for Q ratio, I had to look at that screen, and then when I was explaining that time, I looked the formula, then only I told you. But other formula, you ask me anything, I'll be able to tell you. Reason is I have tried understanding the logic of the formula rather than by hearting the formula. You by heart the formula, I cannot do anything. Capital employed, asset side is total assets minus fictitious asset minus current liability. Liability side root formula. Equity capital, reserves and surplus, preference share capital, debentures minus the fictitious asset. What's the formula for proprietary ratio? Proprietors funds divided by total asset. Proprietors funds, what is proprietor fund? Is equity divided by total assets. Variant of this is debt to total asset ratio. Debt to total asset ratio, which is total debt by total asset. Total debt can be replaced with long term debt or total outside liability. Total outside liability. What is the formula for equity dividend coverage ratio? EAES divided by equity dividend. Source of payment divided by what is getting paid. Equity dividend is paid out of EAES. What is interest coverage ratio formula? EBIT by interest, because interest is paid out of EBIT. Preference dividend coverage ratio. PAT by preference dividend, because PAT is paying the preference dividend. Understand logic of the formula. What's the formula for working capital turnover ratio? Sales by working capital. How many times I rotated the working capital? How many times I have rotated the working capital? Total asset turnover ratio. Sales by total asset. Financial expenses ratio. Financial expenses by sales into 100. Operating ratio. COGS plus operating expenses by sales into 100. Pre-tax profit ratio. PBT by sales into 100. Return on capital employed. Give both the formula. That's okay. What is the formula? Return on capital employed. Denominator is capital employed. Numerator is EBIT or EBIT into 1 minus tax rate. EBIT or EBIT into 1 minus tax rate. What is return on asset formula? Denominator is asset. Numerator is PAT or PBT. PAT or PBT divided by asset. Pre-tax or post-tax. Return on equity formula. Denominator is equity and they get EAES. What I get back divided by what I give. What is the formula for dividend yield? Dividend per share divided by earnings per share into 100. Dividend per share by earnings per share into 100. What is the formula for earnings per share? Earnings available to equity shareholder divided by number of share. Dividend per share formula. Total dividends divided by number of share. Total dividend divided by number of shares. See, what I wanted is get full grip on the formula. I didn't want you to just go through it. Get the logic of the formula. Don't try to buy out anything. Payout ratio formula. Dividends by earnings. Dividend per share by earnings per share. Retention 100 minus payout ratio. Current ratio formula. Current assets by current liability. Absolute liquidity ratio formula. Cash and cash equivalent divided by current liability. Quick ratio formula. Quick asset by current liability. Quick asset by current liability. Basic defense interval formula. Cash and cash equivalent plus receivables divided by daily expenses. Net working capital formula. Current asset minus current liability. In the current liability, you should not include the short term loans. Short term loans can be excluded from the calculation. Debt to equity ratio. Debt by equity, debt can be total debt, long term debt, total outside liability. Capital gearing ratio. Debt plus preference divided by equity. In this, preference cannot be added. Preference cannot be added. GP ratio. Gross profit by sales. COGS ratio. COGS by sales. Net profit ratio. Profit after tax by sales. Profit after tax by sales. Operating profit ratio. Operating profit, otherwise called as EBIT by sales. Operating expenses ratio. Operating expenses by sales into 100. Clear? Any doubts in any of the formulae? Any doubts in any of the formulae? Again, I'm saying the formula has to be like you ask me any formula, I'll be able to tell the same thing I want from you guys. And I don't want you to remember any formula. If you try spending time in remembering, I can't really help it. I am not expecting you to remember even one formula. Understand logic of the formula, automatically formula will come. Any doubts in any of the formulae? Clear? Okay, we will now do question 5, which is a homework question. Indirectly, you are going to do it. I'll explain it, and there is some explanation extra they need. That alone I'll take you through, but you will be doing the solving part. And in this question, you will not see one category of ratio. They'll ask different category of ratio. Let's go through 5. In a meeting held at Solent towards the end of 21-22, directors of HPCL Limited have taken a decision to diversify. At present, HPCL sells all finished goods from its own warehouse. Company issued debentures on 1/4/22, purchased fixed assets on the same day. Purchase prices have remained stable during the concerned period. Income statement is given. Cash sales, credit sales, total sales, COGS, gross profit, warehousing expense, transport expense, admin expense, selling expense, net profit they have given. No tax information, no interest information. So net profit is otherwise called as PBT, otherwise called as EBIT in this question. I do not have information. I can't help it. It is EBIT, EBT, EAT, all are same. Then balance sheet is given, fixed assets, receivables, cash at bank, stock, total current asset, payable, total current liability, and they have said working capital is so much and net assets is 1 lakh. What is net asset according to the question is fixed assets plus current asset minus current liability. They have given the balance sheet in this manner. Fixed assets plus total current asset minus total current liability is called net assets as per the question. And how is it represented by share capital, reserves and surplus, and debentures? To put it very simply, capital employed is 1 lakh. Capital employed is 1 lakh. They have given the asset side capital employed fixed assets plus current asset minus current liability, and then they have given separately liability side capital employed. You are required to calculate for 21-22 and 22-23. For 21-22 and 22-23. Some of these are self-explanatory, nothing much for me to explain. First ratio is GP ratio. What is the formula? Gross profit by sales. 2 years you have to calculate. After you calculate for 2 years, I have to give some commentary. That alone I'll explain you. Then operating expenses to sales ratio, as the name indicates, operating expenses by sales into 100. Operating profit ratio, EBIT by sales into 100. Capital turnover ratio formula, sales by capital employed. Now I may want to take average if possible, and average means for both years. Don't do it only 1 year, because second year average is possible because I'll have opening balance sheet, closing. But first year average may be possible, may not be possible. If not possible, then don't do average for both. Don't do average for both. Sales by capital employed. Stock turnover ratio formula, COGS by average stock. If possible, take average. Not possible, take closing. Not possible, take closing. Receivables collection period, 365 by debtors turnover ratio or inverse. Inverse. What is inverse? You take the average receivable by debtor into 365. Into 365 in case you have the data. Ratio relating to capital employed. Okay, very clear. Should be based on the capital at the end of the year. They say don't take average and all, please take end of the year. They are very clearly mentioned. So this ratio very clearly mentioned. First three ratio average concept is not there. For capital turnover ratio, take it on the basis of what? Very clearly mentioned, capital at the end of the year. Give the reason for the change, which is what I'll have to explain. Opening stock of 40,000 for year 21-22. Why they have given this is to take average stock for 21-22 as well as 22-23. Both year take average or both year don't take average. Okay, be very clear. Both year take average or both year don't take average. I have no problem. If data is there, stock is there, I need stock for 3 years to take average for 2 years. Okay, first year, second year and third year they have given that information. So GP ratio, operating expenses, operating profit, capital turnover, stock turnover take average. Net profit to net worth ratio. Okay, I did not discuss what is net profit to net worth. Net profit, we have net worth is equity capital plus reserves and surplus. Equity capital plus net worth means equity. Net worth means equity. To put it very simply, this is ROE, but they did not use the name. They have said net profit divided by net worth. And receivables collection period I've already discussed. I give you around 10 minutes. Do both the years calculation. 10 minutes for you and then I'll discuss it. Okay, 10 minutes for you. Start doing it. The first ratio was GP ratio, which is self-explanatory. 64,000 by 3 lakh, which is 21.33, and 76,000 by 374, 20.32%. It means there is a deterioration which has happened. Why will it fall down? Either you have reduced the selling price or increase in cost. That could be the reason. In a practical world, when I used to work in a rating agency and all, we'll discuss with the client and they'll explain us what happened. We'll be discussing more on the ratios only. So here 21.33 has become 20.32. Major reason I cannot say, decline in the GP is either due to reduction in the selling price or increase in the direct expenses. In this case, COGS have increased more than the proportion of income and hence impacting GP ratio. More or less, we'll just give small reason. We will not be able to give exact reason and all. Second ratio they've asked is operating expenses to sales ratio. All these are part of operating expenses. 49,000 divided by 3 lakh, 16.33%, and this side 57,000 divided by 374, 15.24%. So this is benefit. GP went down. This has also gone down. Indirectly, my net profit may remain same. Net profit can remain same. Here, I see an increase in transport expense. Admin expense has remained same despite sales going up. So that could be the factor which has contributed to a percentage fall. The percentage has gone down. Admin could be more of a fixed expense. So here there is a decline in the ratio. Further analysis revealed that there is, in comparison to increase in sale, there has been lesser proportionate increase in operating expenses. Twin effect of this will come in the operating profit ratio, because operating profit is impacted by GP ratio as well as operating expense. High probability operating profit ratio may remain almost similar. 15,000 by 3 lakh is 5%, and 19,000 by 3,74,000 is 5.08%, almost same. Reason is GP went down, operating expenses went down. My net profit or my operating profit is almost remaining same. Operating profit is almost remaining same. As a result, even the operating has remained the same, despite what? Decline in the GP margin, despite the decline in GP. Because if GP goes up, operating profit has to go down. But benefit for us was operating expenses also went down. Fourth ratio is capital turnover ratio, which is sales by capital employed. Sales is 3 lakh divided by 1 lakh. 3 times we rotated. Then it became 374 by 147. 2.54 times rotation has become little lesser. Reason could be here, they've said company issued some debentures, purchased fixed assets. These new assets which I got, I'm not able to rotate it faster. It took me time, and somewhere this has led to reduction here. They'll not give reason and all. They'll say company has not been able to deploy its capital efficiently. You could not use your capital properly. If you had used your capital properly, for 147, sales should have been 147 into 3 times. Either sales should have been more or capital should have been lesser. We could not, because last year we did 3 times. 100 capital, last year 100 capital, sales 300. Now if capital goes up, sales should automatically go up that much. It did not go up in proportion. Clear? Anyway, you look at your numerator denominator. I'm not getting into the ratio calculation. I'm just getting into the discussion on the reasons and other things. Then stock turnover ratio, COGS by average stock. COGS is 236. Average is opening and closing by 2. Opening was 40,000. Closing stock is 60,000. Average is 50. And this year 298. 50, sorry, 60 plus 94 by 2. 60 plus 94 by 2, which is 77. I think there is a deterioration here also. 236 by 50, 4.72. 298 by 77, 3.87. Rotation has become lesser, which is again a deterioration, a problematic scenario for the company. Decline implies that investment has increased in stock. You are putting more money in stock, but profit is not coming. Profit or sales is not coming. Then net profit to net worth ratio. I will be doing closing net worth only. I cannot do the average net worth for the previous year. I do not have the data. I can make some assumption, but I don't want to get into that. So your net profit is 15,000 by 1 lakh, 15%. 15,000 by 1 lakh, 15%, and 19,000 by 1 lakh 17. 19,000 by 1 lakh 17. 16.23%. Some improvement has happened, 24%. Reason for improvement is, I don't know why they did not give interest expense in the calculation, because you issued debt and all, no interest should have come. that they have not given, indicating that is efficient in generating profits. Efficient in 15 has become 16.24. Last requirement is collection period, inverse of debtors turnover ratio. So I'll use the inverse formula. Inverse formula is debtors turnover is sales by debtor. Here it is going to be debtor by credit sales into 365. No average concept because I do not have the opening for the 21-22 period. So debtors is given in the question 50,000 divided by credit sale 2,70,000 into 375, and the next one is 365, 82,000 divided by 342 into 365, 67, 87. It means build up is happening. Your receivable is going up. 67 has become 87. Build up of receivable is happening. We are not able to collect the money faster. Sales going up, but that sales is leading to a very high increase in debtor here. So increase in receivable indicates company has been liberal in extending credit, or maybe customers are not making the payment. Clear? So we are focused in this question to calculate the ratio. Exam will only ask you to calculate the ratio. Commentary very rarely they ask, but even if they ask a commentary, you will have to only say improved, deteriorated, and some reason you have to give. Clear? Any doubts on this? And receivable collection period going up is bad. Net profit to net worth ratio going up is good. Stock turnover ratio, if it goes up, it is good. Going down is bad. Going down is bad. Turnover ratio, capital turnover ratio going up is good. Going down is bad. That clarity you will get as we do more and more ratios. Clear? So we have done with all the ratios. We have done few question also. Technically the chapter is over. Next session onwards we'll be doing a lot of question. But only thing I want you to do is before you come for the next session, please go through all the ratios and solve all MCQs at home. I've done the MCQs, but you didn't have written all the MCQ answer and all. So you solve all MCQs at home again once without looking at the solution. You will get full grip on this area. Clear? We'll end with this thing. Okay, let's come to question 6. Total sales, all credit of a firm are 6,40,000. GP margin of 15%, current ratio of 2.5, current liabilities are 96,000, inventory 48, cash 16,000. Determine the average inventory to be carried by the firm if an inventory turnover ratio of 5 times is expected. Assume 360 days in a year. Determine the average collection period if the opening balance of debtors is intended to be 80,000. Assume 360 days a year. Two requirements. Nothing much in the question for me to explain. We'll directly start doing it. Some basic information. Let's see. I have been given total sales 6,40,000. All credit sale. GP is 15%. GP is 15%. Current ratio is 2.5. Current liability is given, inventory is given, and cash is given. Determine the average inventory to be carried by the firm if an inventory turnover ratio of 5 times is expected. Tell me the formula for inventory turnover ratio. COGS divided by average stock, and they've asked me to calculate average inventory. So COGS by average stock will give me the average stock, and I'm done with the part 1 of the question. We'll solve together in some time. Determine the average collection period if the opening balance of debtor is intended to be 80,000. Now what is average collection period is 360 divided by debtors turnover ratio, or the other formula is whatever is your formula for debtors turnover ratio, inverse it. What is the formula for debtors turnover ratio? I want participation. Credit sales by average debtor, wherever data is available. Average debtor, inverse. Average debtor by credit sales into 360. Average debtor by credit sales into 360. Inverse the formula wherever data is available. Wherever data is available, you will have to inverse the formula. Question says average collection period if opening balance of debtor is 80,000. Opening is given, but I need closing also. See, if opening was not there and they give closing, you do not have information, take closing as average. But I cannot take opening as average and all. How will I get closing data? with the current ratio, because current ratio is current asset by current liability. I know the current liability, I'll get the current asset figure. In the current asset we have three items here: inventory is there, cash is there, debtor is obviously balancing figure. Working note 1: computation of computation of average inventory. Computation of average inventory. Average inventory. Average inventory is equal to average, sorry, not average inventory, right? Inventory turnover ratio is equal to turnover ratio is equal to COGS by average stock. COGS by average stock. COGS by average stock. How much is the inventory turnover ratio given in the question? 5 times. How much is the GP margin? Which means COGS is 85%. GP margin is 15%. Balance is COGS. So numerator is 85% into 6,40,000. Average stock is balancing figure. You can calculate and close it. 85% into 6,40,000. Average stock is 1,08,800. Any doubts in this? The straightforward, simple question just to get started with. I didn't take a difficult question to start the questions discussion. Any doubts on this? Clear? Second requirement is to calculate average collection period. Average collection period. If opening balance of debtor is 80,000, I have the opening balance. I need to calculate average collection period. For average collection period, we normally use average. The word average doesn't have any implication there. We normally use average receivable if available. Not available, you use closing receivable. But they have given opening debtor. If they had given me closing debtor and opening was not possible, I would have ignored it. But here there will be some possibility of calculating closing, which is where current ratio is going to come into picture. Any doubts? Working note 2: computation of average collection period. Average collection period. Average collection period. Current ratio is equal to current assets by current liability. Current assets by current liabilities. How much is the ratio given? 2.5 is equal to 2.5 is equal to current asset divided by how much is the current liability? Sorry, 96,000. Get me the current asset figure. Current asset is 2,40,000. Current asset is 2,40,000. Now, what is debtor is very simple. From the current asset, we have to eliminate the two items which are there. We have to eliminate the two items. What are the two items? Cash and inventory. Cash and inventory is given in the question. I eliminate that. I'll get the closing debtor. Any doubts on this? Next, closing debtors is equal to current assets minus stock minus cash. Minus stock minus cash. How much is the stock? 48,000. Cash 16,000. Eliminate 48,000 and 16,000. How much is closing debtor? 1,76,000. 1,76,000. Any doubts on this? 176. Now we are going to calculate average debtor. How will you calculate average? Opening plus closing by 2, and then we'll go to average collection period. Average debtors is equal to opening debtors plus closing debtors divided by 2. Opening plus closing by 2. How much is opening? 80,000. Closing 176 divided by 2. 1 lakh 28,000. This is on the average debtor figure. And now we'll come to average collection period. Now we'll come to average. See, for average collection period, I have two choices. One, I calculate debtors turnover ratio and then do 360. Or I directly take the inverse formula. Average collection period is equal to tell me the formula for debtors turnover ratio. Debtors turnover ratio formula. Credit sales by average receivable, inverse. Average debtors divided by credit sales into 360 in this question. They said take 360 days in a year divided by 360. You can even take 365, but here question is specifically saying 360. 1,28,000. How much is the credit sales? 6,40,000 into 360. Into 360 was answer 72 days. They wanted in days. Average collection period 72 days. I could have done 640 by 128, which is 5 times. 360 divided by 5 is also the answer. Whichever way, I find it better to directly write the answer rather than calculating one ratio and then getting it to the other one. Any doubts on this? Clear? This is a basic question just to get started with whatever. The only thing here is, here we have used one liquidity ratio, current ratio, and 2-3 turnover ratios. Like this, different question can pick different areas and club it together. Initially when we were doing one area. Then yes, last question on that day, we did a problem where you were solving it, where different categories were asked from different places. Any doubts on this? Any doubts on this? Let's come to 7. Either we'll do it together or I'll explain and then you will do it. It's a homework question, but take it. Let's start this. Capital structure of Beta Limited is as follows. Equity share capital of rupees 10 each, 8 lakh. 9% preference share capital of 10 each, 3 lakh, 11 lakh. Additional information. Profit after tax at 35%, 2 lakh 70,000. Depreciation 60,000. Equity dividend paid 20%. Market price of equity share 40. You are required to compute the following showing the necessary working. Dividend yield on equity share. Tell me the formula for dividend yield. DPS divided by MPS, dividend per share divided by market price per share into 100. In case you get doubt and all, you can keep the book open and then the concept book and then keep looking at the formula. Cover for the preference and equity dividend. Coverage is preference dividend coverage ratio formula. Preference dividend coverage ratio formula. What comes above preference dividend in the income statement? PAT. PAT divided by preference dividend. Equity dividend coverage ratio. What comes above equity dividend? EAES divided by equity dividend. Earnings per share is EAES divided by number of equity share. What is EAES? PAT minus preference dividend. PAT minus preference dividend. Price earning ratio. What is the formula? Price by earning. Price is MPS divided by EPS. EPS something you will calculate in part C. Nothing much for me to do. I've already explained what you will do. Dividend yield is total dividend by number of share. Cover for preference dividend. PAT by preference dividend. Equity dividend. EAES by equity. What is EAS? PAT minus the preference dividend. Earnings per share. EAES which you calculate here divide by number of shares, and price earning ratio MPS by EPS. Exactly 6 minutes for you. Start doing it. 6 minutes for you. Start doing this. Okay. Question wanted dividend yield. I could see most of you doing it, but some could not do this also. Dividend yield is very simple. DPS by MPS into 100. What is dividend per share is 20% of face value. 20% of face value, 2 rupees. What is 2 rupees? 10 into 20%. If you have not done, you can write it. 10 into 2, 20%, 2 rupees divided by 40 into 100. Some of you could not get it. That's perfectly fine. Initial set of question, 5%. If you have not got it, you can write this. Then preference dividend, cover for the preference and equity. Separate. Okay. PD coverage. PD coverage is equal to this. Almost everyone had the answer. PAT by PD. PAT by preference dividend. PAT divided by, in the income statement, PAT comes above, preference dividend comes below. So PAT by preference dividend. PAT number is 2,70,000. Preference dividend is 27,000. 10 times. 10 times 2,70,000 divided by 27,000. Equity dividend coverage ratio is this. I could see some notebook not closing it out fully. Equity dividend coverage is EAES by equity dividend. EAES by equity. What is EAES? Is PAT minus the preference dividend, which is what the earlier ratio was using. PAT minus the preference dividend. Equity dividend is 2 rupees per share. 2 rupees per share. We totally have 80,000 share. Or you can directly say 8 lakh into 20% also. You can say 8 lakh into 20%, or you can say 2 rupees per share into 80,000 share. 1 lakh 60,000. ED coverage is 270 minus 27,243 divided by 1 lakh 60,000. 1.88 times or 52 times or 51875. That's okay. Equity dividend coverage ratio. Any doubts on this? Third requirement was simple. EPS, EAES by number of share. EAES is used in the earlier calculation. 2,43,000. Number of share is 80,000. 243 by 80,000. How much? 3.0375 rupees. This is in rupees. 3.0375. Any doubts in this? And last part was, that asked, I think, what is the last part? Price earning ratio, MPS by EPS, 40 divided by 3.0375. How much? Times. Any doubts on this? Any doubts on this calculation? Some numbers you were not able to do. I'm perfectly fine. First question which you are practicing. This category we did not even discuss properly when we did the explanation part, because I had only discussed the ratio. We did not do any problem. Any doubts on this? Any doubts on this part? Clear? Question had given lot of information, like they had given depreciation. All that was of no use. Ideally, this is the income statement format. PAT less preference dividend EAS, number of equity share EPS. EPS multiplied with the price earning ratio is MPS. EPS multiplied with the price earning ratio is called as MPS. So this is the format. If you follow this format also, you'll get to the answer. Any doubts on this? Any doubts on this? Let's come to 8. This question is a very simple one, but a part of the bigger adjustment. What is bigger adjustment is when you do a bigger question, this is a usually tested adjustment, and students somewhere when you look at it as a part of a bigger problem, you find it little difficult to tackle. Let's see. Following information relates to Beta Limited for the year ended 31st March 2013. Net working capital 12 lakh, fixed assets to proprietors fund ratio. There's no ratio like this we have seen, but they have given a name. Fixed assets by proprietor fund is 0.75. Working capital turnover ratio 5 times. Return on equity 15%. It links lot of ratios you will see when we do. They've asked us to calculate proprietors fund, fixed assets and net profit ratio. What is proprietor funds? Is owner's fund, technically share capital plus reserves and surplus minus fictitious asset. Preference your wish. You want to add it. You don't want to add, don't add it. Anyway, we are not going to show the breakup. We'll just call it as proprietor's fund. Fixed assets we'll have to calculate, and net profit ratio. What is the formula for net profit ratio? Net profit by sales. Net profit by sales. Now, I have a ratio called fixed assets to proprietor fund 0.75. I have another item called net working capital. There is no debt capital. There is no debt capital. No debt capital means debt is not there. Debt is not there. If debt is not there, proprietor fund is equal to capital employed. Proprietor fund is equal to capital employed. Tell me the formula for capital employed. What were two formulae were there for capital employed? Asset side, what is the formula? Total assets minus current liability. Total assets minus current liability. So it was total asset minus current liability, which is fixed assets plus current asset minus current liability. This is called working capital. This is called working capital. Current asset minus current liability is called working capital. So somewhere I will use the link here and try to get the proprietor's fund. Try to get the proprietor's fund. If we get proprietor's fund, automatically we will get the fixed asset. Automatically we'll get the fixed asset, and then we'll see what to do for net profit ratio. Let's start working note 1. Computation of proprietor fund and fixed assets. Proprietor funds and fixed assets and fixed assets. They have given one ratio. Tell me what is the ratio name they have given? Fixed assets to proprietor fund, whatever name they have given. FA by PF. FA by PF. Fixed assets by proprietor fund. We do not have a ratio like this, okay? I have not discussed a ratio like this. They have given. Let's write it. How much is this? Net I can say fixed asset is equal to 0.75 PF. 0.75 proprietor funds. Any doubts on this? Clear? Capital employed is equal to fixed assets plus current assets minus current liabilities. Fixed assets plus current assets minus current liability. What is fixed asset? See, capital employed, I told you two routes. One was asset side route, another one was liability side route. Asset side route is total asset minus current liability. What is total asset? Fixed asset plus current asset. In this question, there is no debt capital. There is no debt capital. So, capital employed is equal to what? Proprietor fund. PF equal to PF equal to fixed asset is equal to something we just now wrote. Fixed asset is equal to what? 0.75 proprietor fund. 0.75 proprietor fund. Proprietor fund is equal to fixed assets, which is 0.75 proprietor fund. 0.75 proprietor fund plus current asset minus current liability is given in the question. How much? Plus 12 lakh. Plus 12 lakh. Clear? This will give you the answer to proprietor fund. Solve and let me know. Proprietor fund answer you will get 0.25 proprietor fund is equal to 12 lakh. Proprietor fund, how much you said? 48 lakh. Please close the fixed asset also then. How much the fixed asset? 36 lakh. Any doubts on this? Clear? Can we proceed? Any doubts on this? Clear? Can we? Done? This is a usual adjustment as part of a bigger question. You may see this again coming in 2-3 question. You part of a bigger question. This is usually tested. Any doubts on this calculation? Can we proceed? Okay. Next requirement is net profit ratio, net profit by sales. Tell me the formula for ROE. If you don't know, open the concept book and then tell me. That is also okay. What is the formula for ROE? EAES by amount of equity. Now write ROE is equal to next computation of net profit ratio. Computation of net profit ratio. In case you don't remember a formula, initial sessions, you can even keep the concept book open. But later on, you will have to register the formula. ROE is equal to EAES divided by amount of equity. EAES divided by amount of equity. Earnings available to equity shareholders divided by amount of equity. Divided by amount of equity. How much is the ROE number? Sorry. 15% is equal to. What does EAES is? Profit after tax. Because I do not know whether preference there, not there. Let's not worry about it. So PAT divided by amount of equity is proprietor fund. Amount of equity is proprietor fund. How much is the proprietor fund? 48 lakh. Tell me the PAT figure. Profit after taxes. Technically EA is 7,20,000, but that is equal to profit after tax. That is equal to profit after tax. EA is 7,20,000 equal to profit after tax. Any doubts on this? Can we proceed? The gap between EAES and profit after taxes preference dividend, which I assume is not there. How will I get sales figure? There's the other ratio, working capital turnover ratio, which is sales by working capital. Sales by working capital. Next, working capital turnover ratio is equal to working capital turnover ratio is equal to sales divided by working capital. Sales divided by working capital. Working capital turnover ratio is equal to sales by working capital. How much the working capital turnover? 5 times is equal to sales. We are calculating working capital. We know how much? 12 lakhs. Get the sales figure. That's all. Now net profit ratio is equal to PAT by sales into 100. PAT by sales into 100. 7 lakh 20,000, 60 lakh into 100. How much? 12%. Again, a good question. Linking of multiple ratios. You'll have to keep linking ratios and automatically get to the answer. This chapter is very simple if you're able to do the interlinkage. Otherwise, it will become extremely challenging. Any doubts on this? Clear? Can we proceed? Let's come to 9. Following accounting information and financial ratio of M Limited relate to the year ended 31st March 2012. Inventory turnover ratio 6 times, creditors turnover ratio 10 times, debtors turnover ratio 8 times, current ratio 2.4 times, GP ratio 25%. Some basic information. Total sales 30 lakh. Cash sales is 25% of credit sales. Cash purchases is given. Working capital 2 lakh 80,000. Closing inventory is 80,000 more than opening inventory. Some of this I've already discussed in MCQ. There was one MCQ where we said cash sales is 25% of credit sale. We had done that. There was another MCQ where cash purchases and inventory data was there. We had done that also. So somewhere they have given this information. We are required to calculate average inventory. Average inventory, which formula will help us in calculating average inventory? We'll do the calculation later, but which formula? Inventory turnover ratio is equal to COGS by average stock. Purchases, which formula will help us? No, you've got the COGS, opening stock plus purchases minus closing stock. Opening stock plus purchases minus closing stock. Average debtors, which formula? Debtors turnover ratio. Debtors turnover ratio. We'll do all the calculation. Okay. Average creditors turnover ratio will help me where I'll have to use credit purchases. I'll have to use average payment period. Payment period means how, when are we paying? 360 or 365 divided by creditors turnover ratio. 360 or 365 divided by creditors turnover ratio. Average collection period is how are we collecting it? 360 or 365 divided by debtors turnover ratio. Current asset, current liability part I'll explain, but this is part of a usual adjustment which we normally do. Let's start. Working note 1. Compute note 1 or whatever. Working note 1. Computation of average inventory. Average inventory. Average inventory. We will do this calculation with the help of which ratio is it? Inventory turnover ratio, right? Inventory turnover ratio is equal to COGS by average stock. COGS by average stock. COGS divided by average stock. Divided by average stock. COGS by average stock. Inventory turnover ratio given here is how much? 6 times is equal to 6 times or 6 is equal to COGS is 75% of sales. GP margin is 25%. GP margin is 25%. Usual adjustment. We did it even in that earlier example question. 75% into 30 lakh divided by average stock. Divided by average stock. Let me know the average stock figure. 3 lakh 75,000. Average stock 3 lakh 75,000. Any doubts on this? Clear? Average stock 375. COGS by average stock, which is 2250. Average stock goes to the other side. 2250 divided by 6. 3,75,000. Any doubts on this? Can we proceed? Working note 2. Computation of purchases, average creditors, and average payment period. Let me close all of this together. All are interlinked, okay? Purchases, average creditors, and average payment period. Purchases is part 2, average creditor is part 4 of the question, and payment period is part 5 of the question. Purchases, average creditors, and average payment period. Now we'll have to break this average stock into opening stock and closing stock. Once I break this, then I'll be able to answer the purchases figure. Now, right, average stock equal to 375, center of the page 375, split into 2. Opening stock, closing stock. Opening stock and closing stock. Average stock 375, split it into 2. Opening stock, closing stock. Question has given some information saying closing is more, opening is more. What they have mentioned? Okay, opening, write it as A, closing is A plus 80,000. Take average of this and tell me what is A. A and A plus 80,000. Solve this and let me know what is A. Opening is A plus A plus 80,000 divided by 2 is equal to 375. A plus A plus 80,000. Closing is 80,000 more than the opening. Closing is 80,000 more than the opening. So we have done opening as A. If that's an opening is more, I would have taken closing as A, opening as A plus 80,000. Opening as A plus 80,000. A plus A plus 80,000 divided by 2, 375. Let me know what you get as 3 lakh. Opening is 335. Closing is, if there was no information, if there is no idea to break it up, logic is very simple. Opening also 375, closing also 375. That's the logic with which we work. Any doubts on this? 335 and 415. 335 and 415. Any doubts on this? Any doubts on this part? Can we proceed? Clear? Then write COGS is equal to opening stock plus purchases minus closing stock. Opening stock plus purchases minus closing stock. Listen, it's not only this. Okay, you write the full formula itself plus direct expenses, if at all any direct expenses are there, which is what is the real formula. COGS is opening stock, purchases minus closing stock, any direct expenses like wages and all. Basically, all trading account items. All trading account items. This is the direct expenses which you learn in accounting, not in our costing. In costing, direct expenses is different. In accounting, you would have learned wages, direct expenses, all that will go to your trading account. What is the COGS number? Is equal to, what is the opening stock figure? Plus purchases, we don't know. Minus closing stock is 4,15,000. Let me know the purchases figure. Purchases figure. Sorry? Any doubts on this? Now I'll use creditors turnover ratio like we did inventory turnover ratio. Now we'll use the creditors turnover ratio, that will give me average creditor. Average payment period, now itself I can do 365 divided by creditors even without doing any other calculation. Average payment period is the very simple 365 divided by creditors turnover ratio, divide by creditors turnover ratio. Any doubts on purchases figure? Next, creditors turnover ratio is equal to, please use the formula and tell me the average creditor. Use the formula and tell me the average creditor. Creditors turnover ratio, creditors turnover ratio, how much? What is the average creditor figure? 2 lakh. Only thing is I did not tell the formula purposely. You'll have to use credit purchases. There is a cash purchase element given in the question. You'll have to use the credit purchases. If you have used total purchases, I cannot help it. Credit purchases divided by average creditors. Divide by average creditor. How much is the creditor turnover ratio? No, no. How much is the credit? 10 equal to 2330 minus 2 lakh 30 divided by average creditors. We got average creditors is equal to 2 lakh 10,000. Any doubts on average creditors? Then average payment period is equal to, average payment period is equal to, have they mentioned any number of days in a year? 360, 365, anything mentioned? Then take 365. 365 divided by creditor turnover ratio. 36.5 days. 36.5 days. A very simple calculation. Any doubts on this? 36.5 days. Any doubts on this? Can we proceed? Working note 3. Computation of average debtor and average collection period. Average debtor and average collection period. I give you exactly 3 minutes. Please complete this calculation. For average debtor, you will have to use credit sales. Split all, you do that. All you do that. 2-3 minutes and then we'll discuss it. So first thing we had to do is break the total sales given in the question as cash sales and credit sale. Total sales is 30 lakh. Breakup of this cash and credit. Cash and credit. Cash component we have to calculate. Credit component we have to calculate. 25% of credit sales. So cash is 25. Credit is 100. If that's at 25% of total sales, cash is 25, credit is 75. Break 30 lakh in the ratio of 25 is to 100. Break 30 lakh in the ratio of 25 is to 100. 1 is to 4. So you get 6 lakh 24 lakh. 6 lakh and 24 lakh. Clear? Any doubts on the 6 lakh and 24 lakh? Average debtors is equal to credit sales, that is your debtors turnover ratio. You will have to use the debtors turnover ratio, which is debtors turnover ratio 8 times. So debtors turnover ratio is equal to credit sales by average debtor 8 times is equal to 24 lakh divided by average debtor. What is the average debtor figure? 3 lakhs. Any doubts on this? Any doubts on average debtor? Average debtor is 3 lakh rupees. Average collection period is 365 by 8. 365 by 8. 45.63 or 625 days, whatever way you write. We are collecting the money in 45 days approximately. Any doubts in this part? Next, that current asset and current liability is a usual adjustment which we do. It is a very simple adjustment, but this is a usual requirement of the way. Any doubts till this? Any doubts on this? Can we proceed? Clear? Everyone done till this? Anyone still doing any of these? Next, computation of current asset and current liability. This is a usual adjustment again, a common adjustment which we do as part of a bigger question. Is the current ratio given in the question? Right, current ratio is equal to current asset by current liability, current asset by current liability. You cannot use the short form. I'm writing here, you don't write the short form and all. Okay, current asset is equal to current ratio is equal to current asset by current liability. How much is the current ratio? 2.4 is equal to CA by CL. Current asset equal to 2.4 current liability. I don't know the current asset figure. I also don't know the current liability figure, but I have one more figure in the question, which is working capital. With current ratio and working capital, if they give together, this adjustment is done. Now, right, working capital is equal to current assets minus current liabilities. Current assets minus current liabilities. How much is working capital? Is equal to 2.4 CL minus CL. 2.4 CL minus CL. Current asset is 2. This is a usual adjustment, part of a bigger question. Okay, 2.4 current liability minus current liability, we get 1.4 CL equal to 2,80,000. Current liability is equal to 2 lakh. 2 lakh into 2.4 times 4 lakh 80,000. A usual adjustment. This is a usual adjustment, part of a bigger question. Part of a bigger question. This is a commonly tested adjustment. Any doubts on this? Can we proceed? Clear? Tennis homework. 11, I'll explain it. Maybe I will do, or you are going to do. It's a homework question, but maybe I'll do it in the class. Depends. Let's discuss 11. 10, you will do it at home, and then I'll discuss in the next session if needed. X company has made plans for the next year. Company will employ total asset of 8 lakh, 50% being financed by borrowed capital at an interest cost of 8% per year. Direct cost is 4 lakh 80,000 and all other operating expenses are 80,000. Goods will be sold to customer at 150% of the direct cost. Tax rate is 50%. You are required to calculate operating profit margin before tax, net profit margin after tax, return on asset on operating profit after return on asset on operating profit after tax. They have given some different name here. Asset turnover and return on owner's equity. 5 requirements are there. This question, exact same question came in September exam. In the September 2025 attempt, exact same question with obvious change in numbers. Now let's quickly discuss it. What is the formula for operating profit margin? Operating margin formula. Operating profit, which is called EBIT, divided by sales. I don't know why they specifically said before tax, because we do before tax only. We do it before tax. Net profit margin after taxes, profit after tax by sales into 100. Return on asset, if you just leave it at this stage, ROA is PBT by assets or PAT by assets, but they are saying return on asset on what? Operating profit. On operating profit would mean EBIT on operating, but after tax means EBIT into 1 minus tax rate divided by EBIT into 1 minus tax rate divided by asset figure, divided by the asset figure. Asset turnover, what is the formula? Sales by assets, return on owner's equity. Now you cannot look at the book. I've already discussed it in the one of the question. ROE formula was EAES by amount of equity. Straightforward question. You can manage it, but I'll just do one thing. I'll do the income statement. After that, you complete everything. Let's start. Income statement. Income statement. Particulars calculation amount. Sales. They mentioned something about sales in the question. 1.150% of direct cost. What is direct cost? Is technically COGS. Technically COGS. 1.5 into what is direct cost? 1.5 into 4,80,000. 150% of direct cost. How much is this? 7,20,000. Sales is 150% of direct cost. Direct cost is 4,80,000. Direct cost is 4,80,000. Any doubts on this? Less direct cost. Less direct cost. 4,80,000. 4,80,000. This will give me gross profit. Gross profit. Gross profit. How much is gross profit? 2,40,000. GP is 2,40,000. Not a very tricky adjustment and all. But income statement alone, I'm doing it. Then you close it. Less operating expenses. What is operating expenses? Admin, selling, all that. How much? 80,000. EBIT, technically operating profit. EBIT, technically operating profit. 1,60,000. EBIT operating profit 1,60,000. Less interest. For interest, they have given information that we are going to employ total asset of how much? 8 lakh. 50% is being financed through borrowed capital. Finance means you are taken a borrowing of 50% of the total asset and you have to pay interest of how much? 8%. 8 lakh into 50% into 8%. 32,000. EBT. EBT 1 lakh 28,000. EBT 1,28,000. Less tax, somewhere the tax rate will be there. 1,28,000 into 50%. EAT slash EAES, both are same. EAT slash EAES. Question is almost over. My role gets over at this stage. I give you some time to calculate all those ratios asked in the question and then we'll discuss it. They have asked totally 5 ratio. operating profit, net profit margin, return on asset, asset turnover, and return on owners equity. Please start calculating all the five ratios. We'll discuss this in another 4 5 minutes. Any doubts on the income statement? 4 to 5 minutes for you. The requirements were to calculate operating profit margin. Operating margin is your operating profit 1,60,000 by 7,20,000 into 100. What's the answer? 22.22%. First one. The second one was net profit margin. Net profit by sales 64,000 by 7,20,000 into 100. How much is the answer? 8.89%. Third requirement was ROA on operating profit after tax. On operating profit after tax, EBIT into 1 minus tax rate. EBIT into 1 minus tax rate divided by assets, which is EBIT number is 1,60,000 into 0.5. Asset figure was I think 8 lakh into 100 to express in percentage, 10%. Return on asset on operating profit. Then asset turnover is easy. Asset turnover formula is what? Sales by asset 7 lakh 20 divided by 8 lakh 0.90 times. Asset turnover 0.90 times. And the last one is ROE. ROE is PAT equity. PAT is 64,000. Equity number is of the 8 lakh asset, 4 lakh is borrowing, another 4 lakh is equity. Another 4 lakh is equity into 100. 16%. Any doubts on this? Any doubts on the calculation here? Done? Can we proceed? Any doubts on this? Done? Let's come to question 12. MN Limited gives you the following information related for the year ended 31st March 2016. Current ratio, debt equity ratio 1 is to 1.5, return on total asset after tax, return on total asset after tax, total asset turnover ratio, GP ratio, stock turnover ratio, net working capital, fixed assets, 1,80,000 equity shares of 10 each, 60,000 9% preference share, opening stock. Some information they've asked for quick ratio, fixed asset turnover ratio, proprietary ratio, earnings per share. First, you go through this and then I'll start explaining it. Go through this first. Okay, first requirement is quick ratio. What is the formula for quick ratio? Quick assets by current liability. What is quick asset? Is current asset minus stock. I have that combination which I was talking about. I have current ratio and net working capital. So with this, what I will get is current asset and current liability. We did this adjustment some time back. We'll do it again in this question. You will get current asset and current liability. From the current asset, I have to remove stock. I have to remove stock. I'll have to get to stock somehow. I'll have to get to stock somehow. Once I get that, I'll remove the closing stock. From the current asset, I'll have to remove the closing stock. Now, for getting to the stock information, which ratio can help us? Stock turnover ratio can give me average stock. Average, I'll break it as opening and closing. Opening is given in the question. Closing, we will get it. But for getting to stock turnover ratio, I need COGS. For COGS, I will need sales. For COGS, I will need sales. It is a linking of too many items here. First ratio itself want me to calculate quick asset by current liability. Current liability easy to get. Quick asset little challenging to get. Well, it will take more time. How will you get sales here? Total asset turnover ratio, which is nothing but sales by total asset. What is total asset? Fixed asset plus current asset. Current asset you would have calculated. Fixed asset is given in the question. Fixed asset is given in the question. Fixed asset we'll do it in some time. But first I'll explain the broad overview so that you are very clear, and then we'll start doing it. So fixed asset plus current asset will give me total asset. Total asset turnover ratio will give me sales. Sales into GP margin will give sales into non-GP margin, that is balance margin, will give me COGS. COGS by average stock is stock turnover, that will give me average stock, and then break it into two, opening and closing. Then break it into two, opening and closing, and this way we will get to the answer of opening stock and closing stock. This will get to the answer of opening stock. Opening stock is given, closing stock will come. Use this closing stock for quick ratio calculation. Once this is done, fixed asset turnover ratio is easy. Fixed asset turnover ratio, sales by fixed asset. What's the formula for proprietary ratio? I told you this ratio alone you will have to at least remember. Proprietor funds divided by total asset. What is proprietor fund is? Share capital plus reserves and surplus plus preference. That logic you can preference your wish where you want to take, or you can also say proprietor fund is equal to fixed assets plus current asset minus current liability. Fixed asset plus current asset minus current liability, provided debt is not there. Provided debt is not there. Question is not talking about any borrowing. Okay, there is a borrowing also. Sorry, there is a borrowing. Debt equity ratio is there. Okay, borrowing is also there. So there's another adjustment also. We'll have to see about the borrowing element also. Clear? Let's start now. Working note 1. Computation of, or call it as note 1, not working note 1. Okay, same only. Computation of current assets and current liabilities. Current assets and current liabilities. Current ratio is equal to current ratio is equal to current assets by current liabilities. How much is the current ratio given in the question? 2.5 is equal to CA by CL. CA by CL. Current asset equal to 2.5 current liability. Current asset equal to 2.5 current liability. Equal to 2.5 current liability. CA equal to 2.5 CL. Then working capital is equal to current asset minus current liability. Current asset minus current liability. How much is working capital given in the question? 13,50,000 is equal to 2.5 CL minus CL. Okay, sorry. Current liability is 9 lakh. No? Current liability is how much? 9 lakhs. Current asset 22 lakh 50,000. The problem here is, from this figure I have to remove inventory. I have to remove inventory, then I can do quick ratio. Any doubts till this first? Current liability 9 lakh, current asset 22 lakh 50,000. Can we proceed? Note 2. Computation of inventory. Computation of closing inventory. We have to get the closing inventory. Computation of closing inventory. First I'll get sales, then I'll get COGS, then I'll get average inventory, then I'll get the closing inventory. Total asset turnover ratio is equal to total asset turnover ratio is equal to sales by total assets. Sales by total asset. Sales by total asset. How much is the total asset turnover ratio? 2 is equal to 2 is equal to sales we are calculating. How much is the fixed asset given in the question? Total asset is 30 lakh plus 2250. 30 lakh plus 2250. No, total asset, that's all. That is capital employed. Minus is in capital employed. They've given total asset turnover ratio only, no? Yeah. Total asset turnover ratio, fixed asset plus current asset. How much is the sales figure? If they had given working capital turnover ratio, then yes, I'll have to remove the current liability in the denominator. Sales is 1 crore 5 lakhs. Any doubts on this? Sales is 1 crore 5 lakhs. Is there a confusion? Can you proceed? Next, stock turnover ratio is equal to. You'll have to be very clear on the interlinkages. That is what this chapter needs. Stock turnover ratio is equal to COGS by average stock. How much is stock turnover ratio? 7 equal to 1 crore 5 lakh into 80% divided by average stock. Divided by average stock. 7 equal to 1 crore 5 lakh into 80% divided by average stock. Average stock, how much is it? 12 lakhs. Average stock is 12 lakh. Any doubts on this? Then opening stock plus closing stock divided by 2 is equal to 12 lakh. Opening stock you have in the question. Closing, please calculate it. Opening is 1140. Closing we have to calculate equal to 2 into 12 lakh, 24 lakh. 2 into 12 lakh, 24 lakhs. Closing stock is 12 lakh 60,000. Okay. I've got the information to calculate quick ratio. I'll do the ratio calculation at one stretch. Okay. We'll write a separate note called a solution. We are just doing the base workings. Any doubts on this? Can we proceed? We'll do the quick ratio calculation in some time. Second ratio base working is already done. Fixed asset turnover ratio workings are already done. Fixed asset turnover ratio is very simple. How are we going to get fixed asset turnover ratios? We have the information here. Sales by fixed asset. Proprietary ratio is proprietor funds divided by total asset. Proprietor funds divided by total asset. Now, next, computation of proprietor funds. Computation of proprietor funds. Capital employed is equal to fixed assets plus current assets minus current liabilities. All the numbers are there with you. Tell me. Yeah, I'm writing capital employed. Capital employed includes debt. I'm not written proprietor funds. I'll come to proprietor funds in a minute. Capital employed. See, the same thing we did sometime back here, where I had written capital employed is equal to fixed assets plus current asset minus current liability, and then I said capital employed is equal to proprietor fund. I'm not going to say capital employed is equal to proprietor fund as of now. What will happen, we'll see. Tell me the capital employed figure. What is the fixed asset figure? 30 lakh. Current asset and current liability. So net it is 43 lakh 50,000 is the capital employed. Okay. They have given a ratio called debt equity ratio 1 is to 1.5. Now, ICI may say debt equity ratio as total debt by equity, total outside liability by equity. I don't know how they have taken this number and all. So I will do an answer. In case it does not match the solution, then an alternate answer is possible. Okay. Now listen. Capital employed. Listen for a minute and then you write. The breakup of capital employed is equity and preference one side, debt another side. I'm adding preference to the equity part. This is the way I plan to do this. Now, they have given the ratios what? 1 is to 1.5. So, debt is 1, equity is 1.5. Provided in this formula, we are using debt by equity. If you are using total outside liability, then I cannot do this logic. The answer can change. I'm not very sure what is there in the final answer. Let me do it and then we'll see the answer. Now, write capital employed and break it into two. Equity plus preference 1.5, debt is one time. Equity plus preference is proprietor fund. Equity plus preference is proprietor funds. This is proprietor funds. Another way of taking proprietor fund is equity plus preference, but there can be reserves and surplus also. So that's why I have not done that. How much of the capital employed you said? 43 lakh. Please break it in the ratio of 1.5 is to 1. 26 lakh, 10,000. 20 lakh, 17 lakh, 40,000. Okay. Should ideally be the answer, but in case there's anything different, let's see that. 2610. What is 2610 is equity capital plus preference, some reserve, something and all can be there. I've added preference to equity. This is also assumption only. Somebody says, no, I'll add preference to debt. Then the automatically this break, then preference goes to the other side. Debt plus preference is 17 lakh 40 and equity separately would have become 2610. It is all assumption based area. Any doubts in this? Can we proceed? This adjustment we did not do in that earlier question because they said there is no debt capital. With this, I will calculate my proprietary ratio, which is proprietor fund by total asset. Now, earnings per share also, let's do the base data. Earnings per share needs EAES divided by number of share. For EAES, I need profit after tax minus preference dividend. Tell me how will I get profit after tax? Return on total asset in bracket what? After tax. Same thing we did earlier also, return on asset in the earlier question, but there they said on operating profit. Specific word was on operating profit. Here no specific word and all. So return on total asset after tax would mean PAT by total asset. PAT by total asset. Next note, computation of PAT. Note 4, computation of profit after tax. Profit after tax. Return on asset is equal to return on total asset is equal to PAT divided by total asset. They have said after tax. If they are not said after tax, then assumption. It could be before tax, after tax. Then if it's before tax, you got PBT. Deduct the tax rate, you'll get PAT. Return on total asset is PAT divided by total asset. How much is the return on total asset given? 15% equal to PAT by 52 lakh 50,000. 787 500. From this 787 500, I have to deduct preference dividend, which is easy to do. Divide by number of shares, EPS. Any doubts on this? Note 5, solution. This step I'm not going to do. I'll give you 3-4 minutes to do it. I'll quickly discuss and then you start doing it. Any doubts till this? Quick ratio, quick asset by current liability. What is quick asset? Is current asset minus closing stock. Fixed asset turnover ratio, sales by fixed asset. Already there. Proprietary ratio, proprietor funds already there in your notebook divided by total asset. Earnings per share, EAES divided by number of equity share. What is EAES? PAT minus preference dividend. Clear? Any doubts on this? Straightforward, simple calculation. 3-4 minutes for you. Start doing it. So the requirements were 4 ratios. First is quick ratio. If you have not done, you can write it now. Quick asset by current liability. 2250. What is the closing stock figure? 12 lakh. 60,000. Current liabilities 9 lakh. What's the answer you get? 1.1 times. Then fixed assets turnover ratio. Sales by fixed assets 1 crore 5 lakh by what's the fixed asset figure? Sorry, 30 lakhs 3.5 times. Then they have asked for proprietary ratio. Proprietary ratios, proprietor fund by total assets. Proprietor fund was 20 divided by 52 lakh 50,000. 4971 times. Then they have asked for EPS, EAES by number of shares. EAES is PAT minus preference dividend 787 500. Preference dividend is 6 lakh into 9% into 10 rupees. 10 rupees per 6 lakh into 10% into 10 rupees into 9%. 6 lakh into 10 rupees into 9%. How much? 60. That's what I said. No, what did I say? I said, okay, sorry. 60,000 into 10 into 9%, 54,000 divided by 1,80,000. How much? 075 rupees. You will have to add here. Rupees 4.075 per share. Others are in times. This alone rupee has to be added here. Any doubts on this? Not, that's what it all depends on. There are different ways of looking at the answer. Let's see now. Now I'll look at the answer. Answer can change based on assumption. Now I'll look at the answer. So here the proprietor fund answer itself is different. Reason is, I'll explain the reason. First let's look at this. 1.1 time, 3.5, 4.075. These three have matched. One answer did not match. I'll explain the reason also here. Proprietor funds, they have taken equity is equal to 1.5 debt, which I agree with it. But what they have done is debt and current liability. Debt and current liability. Okay, ठीक है. Only one difference they have done. In the debt equity ratio, the preference was neither added to debt nor added to equity in the solution. Preference is neither added to debt nor added to equity in the solution. The preference is neither added to debt nor added to equity. How will this answer come? I'll quickly discuss it and then you can see the solution. So what is the solution I see as followed is, what is the total asset figure we had? Total asset figure 52 lakh. What I did is I removed the current liability and called it as capital employed. Now this total asset is from a liability side point of view, debt, equity, preference, current liability. Debt, equity, preference and current liability. You can write this answer in a minute. Okay, let me first close it and then write. This is an alternate answer where preference is neither added to debt nor added to. I was thinking that preference will be added to equity. Current liability figure we had calculated how much? 9 lakh. Preference 6 lakh. What is the debt equity ratio given in the question? 1 is to 1.5. So debt is 1, equity is whatever balance is there, split that in the ratio of 1 is to 1.5. Whatever balance is there, I had added preference to the equity number. Write this now. Alternate answer or ICI answer. Let's follow this only. Total asset equal to 52 lakh 50, 52 lakh 50. Debt, equity, preference and capital employed. Preference and current liability, sorry, preference and current liability. Debt, equity, preference and current liability. In the solution, again I'm repeating, the component of preference is neither added to debt nor added to equity. Is it logical? Yes, can be argued on. I normally feel that it has to be added to one place. Okay, so preference and current liability. Preference is 6 lakh, current liability is 9 lakh. Whatever balance amount is there, split in the ratio of 1 is to 1.5. Whatever balance is there. Balance amount is after this 15 lakh balance is 3750. 3750. 15 lakh and 22 lakh 50,000. 15 lakh and 22 lakh. In the debt equity ratio, ICI has said debt separately, equity separately, no need to add the preference anywhere. Any doubts on this? Any doubts on this 22 lakh 50? Clear? Now proprietary ratio is equal to proprietor fund by total asset 2250 plus, assuming preference is brought in by the proprietor, 2250 plus 6 lakh divided by 5250. And this is also a challenge with ratio because it can be looked at in different ways. That's a problem. Practical world, I have no issue. I write my assumption clearly. 0.5429. Now it will match. 54 times. Any doubts on this? Any doubts on this? This challenge will be there in this entire chapter. Wherever issues are there, I normally write a note before the question itself. I don't know why I did not write a note on this, but I normally write a note saying that this is how you will have to consider in this question. In exam, that note and all will not be there, but this challenge will be there with this area. Any doubts on the question? A good problem. We have to link multiple ratios and get to the solution. Any doubts on this? Can we proceed? Let's go to the next question. Question 13. Some part of it you may do or most of it also you may do. Let's see first. Following information relate to a concern. Debtors velocity 3 months. If they use the word velocity, it can be times, it can be days. They have given 3 months. Creditor velocity 2 months. Stock turnover ratio 1.5 times. GP margin 25%. Bills receivable 25,000. Bills payable 10,000. Gross profit 4 lakh. Fixed asset turnover ratio based on COGS 4 times. Opening stock is 10,000 less than closing stock. 10,000 less. They have asked us to calculate sales, COGS, sundry debtor, sundry creditor, closing stock and fixed asset. I don't think so I'll be doing this. You will be doing it, but you first go through it and then I'll explain and then you start doing it. Go through the question. Okay, I'll start explaining it. It is a fairly simple question and I hope you'll be able to do it. First is ask for sales. Which ratio will give me sales? Gross profit ratio. GP by sales equal to 25%. GP is given in the question. Listen for 2 minutes and then you start doing it, please. GP by sales. Once you get sales, sales minus GP is COGS. That is part 1 done. Sundry debtor, which ratio will help you? Debtors velocity 3 months. Debtors velocity 3 months. Is there any cash sales, credit sales component here? No. So nothing is given. So it's entirely credit sales. Entirely credit sales. So whatever sales figure you got, entirely credit sale. Tell me the formula for debtors turnover ratio. Credit sales by average debtor inverse. Average debtor by credit sales into 12. into 12 is equal to 3. This will give you average receivables. Let's call it as average receivable. From the average receivable, remove the bills receivable, you will get sundry debtor. Remove the, because what is receivables is debtors plus bills receivable. Debtors plus bills receivable. Specifically, they have sundry debtor and they have given bills receivable. If they don't give bills receivable, whatever you calculated is sundry debtor. Whatever you calculated is sundry debtor. That is average. But I cannot split opening, closing around. So that is equal to as it is. Okay. Then sundry creditors. Sundry creditors, we are going to do it through which ratio? Creditors velocity. Creditors velocity. For doing creditors velocity, my formula is average creditors by credit purchases into 12 is equal to 2. But in order to do this, I need purchases figure. How will I get purchases? COGS is equal to opening stock plus purchases minus closing stock. How will I get opening and closing stock? This adjustment. Opening stock is 10,000 less than closing stock. How will you get average stock? Stock turnover ratio. COGS by average stock. COGS by average stock will give you average stock, opening and closing. Opening and closing. Fixed assets through which ratio? Fixed asset turnover ratio, very crystal clear mention in bracket what? Based on COGS. If they don't mention that, fixed asset turnover ratio is sales by fixed asset. But they are saying here it is based on what? COGS. Based on COGS. Clear? Any doubts on this? You'll be able to do it. If you want, I will do it together. Else you'll be able to do it. Okay, you do it in your notebook. I'm doing it in the screen. You refer the screen whenever you want. Otherwise, you keep doing it in your notebook. You keep doing it in your notebook. Refer the screen if you want. You keep doing it. Refer only in case you get a doubt. Refer the screen. Otherwise, keep doing it. Sales 16 lakh, COGS 12 lakh. That's the number I get. Any stage you get a doubt, you can refer the screen. Otherwise, keep doing it. Sundry debtors 3,75,000. Anywhere you have a doubt, you let me know. This will be your stock calculation. Should be self-explanatory. We have already done these adjustments. Any place you find any error, let me know. Stock turnover ratio 1.5 times. That gave me the average stock. Opening is A minus 10,000. Closing is A. Opening is A minus 10,000. Closing is A as it is. Closing stock you get 8,05,000. Opening stock you get 7,95,000. 805,795. Okay, I'll give you another 3 4 minutes. You please close it. Everything is there. Fixed asset turnover ratio, fixed asset alone is to be done. You complete it. Refer the screen if you want, but you complete it and then we discuss. 3 4 minutes more for you. So I've already done the four calculations. First one was sales and COGS, self-explanatory. GP margin 4 lakh by 25%, 16 lakh. COGS is 16 minus 4. Sundry debtor velocity 3 month. You need not even use this formula. Debtor velocity 3 months means debtors is equal to sales into 3 by 12. You can directly also write debtors is equal to sales into 3 by 12 because debtors velocity 3 months means debtors is 3 months of sales. So sales into 3 by 12, I could have done that also directly. 4 lakh rupees minus 25,000 bills receivable. Creditor velocity is 2 month. Creditors is 2 months of purchases. 2 months of purchases. Purchases into 2 by 12. You could have directly used this also. How will I get purchases? Using the opening and closing. Inventory turnover ratio. COGS by average stock. Average stock is 8 lakh. Opening is closing minus 10,000. Closing is A. Opening is A minus 10,000. You get A as 8 lakh 5,000 which is closing. Opening is 795. With this we got purchases 1210. To creditors is 201. In that remove bills payable. Sundry creditor is 191 667. Apart from that, fixed assets using fixed asset turnover ratio, but they're very clear that you have to do it on the basis of COGS. So fixed asset turnover ratio is equal to COGS by fixed asset. 4 is equal to 12 lakh by fixed asset is equal to 3 lakh. If this line was not given, we would have taken it as on sales only. On sales only. Any doubts on this? Any doubts on this? I'll not have the time to discuss the next question. What I'll do is that homework question which I said, I'll discuss how you need to do because I feel maybe some challenge will be there. And at home, you complete the question. This was the question. It's a slightly lengthy question. They have, it's a listed company presented below the abridged financial statements below. They have given the income statement starting from sales going on till PAT, page 13. No need to look at it in your notebook. You look at the screen itself. PAT. Then balance sheet is given for the last year. Equity capital, reserve, secured loan, unsecured loan, everything. They have asked us to company has set certain standards for the upcoming year. Upcoming year is future year. In the future year, equity capital will be equal to reserves. Net profit ratio is given. GP ratio is given. Long term debt to equity is given. Debtors turnover, creditors turnover based on COGS, and inventory is 70% of opening inventory. Technically, with this, I can prepare a full balance sheet. They have not asked for a balance sheet. If they ask balance sheet, that is the third segment of the chapter, which I will be discussing later. Calculate inventory turnover ratio in days. In days for current year. In days means inverse of the inventory turnover. For current year means you use here COGS is given here. Average stock is equal to closing stock. I don't have data. Current year means whatever year has gone by. So stock by COGS into 360 or 365 depending on the data given in the question. Then receivable turnover ratio again in days. Receivable turnover ratio is you have to inverse the formula. You have to inverse the formula. Normally we do credit sales by receivable. You have to do receivable by credit sale into 365. Projected receivable, inventory, payable, long-term debt. For projected receivable, I need the projected sales. I'll need the projected sales. Sales into 100 by 365. Sales into 100 by 365. Inventory, very simple. 70% of opening inventory. You have the opening stock. What is opening stock? Balance sheet. Balance sheet is the opening. 70% of that. Payables, COGS into 100 based on COGS into 100 by 365. How will I get sales here? This is the data. How will I get sales here? That was the only discussion point. For which net profit ratio is there. Okay, net profit ratios, net profit by sales. How will you get net profit? How will you get net profit here? Okay, you haven't looked at the full question, but at home when you look at, you'll understand. There is this opening balance sheet given, and they have said equity share capital to reserves will be 1 time. Using this ratio, I'll calculate the closing reserve. Capital does not change, reserves can change. Increase in reserve is equal to profit for the year. We have done this as part of MCQs. Increase in reserve is equal to profit for the year. Divide by the, using that, get whatever you want to do. Balance is self-explanatory. Balance part you can complete. This is a good question. If they could have asked for the detailed balance sheet, if they had asked that, then I would have done it as part of the later sections. Clear? Any doubts on this? With this, I'll end today's session. Question 14. Team Limited provides you the following information: 12.5% debt, 45 lakh, debt to equity ratio 1.5 is to 1, return on shareholders fund operating ratio, operating expenses to COGS, tax rate, fixed assets, current ratio. You are required to calculate interest coverage ratio, gross profit ratio, and current assets. Three requirements to the question. Nothing much for you to read. I'll quickly explain and then we start doing it. They have given 12.5% debt, 45 lakh. Moment you see an interest rate being given, it can help you in calculating interest amount. That could be the purpose of this. Interest amount can be calculated. Debt to equity ratio, the formula is debt divided by equity. Debt is given in the earlier row, so equity can be calculated with the help of that. Return on shareholders fund, what is the formula for return on shareholders fund? ROE, shareholder fund is ROE is equal to PAT or EIS, assuming preference is not there, PAT divided by equity. So, first item will give me interest, second item will give me the equity value, third item will give me the PAT, third item will give us the PAT. Using the tax rate, you will get PBT. Using the interest, you will get EBIT. Using the interest, you will get EBIT. Operating ratio 85% mean what? What is the meaning of operating ratio? COGS plus operating expenses 85% of sale, and the balance operating profit is 15% of sale. Balance is operating profit from sales. If you deduct COGS, you get gross profit. If you deduct operating expenses, you get operating profit. So if operating ratio is 85%, balance 15% is the operating profit. Operating ratio is the COGS and operating expenses. COGS and operating expenses. So from sales, I deduct COGS, I get gross profit. I deduct operating expenses, I get operating profit slash EBIT. So operating ratio 85%, balance 15% is the operating profit. And whatever is the operating expenses, 2 is to 6. 2 times is operating expenses, 6 times is COGS. Tax rate is given, fixed assets and current ratio. We are required to calculate interest coverage ratio. What is the formula for interest coverage ratio? EBIT divided by interest will come in my income statement. Then gross profit ratio, GP by sales, again in the income statement. And they've asked for current asset. We'll see how to get current asset. There's an item of current asset which is asked in the question. Let's start doing it now. Income statement. Income statement. They have not asked for income statement, but without doing income statement, will not be in a position to close this question. Particulars calculation amount. Income statement. Sales less cost of goods sold gross profit, sales less COGS gross profit. What do we deduct after this? Less operating expenses. We get EBIT, other name is operating profit. EBIT, other name is operating profit. Operating profit less interest, EBT less tax, EAT. This will somewhere give us the required information to calculate interest coverage ratio as well as to compute your GP ratio. Current assets, we'll see how to get. For the first information we can calculate. Yeah, participate guys. What is the first information? I'm not able to hear anything. Interest. The first line itself has the interest expense. 12.5% debt. 12.5% debt. Interest 45 lakh into 12.5%. 5 lakh? 562, 500. Interest is 562, 500. Any doubts on this? Second, they have given debt to equity ratio. Let's do a note 1. This will give me equity. What is the purpose of equity? Return on shareholders fund. Come down, note 1. Computation of equity and PAT. Equity and PAT. Note 1. Equity and profit after tax. Equity and profit after tax. Alright, debt by equity is equal to debt divided by equity is equal to how many times they've given? 1.5 by 1. 1.5 times, or you can say 1.5 also, not by 1 is not needed. Debt by equity is 1.5. Somebody keep unmuting. Who is this? How much is the debt component? 45 lakhs by equity equal to 1.5. Tell me the equity component. Equity is 30 lakh. Equity is 30 lakh. Any doubts on this? Equity component is 30 lakhs. Then ROE, return on shareholders fund. ROE, return on shareholder fund is equal to PAT by equity. Return on shareholder fund is equal to PAT divided by equity. PAT divided by equity. PAT by equity. How much is the return given for shareholder fund? Sorry? Okay, 54% is equal to PAT by 30 lakh. You can call it as PAT, you can call it as EAES. That is okay. Both are same because there's no preference dividend here. Tell me the profit after tax figure. 16 lakh 20,000. PAT is 16 lakh 20,000. Any doubts on this? Can you proceed? So I write it here 1620. Note 1. What's the tax rate given in the question? EBT is 100, tax is 25, EAT is 75. Tell me the EBT number. EBT 100, tax is 25, EAT is 75. How much? 21 lakh 60 minus 540. 2160 and minus 540. A very good problem. Does test understanding of multiple ratios. 540. Any doubts on this? Can we proceed? Reverse working operating profit 2160 plus 562 500. Reverse working 27 lakh. Clear? Any doubts on this? 27 22 500. Can we proceed? Note 2, computation of sales. Computation of sales. Operating ratio in bracket COGS and operating expenses. Operating ratio in bracket COGS and operating expenses is 85% of sales. Is 85% of sales. Hence the balance 15% is operating profit. Balance 15% is operating profit. Balance 15% is operating profit. Clear? 27 22 500 is equal to 15% of sales. How much the sales? 1 crore. 1 crore 81 lakh 50,000. 1 crore 81 lakh 50,000. Any doubts in this? Sales number is 1 crore 81 lakh 50,000. 181.50. 181.50. Now, whatever is that 85%, which is your COGS and operating expenses, COGS and operating expenses, that 85% is in the ratio of 2 is to 6. In the ratio of 2 is to 6. Ratio of operating expenses to the COGS number. 1 crore 81 lakh 50,000 into 85%, whatever number you get, that has to be split in the ratio of 2 for operating expenses, 6 for COGS. 1 crore 8150 into 85%. What is 85%? The expenses. That has to be split in the ratio of what? 2 is to 6. So into 6 by 8. 6 is COGS and 2 is operating expenses. 6 by 8 and 2 by 8. This is how much? 1 crore 15 lakh 20,625. 65 79 375. 38, 56, 875. This will answer two requirements of the question. One is your interest coverage ratio, and second is your GP margin. Any doubts on the income statement? Any doubts on the income statement? Can we proceed? Any doubts on the income statement? Clear? Done? Note 3 solution. Solution. Any doubts till this? First is interest coverage ratio is equal to interest coverage ratio is equal to EBIT by interest. How much was the EBIT number? 27, 22, 500. Interest number is 562, 500. 27, 22, 500. 562, 500. How much? 4.84 times. 4.84 times. Clear? Second item, GP ratio, gross profit ratio is equal to gross profit by sales. These are very simple adjustments. $65, $79, $375. Tell me what is the percentage? 36.25%. The two ratios are done. Third ratio is where a little bit of a challenge will come. Any doubts till this? Can we proceed? Done. Third ratio is current. Okay, current asset is to be not ratio. Current asset is to be calculated. How can I calculate current asset? Using the which one? Current asset is debt plus where is the current liability? Okay. Okay. So one way of is visualizing the balance sheet. In the balance sheet, what will happen is total liabilities is equal to debt plus equity plus current liability. In the asset side, you have fixed assets and current asset. What is current asset? 1.8 CL. You equate both, you will get answer to CL. You will get answer to CL, and using CL you can get the current asset. Using why 1.8 CL? Current ratio is 1.8 times. Current ratio is 1.8 times. So now write. There are other ways of getting it, but I think this looks very simple. Equity plus debt plus current liabilities is equal to equity plus debt plus current liability is equal to fixed assets plus current assets. Total liability is equal to total debt. There are other ways of total liability, sorry, total assets is equal to total liability. There are other ways of getting it, but this looks simpler to me. Equity plus debt plus current liability is equal to fixed assets plus current asset. How much is the equity value? Debt value? Current liability we don't know. Current liability we don't know. Fixed asset how much? And current asset is 1.8 CL. Please solve and tell me the CL number. 1.8 CL. Current asset is 1.8 times of current liability. How much you're getting? 45, 50. Current liability is how much? 45 lakh. Current assets is 45 lakh into 1.8, 81 lakh rupees. Any doubts on this? 45 lakh into 1.8, 81 lakh rupees. Clear? Can you proceed? There are other ways of getting it. I think I would have done a capital employed. Yeah, capital employed object way. Okay, whichever way you get, your answer is going to remain same. Any doubts on this? Clear? Okay, let's move to question 15. I think it's exactly same as that one homework question which I said you to do yesterday. Not sure if you have done it or not done it, but this is exactly the same. I should have ideally removed that question. No, it just got copy pasted. But here something else additionally is also asked. Let's first quickly go through it and then we'll start doing it. RONOC Limited is a listed company facing cash crunch situation since a while. The CFO is of the opinion that excess stock maintained as per the instruction of the management of the company is a reason for cash crunch. Management states that its product line requires larger amount of inventory due to greater variety of product line. Customer may ask for any type of product. To maintain competitive advantage, company should be able to cater to customer needs as and when required. Management is highly critical of the collection team as the management feels that they are not collecting the receivable within time as per the industry standard. You have been hired by the company as a financial consultant. Management has provided you the latest audited financial statement. Income statement is there, balance sheet is there, and some industry standards and some future expectation. And here they've asked, this is an MCQ based question, case scenario. I'll explain how we are going to do, but case scenario is almost similar to a normal descriptive question. Nothing really changes. First you go through this, I give you 2-3 minutes, just go through full question and then I start explaining it again. 2-3 minutes for you. Okay, let's quickly discuss now. First of all, any case scenario based question, which will obviously face an exam also, MCQ part. First, you read the requirements of the question and then start reading the case study. This is a rule you should ideally follow in any subject. First, read the requirements. If it's a very simple, not a very lengthy case study, you can read the case study and then the requirement. But if it's a lengthy, more than a page or so, read the requirements. Requirement is what is inventory turnover ratio in days, and whether assertion of CFO is correct. CFO has made some statement, I think we'll have to see that. And what is inventory turnover ratio in days is to be calculated by us. What is receivable turnover ratio in days, and whether management assertion is right. So management has also made some point and we'll have to see on receivable. What is the expense company needs to incur for earning 1 rupee of revenue in the last year? Expense incurred to earn 1 rupee of revenue is nothing but technically called as operating ratio. Technically it is called operating ratio. Why is it called operating ratio? Because operating ratio includes all expenses. COGS is included, operating expenses is included. All these are incurred to earn the revenue. What is projected net working capital of the company? Projected net working capital is future working capital they've asked. And what is the projected long term debt of the company for the next year? Some 5 requirements are there. Now coming to the question, they have given me an income statement, sales, COGS breakup and all they've given. Gross profit is there, operating profit, non-operating income, non-operating expense, PBIT, interest, PBT, tax, and then PAT. Normally, operating profit is otherwise called as EBIT, but here there are some non-operating expenses. They've indicated something, not sure, we'll see. And a balance sheet is given, and below this, industry standards. What is the reason for giving this industry standard is, in the beginning, the CFO is saying that we are having cash crunch because we are maintaining excess stock. Excess stock maintained as per the instruction of the management is the reason for cash crunch. Now, whether it is excess or not, I can answer by calculating inventory days and checking the same with the industry standard. If industry is at 100 days, inventory turnover 100 days industry, and we are at 150, 160, 170, it means there is some problem with our company. Same way, management is saying no, no, inventory is not the problem. The problem is the management feels that receivables are not getting collected as per the industry standard. Industry standard for receivable is 90 days. We'll have to check whether our company is more than 90, less than 90, nothing on payables, nothing on net asset turnover. Third was how much expenses do we incur to earn 1 rupee of revenue? Somewhere using this, we will do the calculation. Normally, we do not consider non-operating expenses and all in the calculation. We'll see in the MCQ option. Fourth one is projected net working capital. Just give me a minute. Okay. Projected net working capital is you will have to estimate what will be inventory, what will be receivable, what will be cash and bank, what is short term investment. I'll explain what will we do with that. Creditor, you will have to forecast all of this and get the net working capital. And also, the question is asked for what will be the projected long term debt of the company for the next year. Five requirements in the question. A good problem. I am not sure if you have already done that homework question. If you have done it, then this will look exactly similar, but with some extra adjustment. Working note one, computation of inventory turnover ratio. Computation of inventory turnover ratio. Being in MCQ form, these workings can go in any way, doesn't really matter. You need not exactly do the working. Now, they've used the term inventory turnover ratio, but they're saying in days. Ratio is normally in times. Days means inverse the formula. Days means inverse the formula. Inventory turnover ratio, or let me call it as inventory days. Inventory days is equal to average stock divided by COGS into 365. 360 or 365, if at all they mention anything. Have they mentioned any number of days? Okay, 365. 365. Can I calculate average stock here? Yes. How will you calculate average stock? You can calculate. Look at the income statement. Look at the income statement. Opening stock, closing stock is there in the income statement. In the income statement, there is an opening stock and closing stock. In the balance sheet, it is not there. In the balance sheet, it is not there. In the income statement, you find an opening stock and a closing stock. So ideally, yes, I can calculate it. I hope they would have used this in case, because it's an MCQ form. In case they have not used average, then we'll do closing and close it. But looking at the data, I can do the average stock. There is an opening stock and there is a closing stock. 23 lakh. Where have they given? Okay, sorry. Then. They've said the company has set certain standards for the upcoming, but this is for the upcoming year. Uh, Next year projection, they have done it on the basis of closing figures in the financial statement. Let's do average. If the option is not there, I'll change the calculation. I feel average is to be done. We'll change the calculation if not there. 23 lakh plus 3860. This is the average stock. How much the COG is given in the question? Into 365. If the answer does not match, I will change the value to closing stock. 147 days is what I'm getting. Yeah, we'll change it. Matlab, I still feel it has to be this way, but in MCQ, I don't have a choice. I'll do it on the closing stock. I'll do it on the closing stock. Do it on the closing stock alone then. Only on the closing stock. 184.41 rounded off to 185 days. 185 days. That is there in the choice. 185 days. Can be average stock. I still feel it has to be average only, but TK will go with whatever the question has done. Any doubts on this? Can we proceed? What is the CFO saying about inventory? In the first para, what is the CFO saying about inventory? We are having cash crunch due to what? Excess stock. Industry is at how many days? 100 days. We are at 185. So yes, he is right. His point of view is right. 185 days. Assertion of CFO is correct. Assertion of CFO is correct. 185 days we are at. 185 days we are at. And the assertion of CFO is correct. Any doubts in this? Now, whenever you solve MCQ, you will have to think about, in case you are not able to solve, an elimination route also. What is elimination route? What did the CFO say? Is the stock excess or lesser? Excess. 150 days answer is not possible then, because if it's 150 days, his assertion is correct. 150 days means his point of view is right. What the option says? 150 days assertion of CFO is incorrect. This together cannot happen. If it's 150, his point of view is right. If it's 150, his point of view is right. I don't know the answer. I'm just telling you the logic. 150 days and assertion of CFO is incorrect. Together cannot work. Together cannot work. So D is eliminated. D is eliminated. If answer is 150, you had solved answer and you got 150, then you would have concluded, yes, CFO is saying right thing. But here they are saying 150 with CFO saying wrong doesn't make sense. Then 100 days assertion of CFO is incorrect can be logical, because 100 days means we are not having excess, which means CFO point of view is not right, because CFO is saying what? The inventory is on the higher side, and these two options can also be right. So A, C and B, 3 can be right option. D is straight away eliminated. D is straight away eliminated. Thinking logically, B also would get eliminated, because mostly it may not match the exact number, but as of now D got eliminated. In case you are not able to solve a question, go and choose one of the 3. There are many questions where in the elimination route itself you would have eliminated lot of option and you will be left with only one option many times. So elimination route is basically removing option which can't be the right answer. Rather than trying to solve the question, I try to find alternative. Even in your auditing subject or in your SM subject, when you see options, you are not able to solve the question straight away. Go to the option, eliminate the choices which can't be the right answer. Then obviously if you eliminate and bring it down to 3 or 2, still not able to do, choose one of the 2 and go ahead. A little bit of luck factor, 50% probability of success and 50% failure. But try eliminating choices. That is a easier way of answering any times an MCQ question. Clear? Any doubts on this? Next, note 2, computation of debtor turnover ratio. What is the industry number for debtor turnover ratio? 90 days. Listen, I think this should be 100 days. This should be 100. 117, I'm yet to solve anything, okay? 117, assertion of management is correct. What is the management saying about inventory? Participate, guys. What is the management saying? Not collecting the money on time. So management is thinking receivable is on the higher side. CFO is thinking inventory is on the higher side. CFO part we have analyzed here. Now we are coming to this. In this, tell me by elimination route which option you can eliminate. Which option can you eliminate? 85 days. If the answer comes, then management point of view cannot be correct. Management point of view cannot be correct. Answer can be 85, which is option D. 85 days and assertion of management is not correct. That option is possible. But with 85 days, why 85 days management option is not right? Because management said we are having excess receivable. Industry is at 90. If my company is at 85, if my company is at 85, it means I do not carry excess receivable. If I do not carry excess receivable, management conclusion is wrong. Clear? Any doubts on this? We have eliminated. Is there a confusion? We have eliminated option C. 117 days management view can be right. 100 days management view can be right. And 85 days management view can be wrong. These three still remains. These three still remain. But one option is eliminated by us. Anyway, I'll do the detailed calculation now. But one option got eliminated. There are questions where you'll be able to eliminate three options and choose the right answer also. Choose the right answer also by doing the elimination route. Any doubts on this? Any doubts on this? Clear? Next, let's do the calculation now. Debtor days is equal to closing debtor by credit sales. Closing debtors by credit sales into 365. How much is the closing debtor? Sorry, 39,97,000. Credit sales 1 crore. Entire sales is taken as credit into 365. 117 days. 117 days. Any doubts on this? So 117 will indicate management point of view is correct. Any doubts on this? Clear? Can we proceed? What is the expense company needs to incur for earning 1 rupee of revenue, which is technically called operating ratio, which is technically called operating ratio. What is operating ratio? Is how much expense are we incurring to earn 1 rupee of revenue. If you remember in your costing, when we did cost sheet, we will not consider items like interest and all there, because costing was only focused till operating profit. That is why expense incurred to earn 1 rupee revenue is technically called operating ratio. Balance interest and all is not an expense incurred to earn revenue, that we had to take a loan and other reasons. Now, right, operating ratio is equal to COGS plus operating expenses divided by sales into 100. So into 100 is not needed. We'll just do 1 rupee they've asked. COGS for 1 rupee they've asked. COGS plus operating expenses. COGS plus operating expenses by sales. How much is COGS? 76 lakh 40. Operating expense. Non-operating ideally will not come in the calculation. Divided by 1 crore 25 lakh. 0.844, which is your option A. 0.844. Here I will not be in a position to eliminate anything, so we have done this. 0.844. Any doubts on this? Can you proceed? Okay. What is the projected net working capital? What is net working capital normally? Working capital means operating working capital. There are two types of working capital. One is called operating working capital and second is called normal working capital. If you see in this calculation, we have this item like short term investment, short term loan. All this is not part of working capital of a company. They are technically not part of your accounting standards. Say that you will have to disclose them as current asset and current liability, but they are not part of operating capital of the company. They are not part of the operating working capital of the company. So I have to estimate what will be inventory, what will be receivable, what will be cash and bank, what will be creditor, and find out the difference. Find out the difference. Again, I'm repeating, logically speaking, your short term investment and short term loan, short term investment and short term loan is not part of the operations of the company. Even when you go to the bank and say that please give us a loan, bank will say let me first eliminate your short term loans, let me eliminate your short term investment, calculate how much is your working capital requirement, against that I'll give you loan, against that I'll give you loan. And this ST loan could be that bank loan also, we are not sure, it could be that bank loan also, but short term loan and short term investment will not form part of the operating working capital of the company. In case I do not get the right answer, maybe I'll include these two and then see the answer, but ideally these two will not be included. Next, projected net working capital. It is assumed, it is assumed that networking capital is networking capital is operation related, is operation is company sales related, purchases related, and does not include, it's operation related and does not include short term investment and short term loan. In fact, most of the question, this confusion will not be there because these items will not be there in the question. This question they have given it, so I'm discussing here. Short term investment and short term loan does not include short term investment and short term loan. Net working capital is equal to inventory. In the balance sheet, what are the other items there? Inventory is there, then what is there? Receivable, cash, creditors. This is not for the last year. Projected next year I have to project and write. Last year calculation they have not asked. Okay. Projected net working capital is the requirement. Any doubts on this? Leave one line where we will we'll come back and write all of this. We'll have to now first calculate inventory, calculate receivable, calculate cash, calculate creditors, and then come back. And then come back. It's a very good problem. This adjustment is a very good adjustment. Inventory, receivable, cash, and creditor. Any doubts till this first? Inventory is very simple. How much is the next year inventory? 70% of the opening inventory for the next year. For the next year, it is going to be 70% of opening inventory. 70% of opening inventory. So very simple. How much was the inventory last year? 38 lakh 60,000 into 70%. 27 lakh 2,000. 3860 into 70%. 27 lakh 2,000. Any doubts in this? Next, I have to estimate debtor. Debtor is 100 days. 100 days. For debtors, I need sales, and I had discussed this in the last session. We'll do it now. I have equity share capital reserve so much? One time, which means next year reserve from 18 lakh will go up to, and that increase in reserve is the net profit. Increase in reserve is the net profit. Next item, closing reserves. closing reserves equal to 30 lakh, closing reserves equal to 30 lakh in bracket equal to equity, closing reserves equal to 30 lakh in bracket equal to equity. Profit of next year is equal to increase in reserve value, increase in reserve. Profit of next year is equal to increase in reserves, 30 lakh minus 12 lakh, minus 18 lakh, sorry, minus 18 lakh, 12 lakh. Profit of next year 12 lakh. Any doubts on this? Sales computation. Which ratio will help me in getting the sales? How much is the net profit margin? Net profit equal to 15% of sales equal to 12 lakh. Tell me the sales figure. Net profit equal to 50% of 15% of sales, 80 lakh. Any doubts on this? Net profit equal to 15% of sales, 12 lakh rupees. Sales is 80 lakh. Any doubts on this? Okay, at this stage, I'm giving you 3-4 minutes. Close receivables, close cash, close creditors, complete this, and then do the long term debt also. 3-4 minutes for you to close even the long term debt part. Okay, once you are done, we will discuss. Any doubts till this? Any doubts on this calculation? Please take around 4 minutes and close this question now. Okay, we have calculated sales. Question says receivable. Receivable is 100 days. Receivable is 100 days. So what we can do is receivable days is equal to receivable days or debtor days is equal to your debtors, closing debtors by sales into 365. How many days they gave? 100 is equal to debtors by 80 lakh into 365 and debtors is equal to 80 lakh into 100 divided by 365. 80 lakh into 100 by 365, that is the debtor figure. Debtor figure is 80 lakh into 100 by 365. 21 lakh 91,781. 2191,781. Some of you, I'm not sure why you have not done this. Is there any confusion here? Is there a confusion in this calculation? Clear? Can we proceed? Then cash, I think they said it remains same. Cash balance is assumed to remain same for next year, and creditors is on COGS. Normally creditors is on purchases. Here it is on COGS. Next, creditors is equal to COGS into 100 by 365. Directly you can do this, or you can expand like what I've done earlier. You can, last part also I could have said debtors is directly sales into 100 by 365. This is what I told you even in the previous session. You can directly take it as 100 by 365, or you do a detailed calculation like I did in the previous one. COGS is how much? Sorry, 40 lakhs. 50% profit, gross profit, 50% COGS. 40 lakh into 100 by 365. 100 by 365. 10 lakh 890, 890 or 891, we'll see. 890 is the number. 890.4 something. Any doubts on this? Any doubts on this? In case there is anywhere a challenge, you will have to tell me, because in case speed becomes an issue also, you will have to tell me initially so that I fine tune the speed. You should have got used to by in the costing, but okay, still at any place you want me to slow down, you'll have to tell me. Any doubts on this? Any doubts on this? Can we proceed? So my net working capital is now 27 lakh 2000, 2191 781, 1095. Sorry, cash is how much? Plus 2 lakh 30, plus 2 lakh 30 minus 1095 890, minus 1095 890, 890 should be there in one of the choices. If not there, maybe ST loan and ST investment I'll adjust, but I don't think so. That has to be considered here. 40 27 891. Any doubts on this? Any doubts on this calculation? Can we proceed? Any doubts on this? And last is, what is the projected long term debt using this ratio? Long term debt by equity, if you have not written, you can write long term debt by equity is 0.5. Long term debt by equity is 0.5. Equity share capital plus reserves. Equity is share capital plus reserves and surplus minus any fictitious asset. No fictitious and all. How much is the equity capital? Reserves also 30 lakh. Next year number 30 plus 30. 30 plus 30. Share capital 30 lakh. Reserves also 30 lakh. Any doubts on this? Any doubts on this? Clear? So we get long term debtors 30 lakhs. Any doubts on this? A slightly extended question. In this, I feel inventory turnover, still my belief is it should be average stock, but they have taken closing and done it. Any doubts on this? Any doubts on this? With this, the first segment of the chapter gets over, where our focus was using the information, calculate ratios. We were calculating ratio. Any ratio you have any confusion, you will have to tell me now. Any ratio, any confusion is there. Clear? Can we proceed? Can we proceed? Any doubts in any of the items? Okay. Now I'm going to discuss an area called ROE as per Dupont framework. Now we have learnt about multiple ratios and all. We learnt about liquidity ratio, profitability ratio, asset turnover ratios. Multiple categories have been learnt by us. In that, one of the ratio was ROE. What is the formula for ROE? EA ES by equity. EAES by equity. For all practical purpose, EAES is PAT. Preference is very rarely there. So you can say ROE is nothing but PAT by equity. Now, Dupont is a person who came out with some analysis here, and he said that your ROE can be improved. ROE can be improved. Either you improve profits or you reduce equity. But then he said this is not so easy for a person to do. So we are now going to look at sub segment of this ratio. The formula is PAT by equity, but he said I'll break it into 3-4 parts, and if you can improve one of them, automatically ROE will go up. ROE is a very important ratio from a shareholder point of view. So what he said is you do PAT by sales. First thing he said is do PAT by, he's breaking that ratio, PAT by equity as PAT by sales. What is, which ratio is PAT by sales? Net profit margin. Net profit margin. Then he said you do into sales, so that sales and sales is cancelled, because sales is nowhere in the formula. In the formula of ROE, you do not have sales. You have what? PAT by equity. He said we will have the formulas PAT by equity, but let's write the sub segments. What are the sub segment? PAT by sales, which is what? Net profit margin. Then he said sales by asset. So sales and sales is cancelled. Sales and sales is cancelled in the formula. Which ratio is sales by asset? Asset turnover ratio, total asset turnover ratio, total asset turnover ratio. Then he said, write asset again. Asset and asset is cancelled. Asset and asset is cancelled. And the denominator for this was called equity. We have not learnt a ratio like this till now, but he added this ratio. Formula is backed by equity, but Dupont framework said, let's not keep it so simple. Let's call it as net profit margin into asset turnover. The third item is technically called equity multiplier. I'll explain as we proceed. So he said ROE can be improved if you improve one of these three items. Either improve net profit margin. Bharadwaj Institute not able to improve profit margin. No problem. Improve asset turnover. Asset turnover is more utilization of the asset and do more sales. Not able to do that. Improve equity multiplier. All the three improves. Automatically ROE will go up significantly. One of the three improves. One improves, another deteriorate. Then ROE can go up or go down. So instead of saying that you have to improve ROE, you have to improve ROE, he said no. ROE has three sub segments. First subsegment is net profit margin. If an organization can improve net profit margin, automatically ROE will improve. If you are not able to improve net profit margin, which is possible, no problem, then go ahead and improve asset turnover. There are certain businesses where profit margins cannot be increased because competition and all is too much. They will focus on improving asset turnover. You cannot improve asset turnover, improve the equity multiplier. But the third one is little risky. This formula we have already seen, but it was inverse. We saw a formula called proprietary ratio, which is proprietor fund by asset. This is asset by proprietor fund. What this basically means is my asset is 1000, my equity is only 200. With my 200 rupees, I could buy asset of 1000. How did I buy that? Borrowing, creditor, all put together. So with 1 rupee of equity, you multiplied and made it 5 rupee of asset. With 1 rupee of equity, you multiplied and made it 5 rupee of asset. Today I want to buy a car. Car cost is 10 lakh rupee. I need to put only 1 lakh rupee. 9 lakh rupee will come in the form of a loan. So with my 1 lakh equity, I can buy an asset of 10 lakh. So I did a multiplier of 10 times. This is little bit on the riskier side. If you increase the multiplier, what will happen is you are having a lot of borrowing. Business can suffer suddenly. But there are three segments. Part by sales, sales by asset, asset by equity. A question may say calculate ROE as per Dupont framework. If they ask ROE as per Dupont framework, what you need to do for ROE as per Dupont framework is you will have to write this three sub segment and then do the multiplication and calculate the ROE. Can I directly calculate ROE? Will the answer be different? No, answer will be same only. Whether you do PAT by equity or you do PAT by sales, sales by asset, asset by equity, answer cannot change. Answer cannot change. Answer is going to remain same. The only difference here is you are going to expand it and write the three sub segment. So this is what he said. ROE is equal to net profit margin, asset turnover, equity multiplier. Equity multiplier. Why this breakup is needed? If an organization cannot improve something like ROE directly, they can analyze the three subsegments and try to improve one of them. Some organization may improve net profit margin, some may increase asset turnover, and some may increase equity multiplier. Now, this is a very simple example. Net profit margin 10%, asset turnover 2 times, equity by asset is 0.5. Equity by asset is 0.5. I want asset by equity, not equity by asset in the formula. What is ROE? Net profit margin 10% into asset turnover 2 times. I wanted asset by equity. What they have given is Equity by asset, no problem, into 1 by 0.5. 1 by 0.5. That's all. This will give me the ROE number. This will give me the ROE number. Clear? Able to understand this? The formula is very simple. Why did this come into picture? This is just to do better analysis from a management point of view. Some businesses, they focus on increasing asset turnover. There are a lot of companies which will say, let us reduce our profit margin but do more sales. Why they are focusing on more sales? Improve asset turnover, reduce NP margin a little bit, improve asset turnover, improve equity, or keep the equity multiplier intact. You will still be able to improve your ROE. You will be able to improve your at the end of the day, how much extra are we earning on the capital contributed, or how much are we earning on the capital contributed matters. Some businesses, wholesale businesses, focus on asset turnover. They'll say margin can be lesser, but asset turnover has to be higher. Retail business focuses on profit margin. They are not bothered about the more sales. They are saying sales can be lesser also. When you go to a retail shop and you buy any product, they'll not give you any discount at all normally. But if you buy for 10,000, 20,000, 30,000, 40,000, they'll say we'll give you discount. Because discount is coming, reason is they are saying NP margin can go down, but asset turnover has to go up. Asset turnover has to go up. If I am able to do more sales, I will be able to improve asset turnover. If you cannot do more sales, then less sales but more profit. Less sales and more profit. Any doubts in this? Can you give me the ROE for the below example? Okay, I think same. Just give me a minute. Okay, I will do it. I'll do it. I'll do it. Net income 10 lakh. Net profit margin is 5%. Net income 10 lakh. Net profit margin is 5%. Can you tell me what is the net profit amount? 10 lakh into 5%. 10 lakh into 5%, which is how much? Equity by asset is 0.4. Can you calculate equity? Equity by asset is 0.4. Calculate equity. Calculate equity. Sorry, guys. My mistake. Net income is directly 10 lakh. Net income is directly 10 lakh. I saw this as sales. Sorry. Net income is directly 10 lakh. Net income is directly 10 lakh. NP margin is 5%. Asset is 50 lakh. Equity by asset is given 0.4. We have to calculate three things: NP margin, asset turnover, equity multiplier. So NP margin 5%, asset by equity is inverse of 0.4. Asset turnover is to be calculated by us. Asset turnover is to be calculated. Listen for 2 minutes. Asset turnover is equal to sales by asset. Sales by asset. Asset is 50 lakh. Can you tell me the sales figure? How much will be the sales figure in this example? Easy to calculate. How much will be the sales? Sorry? Tell me the figure. 2 crores. Net income is given. Net income is net profit. So net profit is 5% of sales. Net profit is 5% of sales. So divided 2 crores the sales. Asset turnover is 4 times. Asset turnover is 4 times. ROE is equal to NP margin into asset turnover into equity multiplier. Equity multiplier. NP margin is 5%, asset turnover is 4 times, and equity multiplier is 1 divided by 0.4. 1 divided by 0.4. What's the answer you get? 50%. If it comes in MCQ form, I can directly also write the answer. What is direct answer? You see here. This is the direct answer. calculated equity, net income by equity. That's a direct answer. In an MCQ, I can do a direct calculation, but if it comes as a descriptive question, then they'll ask you to write the subcomponents. Any doubts on this? Any doubts on this? Okay. ZX Limited has total asset of 7 lakh 20, shareholders equities 4 lakh 50, net profit margin is 12.5, asset turnover ratio is 1.5. Using the Dupont model, return on equity of ZX Limited is calculated as Dupont model means you'll have to write those three sub formula, but MCQ you can do directly also. But here I think it will be better to write all the three. Now write along with me. ROE is equal to net profit margin NP margin asset turnover equity multiplier. NP margin asset turnover equity multiplier. NP margin asset turnover equity multiplier. NP margin is given directly how much? 12 point. Asset turnover given directly. Equity multiplier. Equity multiplier. What is the formula for equity multiplier? Asset by equity 7.2 by 4.5. 7 lakh 20 divided by 4 lakh 50. Multiply all the three and tell me. 30%. This question, direct formula not possible. It will take a lot of time. Best is to do this. Direct formula means using asset turnover, you have to calculate sales. Using sales and NP margin, you have to calculate net profit. After calculating net profit, you have to divide by shareholders' equity. Rather than directly 3 multiplier. 3 formula you multiply. In that, 2 items are given directly. Any doubts on this? Clear? So this is a very simple segment which focuses on calculating ROE as per the Dupont framework. As per the Dupont framework. Any doubts in this? Okay, let's see a question on this now. Let's come to 16. A limited company's book reveal following information. Particulars amount. Net income 3 lakh 60. Shareholders equity 4 lakh. Asset turnover 2.5 times. Net profit margin 12%. You are required to calculate ROE as per Dupont model. ROE as per Dupont model. Now listen. If I want normal ROE, item 1 by item 2 there. Net income by equity. That's all. Net income by equity is the answer. Dupont means you'll have to break it into those 3 subsegments and do. Now write. ROE as per normal formula. This is not to be presented in exam. Just for your understanding. ROE as per normal formula. As per normal formula. As per normal formula. PAT by equity. PAT by equity into 100. PAT is given in the question how much? 3 lakh 60,000. Equity is given in the question 4 lakh into 100. Divided by 4 lakh into 100. This is over if you do normal calculation. ROE as per normal formula 90%. This kind of takes care of the solution. ROE as per normal formula 90%. What did the question say is, can you do it as per the Dupont model? For doing as per the Dupont model, very simple. I'll have to do the 3 parts. Net profit margin given in the question, asset turnover given in the question, and I also need to do something called as an equity multiplier. What is equity multiplier? Asset divided by equity. Asset divided by equity. For doing that, equity is given. How will you get asset figure? Net income will not give you asset figure. Using asset turnover, but for asset turnover you need sales. Where will the sales come? Using the net income. Using the net income. Next, ROE as per Dupont framework. ROE as per Dupont framework. As per Dupont framework. Note 1, computation of sales. Computation of sales. Net profit equal to how much is the profit margin? 12% of sales. Net profit equal to 12% of sales. 12% of sales. How much is the net profit? 3 lakh 60,000 equal to 12% of sales. Sales equal to 30 lakhs. Sales equal to 30 lakhs. Clear? Can you proceed? Note 2, computation of assets. Computation of assets. Net profit is 12% of sales. We got the sales figure. Asset turnover is equal to sales by assets. Asset turnover is equal to sales by asset. How much is asset turnover? 2.5 is equal to 30 lakh by asset. What is the number you said? 12 lakh. Any doubts on this? We could have straight away completed. That is what we completed. Pad by equity. It was over with that. But here you'll have to do a detailed computation like this. Note 3, computation of equity multiplier. Equity multiplier. Equity multiplier is equal to asset by equity. 12 lakh by. What this means is with 1 rupee of equity, we buy 3 rupee of assets. With 4 lakh of equity, we bought 12 lakh of assets. How that was possible? By borrowing and other things. Okay. So 3 times is my multiplier effect. And then ROE is equal to net profit margin. ROE is equal to net profit margin into asset turnover into equity multiplier. Net profit margin, asset turnover and equity multiplier. %, 2.5 times, 3 times, you will get obviously the same 90%. Same 90% will come. It does that you will have to write the sub segments. Any doubts on this? Clear? Done? Any doubts on this? Okay, now we move to the third segment of the chapter where we are going to prepare a balance sheet and income statement using the knowledge of the various ratios we have got. So this is the forecasting power of ratios. Using the ratio, you can do forecasting of P&L and balance sheet. No new concepts here. I'm going to straight away do questions. And in once I'm done with few questions, I'll tell normally used adjustment, which is described in the concept book. Let's come to 17. Balance sheet of ABC Limited as on March 31, 2015 is as under liabilities, asset, share capital, equity, preference, general reserve, debenture, sundry creditors total, fixed assets, gross block less depreciation, current assets, stock, debtor. Company wishes to forecast the balance sheet as on 31st March 2016. Following additional information is available. Fixed asset turnover ratio on the basis of gross value of fixed asset, stock turnover ratio on the basis of average stock, breakup of cost and profit would be as follow. Profit is subject to taxation. Debtors is 1/10 of sale. Creditors is 1 by 5 of material consumed. And equity dividend at 10% has been declared. You are required to forecast balance sheet as on 31st March 2016. I give you a minute or two, go through the question. Okay, we are required to forecast the balance sheet. More or less the same format the balance sheet should continue. So we are going to first write the format of the balance sheet. After the format is written, we'll try to use the ratios understanding and try to forecast different item. They have given multiple information. They have given some fixed asset turnover ratio, stock turnover ratio, breakup of cost and profit, debtor some 1/10, something, lot of information is there. Somewhere objective is to get this balance sheet again. So now write balance sheet of ABC Limited as on March 31, 2016. March 31, 2016. Liabilities amount, assets amount. Liabilities amount, assets amount. You may need some 10, 12 lines, and then we'll come down and then do the calculation. Now our objective is to forecast each of these items. In case information is there, we'll do forecasting. If not there, we may take some assumptions. So first item is equity shares. Last year was 200 lakh. Any information about any new issue of equity share in the question? Any new issue of equity share? No. We'll write the same thing. Share capital, underline that. Equity share capital 200. Equity share capital 200. Amount in lakhs. In lakhs 200. Next item, preference 7.5. Anything there in the question? Anything there in the question regarding preference, new issue, redemption, anything there? Copy paste. 100. 7.5 preference share 100. Equity copy pasted. Preference copy pasted. Clear? Any doubts? Then general reserve. Now I cannot copy paste 60. Next year they have given me data to forecast an income statement. Why will I do income statement? Income statement will give me the profit for the year, which will be added to the reserves value. Which will be added to the reserves value. In case this data was not there, then if at all no other choice, I would have copied the same reserve, which is very unlikely. But here I have the income statement data. So come down, note 1. Income statement of ABC Limited for 2015-16. income statement, particulars calculation amount. Income statement, particulars calculation amount. Now for income statement, I will start with sales, deduct material cost, labor, manufacturing expense, office and selling expense, depreciation, and balance is profit. Profit is PBT. Then there is some tax and other data they have given. We'll consider all of that. How will I get sales? Fixed asset turnover ratio on the basis of what? Gross value of fixed assets. On the basis of gross value of fixed asset, because fixed asset has two items. One is called gross block and second is called net block. What is net block? Is after deducting depreciation. In your accounting, you can either write the gross block less depreciation net block or directly write the net fixed asset. There are two types of fixed asset. And fixed asset turnover ratios on the basis of what? Gross value of fixed assets. On the basis of gross value of fixed assets, come down, leave again some 10 lines, come down. Note 2, computation of sales. Number your working notes properly. Note 2, computation of sales. Fixed asset turnover ratio is equal to fixed asset turnover ratio is equal to sales by gross fixed asset. Sales by gross fixed asset. Sales by gross fixed asset. Any information about any change in fixed asset figure in the question? No. So then I copy this. What is the fixed asset turnover ratio given? Is equal to sales by how much is the gross fixed asset? 500. Tell me the sales figure. Sales is 750. On the basis of gross value of fixed asset. Very crystal clear mention. It is on the basis of gross value of fixed asset and not the net value of fixed asset. Sales is 750. Any doubts on this? Can you proceed? Now write sales note to 750. From this we will deduct various expenses. Sales 750 for the first expense. Material cost, how much percentage? 750 into 40%. 300 less material cost, 750 into 40%. What was the next item? Labor, how much? 750 into 25%. 187.5. Labor cost 187.5. 187.5. Next item, third item is manufacturing expenses. 750 into 15%. How much? Deduct all of this gross profit. Till this is gross profit. Deduct all of this. After this is your other areas. Till this is gross profit. How much gross profit? 150 less office and selling expenses. 750 into 5%. 37.5. 750 into 5%. less depreciation. 750 into 5%, 37.5. Depreciation 750 into 5%, 37.5. Profit before tax. Profit before tax less income tax. Less income tax. What's the income tax rate? 50%. Profit after tax. Profit after tax. Any doubts in this? Now listen, this amount will not be added to reserve because out of this we have paid some dividends and all. We have paid dividend. After dividend, whatever is retained can only be added to reserves and surplus. After the dividend, whatever is left over. The question has talked about dividend. Equity dividend is paid. If equity is paid, automatically preference has to be paid. Without paying preference, you cannot pay equity dividend. So after this, leftover number is technically the retained earnings less preference dividend. What percentage is the preference dividend? 100 into 7.5%. Earnings available to equity shareholders. They have given equity dividend of last year, assuming same continues. That's the logic. That's all. They have given 10% for 2015. Logic is 2016 also same 10% has to continue. If data is there, I take it. Otherwise, I make my best possible assumption. Earnings available to equity. This also will not be added to reserve. After everything, leftover number less equity dividend. How much is the equity capital? 200 into 10%. 20. Retained earnings. This is what I retain after meeting all the requirements. After meeting all requirements, the retained portion is 10, and this will get added to my retained earnings or general reserve. This will get added to general reserve. Any doubts on this? Any doubts on this? Clear? Can we proceed? So, what was the general reserve last year? 60 plus 10. 60 plus 10, 70. General reserve 60 plus 10, 70. Next item, debentures. Anything there in the question about debentures? Any repayment of debentures, new debentures, same amount. How much? 60. Sundry creditors. Anything in the question about sundry creditor? 1/5 of material consumed. Material consumed is 300 in the income statement. In the income statement, it is 300. Material consumed is 300. So in bracket 1 by 5 of 300. 60. 1 by 5 of 300. 1 by 5 of 300. Any doubts on this? Can you proceed? This side. Fixed assets. Underline that. Gross block will continue to be 500. There is no information about any change. Gross block 500 will continue to be 500. Less depreciation. Listen, what does this depreciation mean? Is it is the accumulated depreciation. When it is in balance sheet, it's accumulated for so many years. So 160 accumulated till 2015. 2016, what is the depreciation amount? 37.5. So another indirectly your fixed asset will go down by 37.5 because you have depreciated by 37.5. You have depreciated it by 37.5. So the fixed asset figure of 340 will go down by 37.5. Will go down by 37.5. Less depreciation. Less depreciation. 160. Another 37.5. 197.5. Accumulated depreciation 197.5, and net the asset figure will go down by 37.5 and will become 302.5. Will become 302.5. Any doubts on this? Can we proceed? Any doubts on this? What's the next item in the asset side? Current asset, we have stock. Any information to calculate stock value? Stock turnover ratio is 18 on the basis of what? Average stock. So you get average, opening is there in the balance sheet, closing you are forecasting. Now, right, note 3, number your notes, note 3, computation of closing stock. Note 3, computation of closing stock. Computation of closing stock. Stock turnover ratio, COGS by average stock. COGS by average stock. COGS by average stock. How much is the stock turnover ratio? 12 equal to COGS is sales minus gross profit. 750 minus 150 divided by average stock. Divided by average stock. How much is the average stock? 50. Average stock is 50. Average stock figure is 50. Now, what is the average? Is opening plus closing by 2. Opening is there in the balance sheet. Opening is there in the balance sheet. How much is the value in the balance sheet? 80 plus closing stock by 2 is equal to 50. Tell me the closing stock. Any doubts on this? Any doubts on this? Clear? This is forecasting the balance sheet. Closing stock is 20. We have done a forecasting like this. So stock in bracket, number your notes here, note 3. From there we calculated 20. If you have calculated in a note, please write your numbered notes so that it's easy for a person to verify. 20 lakhs. Any note given on debtors? 1/10 of sales, 1/10 of 750. Clear? Any other item there, first of all, tell in the balance sheet, in the given balance sheet. In the given balance sheet. Okay. So we have forecasted, may tally, may not tally also. Some question, full information will be there, it will tally. Some question, full information will not be there, it will not tally. Tell me the liability side total. Liability side total. 490. No need to write, please listen. 490. Don't write it. Tell me the asset side total. So the final figure has to be higher of the two, obviously. So in the asset side, total is lesser. In the asset side, total is lesser. I do not have other information. Cash at bank balancing figure. Cash at bank balancing figure. Listen. In case liability had a shortfall, bank overdraft or some loans we have taken, and that is balancing figure. Here information is not there fully because cash would have come out of operation and all. They did not give balancing figure. We are taking it as balancing figure. How much is the balancing figure? And the overall total is 490. Some question complete information will be available. In that case, balancing figure is not needed. It will tally. Any doubts on this? Clear? So this is what is the other utility of the ratio, doing forecasting of balance sheet. Technically this question balance sheet and P&L both we had forecasted. Both we had to forecast. Any doubts on this? Clear? Can we proceed? Any doubts on this? Question 18. From the following ratio and information given below, prepare trading account, profit and loss account, and balance sheet of ABC company. Fixed asset, closing stock, stock turnover ratio, gross profit ratio, net profit to capital, capital to total liability, fixed asset to capital, fixed asset by total current asset. Multiple ratios straightforward continuously given. One assumption area I have written, because if I don't take that assumption, answer will not match. Answer will not match. This obviously you will not know when you do it in exam. Okay, I'm making it very very clear. You will not know all this. Why I wrote this assumption? Because I used to solve it in the class, and then I'll say no, IC has taken a different assumption. Our balance sheet is not tallying. I didn't want that headache, so I'm writing it very clearly. If at all any assumption is taken in a question, here they're saying capital to be not part of total liabilities for capital to total liability ratio. We have a ratio here called as capital to total liability. In that ratio, capital is not part of the liabilities total. Capital is not part of the liabilities total in this ratio is the understanding with which we are going to solve the question. We'll straight away start solving it. Any question, what we will normally do is if they ask for trading P&L balance sheet or whatever they've asked, first write the blank format of that. Trading account, particulars amount, particulars amount. P&L, it's a continuation there only, and balance sheet. So let's write the format one. Working note 1, trading P&L, trading account and profit and loss account. Trading account and profit and loss account. Particulars amount, particulars amount. Particulars amount and particulars amount. Trading account and profit and loss account. Trading P&L. Maybe some 10 lines or maybe 12 lines. Both the accounts are there, 12 lines. And working note to balance sheet. They have not given any year and all, so I'm not writing year. Liabilities amount, assets amount. Liabilities amount, assets amount. Objective is to close the balance sheet. Liabilities amount, assets amount. Okay, let's go with whatever information is there. First information itself, we are going to write it in the balance sheet. We are going to write it in the balance sheet, right? Fixed assets in the balance sheet. Fixed assets. How much is the value? 40 lakh. Fixed asset 40 lakh. Fixed assets 40 lakh. Clear? What's the next information? Closing stock. How much? 4 lakh. I'm not sure I'll be able to break the opening and closing, but still I'm writing here by closing stock. In case we are not able to split the opening and closing, we will write opening stock also 4 lakh. Same number. Closing is 4 lakh. Opening will also be 4 lakh in case I'm not able to break it into two. If I'm able to break the opening and closing, okay. Not able to break, then we'll write the same number. By closing stock 4 lakh. This is part of the trading account. Any doubts? Stock turnover ratio 10 times. I may use it if I do not have any other choice. What is stock turnover ratio formula? COGS by average stock. I have closing stock. If no other choice is available, I will take closing stock as average stock and close and do the COGS part. I'll park it for the time being. I may use this in case I do not find any other option. If I use that, I would have got COGS and then GP is 25%, COGS is 75%. I would have got the sales in case I follow that order. With the sales, we would have got net profit. With the sales, we would have got net profit, and net profit to capital is given 1 by 5. Using net profit, you will get the capital. Using capital, we will get the total liability, and fixed assets to capital is 5 by 4. Okay, let's use this now. Fixed asset to capital, because I know the fixed asset figure. I know the fixed asset figure. I may try the other route also. If I don't have any other choice, I'll come to stock turnover ratio. Okay, I'll come to stock turnover ratio if no other choice is there. Fixed asset to capital. Next, note 1, computation of capital. Note 1, computation of capital. Computation of capital. Fixed asset by capital is equal to. They have given the ratio. There is no ratio like this. We use it, but they have given the ratio. Fixed asset by capital is equal to, what's the number they've said? Sorry, 5 by 4. 40 lakh divided by capital is equal to 5 by 4. Tell me the capital figure. 32 lakh. Capital is 32 lakh. Number your notes very clearly. Capital is 32 lakh. The term capital does not mean share capital. Okay, the term capital basically means the share capital, reserves and surplus, preference, debt, all put together. We'll see if we can break it further later. But as of now, capital is 32 lakh. Capital does not mean share capital alone. Capital means capital employed. Any doubts on this? With the capital, I will use net profit to capital and get the net profit. Net profit. And with the net profit, I'll use net profit ratio and get the sales. With the sales, we will get COGS and then we may get average stock. Then we may break it as opening and closing rather than using the closing stock. If there was no other choice available, then I would have gone through the earlier route, because they did not give. If they wanted, they could have said average stock, but they specifically said closing stock. They specifically have mentioned closing stock. No, write this capital here in the credit side. Capital, note 1, 32 lakh. If possible, I may break it further. If I'm breaking it, I'll not write this item. I'll break. What can I break? Equity capital, preference capital, reserves and surplus. This question breaking will not be possible. Note 2, computation of net profit. Computation of net profit. Computation of net profit. Yeah. The ratio which is going to help us is net profit by capital. Net profit by capital is how much? No, what is the percentage there? 1 by 5. Net profit is 6 lakh 40. Net profit is 6 lakh 40. Net profit is 6 lakh 40. I go to the P and L. I don't know, a lot of items will come, but in the end, net profit 6 lakh 40. To net profit 6 lakh 40. Some lines may get wasted also, that's okay. Net profit is 6 lakh 40 in bracket. Note 2, number your notes properly. Note 2 to net profit, note to 6 lakh 40,000. Clear? Any doubts on this? Next item, sorry, I'm not able to, you'll have to be louder. Any doubts on this? Note 3, using net profit margin, let's get the sales. Note 3, computation of sales. Computation of sales. Net profit is equal to, what is the net profit margin given in the question? Net profit equal to 20% of sales. Net profit equal to 20% of sales. Sales is 32 lakh. Good, we did not use the other route. Other route will not have given this number. That would have given a different number. If I had gone through the closing stock route, I would have got a different answer. Sales is 32 lakhs. Any doubts on this? Can you proceed? By sales. By sales, note 2 or 3, 3 no? 32 lakhs. Any doubts on this? Clear? Now I will use stock turnover ratio, get average stock, break it as opening and closing. Get average stock and break it as opening and closing. Whatever note number, please number your notes. Note 4, computation of average stock. Note 4, computation of average stock. Stock turnover ratio is equal to COGS by average stock. COGS by average stock. How much is the stock turnover ratio? What is the GP margin? So 32 lakh into 75%. Average stock. 32 lakh into 75%. Average stock. Tell me the average stock figure. 2 lakh 40. We did not use closing stock for COGS. That would have given altogether a different answer. That route we did not proceed, because your mind may force you to use, because in that order they gave, but in the end they gave fixed assets to capital, and that is the starting point for us. That was the starting point. Any doubts till this? Any doubts in this? Break it as opening, closing. Closing is how much? 4 lakh. Opening will be some number plus 4 lakh by 2 is equal to 2 lakh 40. Tell me the opening figure. It is x plus 4 lakh by 2 is equal to 2 lakh 40. X plus 4 lakh by 2 is equal to 2 lakh 40. Any doubts in this? A straightforward simple computation. Any doubts in this? Can we proceed? Now in the trading account, to opening stock. In bracket, note, what was the note number? Note for 80,000. To opening stock, note for 80,000. Any doubts in this? Clear? Leave a line to gross profit. Gross profit we had calculated, or we know 32 lakh into 75%. 25%, 20, sorry, 25. 8 lakh. Purchases balancing figure. We do not have any other information here. So purchases is balancing figure. Total is 36 lakh. This side also 36 lakh. Purchases and other all expenses. It is purchases and all other expenses. How much is the balancing figure? Sorry, 20, 27 lakh 20,000. Any doubts in this? This is closure of trading account. P&L is almost closed only. We'll close that and then we'll focus on the balance sheet part. Any doubts till this? Clear? By gross profit. And this side, by gross profit 8 lakhs. To by gross profit 8 lakhs. To expenses balancing figure, operating expense, whatever name you want to give, to operating expenses balancing figure, 1,60,000. We do not have full information, but with whatever information available, this is my trading and P&L. 8 lakh, 8 lakh closed. Trading P&L is closed. Clear? Next note, you do it and tell me. Use fixed assets by current assets and tell me the current asset figure. Next note, whatever number, computation of current assets. Computation of current assets. You can number your notes. Fixed asset by current asset 5 by 7. Forty by current asset is equal to 5 by 7. Fixed asset by current asset is 5 by 7. What is the note number? 5. Clear? Any doubts on this? This side, other liabilities, we don't know the item and all. There's a ratio to calculate it, but I'll take it as balancing figure. There's a ratio to calculate, but I'll take it as balancing figure. Yeah. In the current asset, please write it as other current asset and write it as 52 lakh. 56 lakh minus closing stock. 56 lakh minus closing stock. Sorry. Other current asset 52 lakh. This other current asset could be debtor, could be cash, could be anything. Other current asset 52 lakh. Other liability balancing figure. What is other liabilities? Apart from capital, you will have sundry creditors, you will have bills payable, you will have outstanding expenses. How much is the balancing figure? And which is what this ratio would have given. Capital 1, other liability 2. It should have been capital to other liability. They said capital to total liability. And which is where I said I am writing a note for you. Assume capital to be not part of the total liability. I did not even use that ratio. But that is an assumption I wanted to write, because without that, if you take capital to be part of total liability, then total liability is 2. Capital is 1, other liability is also 1. Capital is 1, other liability is also 1. 32, 32 both should have become, balance sheet will not tally. Balance sheet will not tally. So this is 64 lakh. Now 96 and 96. Technically, I should not have taken any balancing figure here, because other liability also we can calculate with which ratio? Capital by total liability. It should have ideally said capital to outside liability. They could have used the word outside liability also, but they used the word total liability. Any doubts on this? These are usual exam type of question where they'll tell you to forecast a P&L and balance sheet. Mostly what is tested is forecasting of P&L and balance sheet. Any doubts on this? Understanding of different ratios is very, very critical. Interlinkage is critical. Any doubts on this? Because if you had started with stock turnover ratio here, you would have got COGS as 40 lakh. How you would have got 40 lakh? Because closing stock you would have taken. If you had taken that 40 lakh, sales would have become something else and everything would have gone different. So that purpose would have got lost because they had used the word closing stock. They use the word average stock, I have no problem. Any doubts on this? Any doubts on this? Okay. I'll do this question 20. It's a small question. Will be in a position to complete in the next 13 minutes. Let's come to this. With the help of following information, complete the balance sheet of ABC Limited. Equity share capital 1 lakh, current debt to total debt 0.4, total debt to owner's equity 0.6, fixed asset to owner's equity 0.6, total asset turnover 2 times, inventory turnover 8 times. Very limited information. They've asked us to prepare a balance sheet of ABC Limited. Open the format of balance sheet and then we'll start filling the data. Balance sheet, liabilities amount, assets amount. There are some information. Let's write there. What is the information there? Equity share capital is how much? 1 lakh. Current debt to total debt. What is current debt to total debt? Is current debt is short term debt. Current non-current. Current is short term. So in the total debt, short term is 0.4. We'll see that later. Use this and tell me total debt figure. Next to note 1, computation of total debt. Total debt by owner's equity 0.6. Computation of total debt. Computation of total debt. Total debt by equity. How much they've given? 0.6. Total debt by equity. Equity is 1 lakh here. We do not have reserves, no other data is there. Straightforward, very simple question. Total debt is equal to how much? Break it into two. Short term debt, that is current debt, and long term debt. Current debt and long term debt. Current debt and long term debt. How much is the current debt proportion they have given? Current debt to total debt is how much? 0.4. Current debt to total debt is 0.4. So this is 0.4 and this is 0.6. With this, liability side is over. 24 and 36. 24,000 and 36,000. Any doubts in this? Any doubts in this? We do not have any other information on the liability side here. Clear? Can we proceed? Long term debt in bracket note 1. How much was the long term debt? 36,000. Current debt again in bracket note 1. 24,000. 36 and 24. 36 and 24. Clear? Any doubts on this? Can you proceed? 36 and 24. Please use fixed asset to owner equity and tell me the fixed asset figure. Fixed asset note 2. Fixed asset divided by equity is zero point 0.6. Fixed asset divided by equity is zero point 0.6. Fixed asset by equity is zero point 0.6. Fixed asset by equity is zero point 0.6. Any doubts on this? Apart from this, two other ratio they have given which do not have any major purpose, but still they have ended up giving total asset turnover and inventory turnover. If nothing else was given, I'd have closed the question by saying other assets balancing figure. Other assets balancing figure. Now I have total asset turnover. Now listen, you leave a line, put a total 1 lakh 60 this side, which means 1 lakh 60 this side also. Both the sides are 1 lakh 60. Both the sides are 1 lakh 60. I can close it by taking 1 lakh as balancing figure, but they have given two more ratio which can help me in forecasting one more item. Next, right, computation of inventory. Computation of inventory. Computation of inventory. Total asset turnover is equal to sales by total asset. Total asset turnover is equal to sales by total asset. Inventory will be calculated with these two ratios. How much is the total asset turnover? 2 is equal to sales by 1 lakh 60. Total asset is 1 lakh 60. Sales is 3 lakh 20. Sales is 3 lakh 20. Any doubts on this? Sales is 3 lakh 20. They have given inventory turnover ratio. What is the formula for inventory turnover ratio? COGS by average stock. Listen for a minute. Inventory turnover. COGS by average stock. Lack of information. It will become sales by closing stock. It will become sales by closing stock. I cannot do average and all, and I cannot do COGS. There's no GP data, nothing is there in the question. You cannot do anything now. So instead of taking COGS, we are going to take sales, and which is what ICA has also done, which is logical. If you do not have one information, take the next best possible information. So sales by closing stock. Inventory turnover ratio is equal to sales by closing stock. This will give me closing stock. Inventory turnover ratio is equal to sales by closing. If this I breakup and all was not given, no problem. I would have taken other assets and closed it. That's all. Other asset and balancing figure and done. Because they gave these two ratio, I calculated sales. Based on sales, we are calculating inventory. Based on sales, we are how much is the inventory turnover ratio? 8 equal to 3 lakh 20 by closing stock. Closing stock is 40,000. Any doubts on this? Any doubts on this? This side, closing stock, note E 40,000. Other current assets balancing figure can be debtors, can be cash, can be prepaid expenses. If debtor was also there, then cash is balancing figure. We normally have three items: debtor, inventory, cash. Other current asset balancing figure 60,000. Any doubts on this? Any doubts on other current asset balancing figure 60,000? Clear? You can try question 21 at home. Please try. I would want you to do 21 at home. Okay. Try and close 21 at home. Yeah. 21 you alone, please complete it. We'll end with this. Okay. Let's do few more question. Let's come to question 19. You are advised by the management of ABC Limited to project a trading and P&L account and the balance sheet on the basis of following estimated figures and profit: ratio of GP, stock turnover ratio, debt collection period, creditors velocity, current ratio, proprietary ratio. They've defined it little differently: fixed assets to capital employed, preference share and debentures to capital employed, net profit to issued equity, reserves and profit and loss to issued equity, preference shares to debentures, material purchased as proportion of COGS, and gross profit. Lot of information has been given in the question. They've asked us to prepare a trading P&L and the balance sheet. Trading P&L and balance sheet. Multiple category of ratios have been given. We'll go through one by one as we do the problem. First thing we will do is open a trading and P&L account, some 12-13 lines. Balance sheet, some 8 to 10 lines. Let's open first the trading P&L and balance sheet format. Please open it. Question 19. Trading account and profit and loss account. Trading account and profit and loss account. Particulars amount, particulars amount. Trading P&L. You can leave 10 lines. 10 lines should do. And balance sheet. Balance sheet could be some 8 lines. Liabilities amount, assets amount. Trading P&L and balance sheet. Trading and P&L and balance sheet. 10 lines for trading P&L, some 8 lines for balance sheet. Okay, can we start discussion? Now tell me which is the first ratio we're going to use and what can we calculate with that? You have everything in front of you. I want participation, guys. Tell me which ratio you want me to use and what can be calculated. Look at the question and you will have to participate. I keep doing it will not serve any purpose. First ratio which we can use. In the order itself, I'll use ratio of GP. GP is given in the last line, 1250 lakh. With this, I'll calculate sales and COGS. Working note 1, come down, note 1. Computation of sales and cost of goods sold. Sales and cost of goods sold. Gross profit equal to 25% of sales. Gross profit equal to 25% of sales. 25% of sales. %25 of sales. GP amount is given in the question. How much? 1250 lakhs is equal to 25% of sales. Sales is how much? 5000 lakhs. Sales is 5,000 lakhs. Clear? COGS is 5,000 minus 1,250, 3,750 lakhs. COGS 3,750 lakhs. Any doubts on this? We'll see how to break this further in the trading account credit side. Buy sales, note 1, 5,000. Buy sales, note 1, 5,000, right hand side corner in lakhs, or you can write amount in lakhs. We're doing it in lakhs. COGS 3,750 lakhs, sales is 5,000 lakhs. Any doubts on this? Clear? What's the second ratio we can use? Stock turnover ratio will give me average stock, which is closing stock. Also, I don't see any other information in the question. There's no breakup of opening stock and closing stock in this question. So, note 2, computation of closing stock. Computation of closing stock. Note 2, computation of closing stock. Stock turnover ratio is equal to COGS by closing stock. COGS by closing stock. Stock turnover ratio, COGS by closing stock. Divided by closing stock. How much is the stock turnover ratio? 5 times COGS closing stock balancing figure. 750 lakhs. Any doubts in this? Any doubts in this? Go to the balance sheet. Leave maybe 2 lines gap where fixed assets and something else can come. Current assets, underline that. First item stock in bracket note 2, 750. Stock in bracket note 2, 750. Closing stock is 750 lakhs. 750 lakhs. Any doubts in this? Clear? Can you proceed? Then the next ratio we can use is debt collection period. What is debt collection period? Is debtor collection period. We are collecting the money in 3 months. Next, computation of debtor. Computation of debtor. Computation of debtors. Debtors equal to 3 months of credit sales. 3 months of credit sale. I'm not writing the detailed formula and all. We used to write debtors turnover ratio and then swap and then do all that. I'm not doing it. 3 months of credit sales. Any cash sales, credit sales breakup in the question? Any breakup? Then 5,000 as it is into 3 by 12. 3 months. 5,000 into 3 by 12. 5,000 into 3 by 12. Debtors 5,000 into 3 by 12. 3 months of credit sales. 3 months of credit sales. How much is this? 1250 lakhs. In the current asset, debtor note 2, note 3, 1250. Note 3, 1250. Debtors is 1250. Any doubts on this? 1250. Clear? Next ratio we have is creditor velocity. Creditor velocity. What is creditor velocity? Is creditor days. How much is this? 3 months of credit purchases. 3 months of credit purchases, and they have mentioned it here. Material purchased as a proportion of cost of goods sold 40%. Material purchased as a proportion of cost of goods sold. How much is the cost of goods sold? 3750. Go to the trading account. I am not writing opening stock and closing stock in the trading account because I don't know the breakup. And even if I have to write, it is the same amount, opening, closing, same. Because the average stock we calculated or the closing stock we calculated was 750, opening also 750, closing also 750. That is how average will be 750. We are not getting into that. 2. Material purchased. Material purchased 3750 into 40%. 3750 into 40%. 3750 into 40%. 2. Other expenses. Other expenses. Our trading account is over with this. Material purchased is 3750 into. If this breakup was not given, only one line item I would have written 2 COGS 3750. That's all. Only one item we would have written 2 COGS. 2 other expenses 3750 into 60%. 2250. 2 gross profit 1250. Trading account is over. Ideally, one more thing should come, which is opening and closing stock. I cannot write it because when we did stock turnover ratio, we have called it as closing stock. Any doubts on this? Done? Done? Note 4. Computation of creditors. Computation of creditors. Creditors equal to 3 months of credit purchases. 3 months of credit purchases. That is purchases into 3 by 12. 3 months of credit purchases. How much the purchases figure? 1500 into 3 by 12. 1500 into 3 by 12 into 3 by 12, we get 375 lakhs. Any doubts on this? Can we proceed? So we get this number, current liabilities, in that creditors. In fact, leave some 5 lines and then write current. A lot of items will come above this. Leave some 5 lines and then write current liability. Okay, some lot of items will come above this in this question. Creditors, note number 4, 375. Note 4, 375. Any doubts on this? Clear? Can you proceed? Okay. Current ratio 2 times current asset by current liability, but the problem is I don't know the current asset figure fully. I don't know the current liability figure also fully. I know creditors is there, and in the asset side we have stock and debtors. Fixed assets to capital employed, they have given a ratio. Fixed asset divided by capital employed is 0.8, but the issue here is I don't know the fixed asset figure, I don't know the capital employed figure also. Then in the capital employed, how do you break it are the other ratio. Preference shares and debentures to capital employed, net profit to issued equity, reserves and profit and loss to issued equity, and some preference share to debenture. So all other ratio are around capital employed. What is capital employed is debt, equity, preference, or fixed assets plus current asset minus current liability. I can say fixed asset is 80% of capital employed. They have given in the question fixed asset to capital employed 80%. Somewhere I need the current asset and current liability. In this question, we're going to make one small assumption to proceed. There's no other way. You see these two items, current asset 750, stock 750, debtors 1250. Assume creditors is the only current liability. Assume creditors is the only current liability. If current ratio is 2 is to 1, if current creditors is the only current liability, what should be the total current asset? If creditors is the only current liability, 375 into 2, 750, not possible, because stock is 750, debtors is 1250. Stock is 750, debtors is 1250. See, I have to make an assumption. My assumption is creditor is the only current liability. Nothing wrong with the assumption. The problem is if you say creditor is the only current liability, 2 into 375 is current asset. Current asset is saying I'm already at 2000. Then the other assumption, only current assets are stock and debtor. Only current assets are stock and debtor. What is the total of stock and debtor? 2000. Current liability is half of 2000. Possible. Current liability is half of 2000. Either current asset is double of 375. That assumption you take. How I could have taken if the creditor figure was something like 1500. Take double of 1500 and write other current asset. Write other current asset. In case creditor figure was higher, I could have taken double of creditor as current asset, but that is not possible. Then what I'm saying, current liability is equal to half of stock and debtor. Half of stock and debtor. No other option available. Either take it as half of stock and debtor, or you take it as double of creditor. Double of creditor has a problem for me. I get negative other current asset. I get negative other current asset. That option is not feasible. Only one of the two is possible. Only one of the two, either double of creditors or half of stock and debtor. We are taking half of stock and debtor, and we will call other current liability. We'll call it as other current liability. What can that current liability be? Bills payable or some outstanding expenses, some taxes payable. It can be anything. Any doubts on this? Note 4, note 5, computation of current assets and current liabilities. Current assets and current liability. Let us assume stock and debtors are the only current assets. Stock and debtors are the only current assets. Current ratio equal to 2. Current ratio is equal to 2, which means current liability is half of current asset. Current liabilities is half of current asset is double of current liability, and current liability is half of current asset. Current liability is equal to half of stock and debtors. Half of stock and debtors. half of stock and debtors divided by 2. Half of this, how much you get? 1000 lakhs. Any doubts on this? Any doubts on 1000 lakhs? Can you proceed? Any doubts on this? Right here, other current liability, other current liability, note 5, 1000 minus 375. We don't know what items and all is this, but there is an the other current liability. Clear? Any doubts on this? 625 lakhs. Can you proceed? Next, computation of fixed assets and capital employed. Now we can calculate that. Computation of fixed assets and capital employed. Fixed assets and capital employed. Fixed assets and capital employed. They have given ratio of fixed assets to capital employed, proprietary ratio, but the ratio formula is fixed assets by capital employed. So write FA by CE. You write the full form obviously. Fixed assets by capital employed is equal to, fixed assets by capital employed is 0.80, 80%, 0.80. FA fixed assets is equal to 0.80 CE, 0.80 CE. Fixed asset is equal to 80% of capital employed. Any doubts on this? Clear? Okay, next is capital employed is equal to, there were two formulae for capital employed. One is liability side route and second there was an asset side route. Asset side route, what is the formula? Total assets minus current liability. Let me expand it as fixed assets plus current assets minus current liability. Fixed assets plus current assets minus current liability. Capital employed is equal to 0.80 capital employed plus 2000 minus 1000. Tell me the capital employed figure. Capital employed figure. How much? 5000 lakhs. And then fixed assets figure. Fixed assets figure. Capital employed is 5000. Fixed assets figure. Fixed assets is 4000. Any doubts on this? With this, my balance sheet can tally, but I'll have to break the capital employed. There are other ratios given. If I close the balance sheet now, fixed assets 4000, total is 6000. Capital employed in the liability side 5000, total is 6000. Balance sheet is tallied. Fixed assets 4000. Fixed asset we can write fixed assets in bracket note number. What is the note here? 6. Note 6. How much we got? 4000. And if I write other side capital employed, it is tallied. That's all. If you write capital employed one side, fixed assets other side, it gets tallied and it is over. but there is a way to break the capital employed further because they have given a lot of other information. Any doubts on this? Any doubts till this? Balance sheet is almost over. Trading account is fully over. P&L will get over once I do the balance sheet. Why, you will understand. Any doubts till this? Now, note 7. Split of capital employed. Split of capital employed. Right center, capital employed is equal to 5,000 lakhs. We'll have to break this further. Capital employed is 5,000 lakhs. Now see here, they have said preference share and the debenture. Preference share and debenture put together is 30%. Share capital and reserves and surplus. Equity, share capital and reserves and surpluses balance 70%. Preference share and debentures to the capital employed. So one side preference share and debenture 1,500 lakhs, 30%. Preference share and debenture 1,500 lakhs. Preference and debentures 1,500 lakhs. Any doubts on this? 30% of 5,000. 30% of 5. This step technically not needed in case you are not able to break it down. Here we are able to break it down. Other side, equity funds 3,500 lakhs. Equity funds 3,500 lakhs. This preference share and debenture, how to break, they have given in the question. What did they mention then? About preference share and debenture. Preference share to the debenture, not preference share to the capital employed or preference share to the overall PS and debenture. Preference share to the debenture is 2, debenture is denominator. Preference share 2 times, debenture 1 time. Preference share 2 times, debenture 1 time. Preference share 2 debentures 2 times. Preference share 2 times, debenture 1 time. So break it as preference share 2 times, debenture 1 time. Break it in the ratio of 2:1. Break this 1,500 in the ratio of 2:1. 2:1. Preference share and debentures in the ratio of 2:1. 1,000 lakhs and 500 lakhs. 1,000 lakhs and 500 lakhs. Any doubts on this? Can we proceed? Clear? So preference share and debenture we have split it. Equity funds can be split. Any doubts till this? This can be split as reserves and surplus to the issued capital equity. What is issued? Is share capital. Issued capital is share capital. How much? 25%. Listen very clearly. Reserves and profit and loss to what item? To the issued capital, not to the overall equity. Overall equity is 3,500. It is not 25% of 3,500. It is 25% of share capital. So when I break this, I'll break it as share capital and reserves and surplus. I'll break it as share capital and reserves and surplus. Share capital 100, reserves 25. 25 on this 100. 25 on, it's not 75 25. It is not 75 25. Question could have said reserves and surplus to the equity overall. Overall equity means you would have done 25 reserves and surplus, 75 share capital. They have very clearly mentioned reserves and profit and loss to what item? To the issued capital. Issued capital is share capital. So break this now further. Equity funds, share capital in bracket 100, share capital in bracket 100, other side reserves in bracket 25. Please split in the ratio of 100 and 25. Split it in, like we split 2 is to 1, here 100 and 25. Share capital is 100, or you can say 0.1 and 0.25, whatever way. Break this now, how much? 2800 lakhs, other one. So very good adjustment, breaking every item into the sub-segment. Not mandatory for us to do, but this question has given information to break it further. 2800 lakhs and 700 lakhs. Any doubts on this? Can we proceed? Clear? 2800 lakhs and 700 lakhs. Any doubts on this? Done? Can we? Now go to the balance sheet. First item, equity share capital. Note 7. Equity share capital. Equity share capital. How much the equity share capital we got? 2800. Equity share capital 2800. Reserves and surplus. Reserves and surplus. Again note 7. How much we got? 700. Reserves and surplus 700. Preference capital or preference, whatever, preference capital, how much we got? 1000, note 7. And debenture, again note 7. Please number your working notes properly. 500. Balance sheet is over. Balance sheet is over. Tell me the total. 6000. Balance sheet is over. Total is 6000. Any doubts on this? Clear? We just need to close P and L. Trading account is over. Balance sheet is over. Any doubts till this? Any doubts till this? Then in the P and L, by gross profit. By gross profit. By gross profit. One two 50. By gross profit 1250. 2 expenses balancing figure. To net profit. To calculate net profit, they have mentioned something in the question. Net profit to issued equity share capital. Basically net profit is 10% of share capital. Net profit is 10% of equity share capital of the issued equity, not overall equity. Overall equity means on 3500 to the share capital, which is 2800. So net profit is 10% of 2800. Expenses balancing figure. Expenses is balancing figure. How much is that? We do not have. I would want to further break it as interest expense and all. We have no data on that. In case we had the interest rate on debenture, then we would have written to interest amount and other expenses balancing figure. Any doubts on this? Any doubts on this? A good question around capital employed. The question revolved around computation of capital employed. Any doubts on this? Clear? Can we proceed? Any doubts on this? Done? Go through the question. I'll give you a minute or two. You go through the solution. Let me know if there are doubts. Okay, let's come to question 22. Major chunk you are going to do. I'll explain it and then you'll start doing it. From the following information, prepare a summarized balance sheet as at 31st March. Working capital 480. Bank overdraft. Bank overdraft is part of the current liability. Part of the current liability. Fixed assets to proprietary ratio 0.75. Reserves and surplus is given. Current ratio is given. and liquid ratio is given. I'll explain it, then you start doing it. First thing I have is working capital. Working capital with current ratio is a combination which will give you current asset and current liability, which will give you current asset and current liability. Working capital is CA minus CL. Current ratio CA by CL, you will get current asset and current liability. Then if you use liquid ratio, you will get quick asset. If you get liquid ratio, you will get quick asset. Current asset minus quick asset is inventory. Current asset minus quick asset is inventory. So current ratio will give me current asset total. Current liability will give me current liability total. Current liability, two items breakup. Bank OD 80,000, other current liability. Bank OD 80,000, other current liability. Current bank OD can be a long term also, but here I take it as short term. Current asset breakup will be inventory, other current asset. Inventory and other current asset. Then you will use fixed assets to proprietary ratio. What is proprietary ratios? Fixed assets to proprietor funds. You will use this ratio with an assumption that there is no debt in the company. There's no debt in the company. That is no debt in the capital employed. Fixed assets by proprietor fund 0.75. FA is equal to 0.75 PF. Proprietor fund is equal to fixed assets plus current asset minus current liability, like capital employed is equal to current fixed assets plus current asset. This will give you fixed asset figure and the proprietor fund figure. I give you around 8 minutes. You start doing it. I'll discuss it after 8 minutes. Start doing it. 8 minutes for you. Okay. First thing we will do is here current ratio is equal to current asset by current liability. 2.5 is equal to CA by CL. CA is equal to 2.5 current liability. Most of the notebook this was there. Then working capital given in the question is 4,80,000 is equal to CA minus CL. 480 is equal to 2.5 CL minus CL. CL number is 3,20,000. CA number is 8 lakh. These are the numbers you got. CL is 320 and CA is 8 lakh. So if I was to prepare a balance sheet, in the balance sheet, CL 3,20,000, in that bank OD, how much is the bank OD? 80,000. Other current liability is 2,40,000. Other current liability is 2,40,000. 2,40,000. That is your other current liability. Coming to current asset part, overall 8 lakh. In that, there was a quick ratio given. How much was the quick ratio given in the question? 1.5. So quick ratio is equal to quick assets by current liability. 1.5 is equal to quick asset by 3,20,000. Quick asset is 4,80,000. So in the current asset, inventory and others are 4,80,000. Others are 4,80,000. Inventory obviously is 3,20,000. Inventory is 3,20,000. Any doubts in this part? Others are 4,80,000. Other current asset, quick asset is other current asset 4,80,000. Inventory is 3,20,000. Then there was another ratio given. Fixed assets to proprietor fund, how much? Point. FA is equal to 0.75 proprietor fund. 0.75 proprietor fund. And then I say capital employed slash proprietor fund. Capital employed slash proprietor fund. If somebody says bank overdraft is part of long term debt, then it will become part of capital employed. Then I will say capital employed, the breakup of capital employed is proprietor fund plus 80,000 proprietor. Bank OD I have taken as part of current liability is equal to fixed assets plus current asset minus current liability. If you have not done this, you can write it along with me. Capital employed slash proprietor fund is fixed assets, current asset minus current liability. PF is equal to 0.75 proprietor fund, 0.75 proprietor fund, 0.75 proprietor fund. Current asset was how much? 8 lakh. Current liability, this will give you the figure of proprietor fund. 19 lakh 20,000, and fixed asset is 75 percentage of this. Fixed asset is 75. In case you have not got it, capital employed slash proprietor fund is equal to fixed asset plus current asset minus current liability. PF is equal to 0.75 PF, 0.75 PF plus 8 lakh minus 320. Proprietor fund is 19 lakh 20, and fixed asset is how much of this? 75%, 14 lakh 40,000. Fixed asset is 14 lakh 40,000, and proprietor funds is 19 lakh 20,000. Any doubts on this? Any doubts on this figure? Clear? Can you proceed? So you write this here and balance sheet gets tallied. Fixed asset 14, 40, proprietor fund 19, 20. Balance sheet total is how much? 22 lakh 40,000. Any doubts on this? Any doubts on the straightforward simple question? Any doubts on this? Can we proceed? Any doubts on this? Let's come to question 23. Following is the abridged balance sheet of Ganesha Limited. Balance sheet as on 31st March 2013. Share capital, P&L, current liability, asset side land and building, plant and machinery less depreciation, current asset stock, debtor, bank. With the help of additional information, you are required to prepare trading P&L and a balance sheet. Trading P&L and a balance sheet. Company went in for reorganization of capital structure with share capital remaining the same, and others are as follows. Debentures were issued on 1st April, interest being paid annually on 31st March. Land and buildings remain unchanged. Additional plant and machinery has been purchased. Further 5,000 depreciation written off. Working capital ratio 8 is to 5. Working capital ratio is current ratio technically. Working capital ratio. If that said working capital turnover ratio, then that is sales by working capital. But working capital ratio would mean current ratio. Quick ratio 1 is to 1. Debtors is 4/5 of the quick asset. Revealed a credit period, no cash sale. Return on net worth, GP, stock turnover 8 times for the year. Ignore taxation. Ignore taxation. Go through the question and then we'll start doing it. Go through the question. Okay, let's come to the question. They have given a balance sheet already, but I need the next year balance sheet as well as a trading P&L. Let's first open the trading P&L, maybe some 12 lines, balance sheet some 8 lines, and then we start doing it. Let's start. Open a trading P&L. Trading and profit and loss account of Ganesha Limited for year ended March 31, 2014. Trading and P&L account. Particulars amount, particulars amount. Balance sheet of Ganesha Limited as on March 31, 2014. Trading P&L some 12 lines, balance sheet some 8 lines. Liabilities amount, assets amount. Trading and profit and loss account and balance sheet. Okay. There is a opening balance sheet given where share capital is there, P&L is there, and current liability is there. First para says company went in for reorganization of capital structure with share capital remaining the same and others are as follow. Now, this information will give me total liability side of the balance sheet. What they have mentioned is share capital is going to remain same. Share capital remaining the same. So, share capital will remain 1 lakh. 1 lakh is equal to 50. 1 lakh is equal to 50. What is 15? What is 10? What is 25? And the liability side will get over. They have said share capital will remain the same and share capital is 50%. So 50% equal to 1 lakh, 15% equal to question mark, 10% equal to question mark, 25% equal to question mark. With this, the liability side will get over. So come to the liability side, right? Share capital in bracket 50%, 1 lakh. 50% 1 lakh. Share capital 50% 1 lakh. Other shareholder funds in bracket 15%. If 50 is equal to 1 lakh, what is 15? 50 equal to 1 lakh, what is 15? This is technically reserves and surplus. Other shareholder fund is nothing but reserves and surplus 30,000. 50% equal to 1 lakh, 15 equal to question mark, 15 equal to question mark. What's the next item there? 5% debenture in bracket 10%. 50 equal to 1 lakh, what is 10%? 20,000. Trade creditors 25%. 1 lakh, 30,000, 20,000 and 50,000. 130, 20 and 50,000. With this, the liability side gets over. 2 lakh is technically the total of the liability side. Any doubts on this? Clear? Can we proceed? Leave maybe some 4 5 lines more because asset side will need more lines. Total 2 lakh both the side. Total is 2 lakh. Both the sides total is 2 lakh rupees. Any doubts on this? Can we proceed? Okay. Second item, debentures were issued on 1st April. What is the use of this information? Interest is for 1 year. So in the P&L, trading account leaves some 5 6 lines. In the P&L, to interest 5% into 20,000 rupees to interest in the P&L. In the P&L, maybe some 5 lines for trading account. In the P&L, some 2 3 lines gap for others, and maybe 7th or the 8th line to interest 5% into 20,000 rupees. Some 7th or the 8th line to interest 1,000 rupees. 5% into 20,000. 5% into 20,000. ₹1,000 is the interest expense. Then land and building remain unchanged. Land and building remain unchanged. In the asset side, write first land and building. Land and building remain unchanged. Remain unchanged. How much is the land and building given in the balance sheet? 80,000. Land and building remain unchanged. 80,000. Remain unchanged. 80,000. Additional plant and machinery has been bought and further 5,000 depreciation written off. What they did for plant and machineries, they followed an accumulated depreciation method. What is accumulated depreciation? Is asset value is 50,000, depreciation for all years till now is 15,000, and outer column was 35,000. Now what they have said is total fixed assets constituted how much? 60% of total fixed and current asset. 60% of total fixed and current asset. So I'm going to write this as it is now. Plant and machinery, I don't know the amount, I'll calculate. Less depreciation 15,000 plus another 5,000 plus another 5,000. Outer column I don't know. The total of these two earlier was 1,15,000. Now the total of this two will be 60% of total asset. 60% of total asset. What is total asset? 2 lakh rupees. Total asset is 2 lakh rupees. 60% of total fixed and current asset. Total fixed and current asset. Any doubts till this? Now go to the P&L first. Write to depreciation. Above interest to depreciation 5,000. To depreciation 5,000. 5,000 depreciation for the year. Additional depreciation. To depreciation 5,000. Any doubts on this? Come down. Plant and machinery. Plant and machinery. If we don't know the amount, it is like this. I'll have to get this amount. Less depreciation. Less depreciation. What is depreciation? Is accumulated depreciation. How much was the depreciation in the balance sheet already? Additional how much? Minus 20,000. Less depreciation minus 20,000. This amount also I don't know. I don't know this amount also. But what I know is a total for this. Total fixed assets. Total fixed assets. We normally don't put an internal total, but here we are putting it because the balance sheet had that way only. Total fixed asset. Fixed asset is what? 60% of fixed and current are technically 60% of total assets. So total fixed asset in bracket 60% into 2 lakh. Now tell me those question marks. Outer column question mark and the inner column question mark. Any doubts on 1,20,000? What is the outer column question mark figure? Guys, you'll have to be louder, guys. Very simple question. 40,000. This alone, if you are not participating, then I don't know what to do. 40,000 outer column question mark. What is the inner column question mark figure? 60,000. I've already done all the calculation. I just asked you the figures. 60,000 minus 20,000 is 40,000 and total is 1,20,000. Balance sheet almost looks ready. Any doubts till this? Any doubts till this? Can we proceed? Clear? Any doubts on this? This ratio is of no use. I could have used this ratio if the earlier data was not there. Working capital ratio is what? 8:5, which means current asset is 8/5 of 50,000. 8/5 of 50,000. What is 50,000? Your trade creditor. I don't want to use the ratio because balancing figure current asset is 80,000 already. Balancing figure current asset is 80,000. I could have used that 8 by 5. I could have used the 8 by 5. 5 equal to 50,000, 8 equal to 80,000. 5 equal to 50,000. Current liability is 50,000. Current asset is 8 by 5. 1.6 times of 50,000. 1.6 times of 50,000. Ideally, they should have either given this information or the earlier information. Giving both information doesn't serve any purpose. Leave that. Quick asset ratio is what? Quick asset ratio will give me quick asset. Inventory is balancing figure. Inventory is balance. Note 1, come down. Computation of inventory. Note 1, computation of inventory. First time we are doing any extra calculation. Computation of inventory. Technically closing inventory. Computation of closing inventory. Quick assets, quick ratio is equal to, quick ratio is equal to quick assets by current liability. Quick assets by current liability. Quick assets by current liability. How much is the quick ratio given? 1 equal to quick assets by 50,000. Quick asset is 50,000. Quick assets is 50,000. Inventory is current assets minus quick asset. Current asset we already know 80,000. How 80,000? 2 lakh minus 120. 2 lakh, or I could have used the working capital ratio, which is your current ratio. Any doubts till this? Inventory is equal to current assets minus quick assets. Current assets minus quick assets. 80,000 minus 50,000. 30,000. Any doubts on this? Can we proceed? Here itself, I'll do one more thing. Debtors is equal to something they mentioned in the question about debtors. 4 by 5 of quick assets. Debtors is 4/5 of quick asset. What is the use of that credit period and all? You will understand in some time. 4 by 5 of quick assets. How much is debtors? Balance sheet is over now. Inventory 30,000, debtors 40,000, and other current asset are technically cash. You can call it as other current asset, you can call it as cash, 10,000 rupees. Inventory 30, debtor 40, and others are 10,000. Any doubts till this? Any doubts in this? Can we proceed? Clear? Right here, current assets. Below this, inventories. Note 1, we got how much? 30,000. Debtors, note 1, 40,000. Debtors is 40,000. Other or cash, you can call it as cash or other current asset, balancing figure 10,000. Cash is balancing figure 10,000. Any doubts on this? Clear? Can we proceed? Any doubts on this? Balance sheet is over. I'll have to look at the trading P&L part. Any doubts on this? Done? Okay. They have given return on net worth. What is return on net worth? Is PAT divided by equity. PAT divided by equity. This can give me the profit after tax figure. This can give me the profit after tax or before tax. Both are same. Both are same. Return on net worth is return on equity. Return on what is equity? Share capital plus reserves and surplus. Share capital plus reserves and surplus. Note 2, computation of net profit. Note 2, computation of net profit. Technically it is PBT, tax is not there. PBT, PAT both are same. Computation of net profit. Return on net worth is equal to return on net worth is equal to PAT by equity. Return on net worth is equal to PAT by equity. No tax angle here. So technically PBT, PAT is same. How much is the return on net worth given? Please look at the balance sheet and tell me the equity total. Share capital, reserves and surplus minus fictitious asset. Tell me the equity total. Share capital plus reserves and surplus. Share capital is 1 lakh. Reserves and surplus is 30,000. Other shareholder funds. Other shareholder funds. So denominator is 1 lakh plus 30,000. Tell me the PAT figure. How much? PAT is 13,000. Clear? Any doubts on this? Now there was another way of getting the PAT figure also. In the balance sheet given in the question, how much is reserves figure? 17,000. In your balance sheet, how much is the reserves figure? The difference is the profit for the year. The difference is the profit for the year. I could have used that approach also. In the balance sheet given in the question, it is 17,000. In your notebook, it is 30,000. Difference is the profit for the year. Difference is the profit for the year. Question 17,000. Notebook 30,000. Difference of 13,000 is the profit for the year. Taxation is not there. If that's a taxation, then this is PAT. I would have got back the PBT number. In the P&L, 2 net profit. 2 net profit in bracket note number, note 2. We got how much? 13,000. Okay. Any doubts till this? Now, I will get sales using this information. Debtors is 2 months of credit sale. So debtors is equal to credit sales into 2 by 12. Debtors is equal to credit sales into 2 by 12. That will give me the sales figure. GP is given in the question and stock turnover ratio is given. What is the use of stock turnover ratio? Stock turnover ratio will give me average stock. Average stock. In that closing stock you have written in, or okay, I don't need stock turnover ratio also. Why I don't need stock turnover ratio? Closing stock you have calculated. Opening stock is there in the opening balance sheet. Opening stock is there in the opening balance sheet. There's an opening balance sheet given. From here I can take opening stock and closing stock you have already calculated. So now I have 2 ways to getting to the sales number. There are 2 ways. One way is to go through debtor. Another way is to go through inventory. If you go through inventory, COGS by average stock, get COGS and then get sales. Longer route. Directly let's do the debtor route. Directly do the debtor route. Then write computation of sales. Computation of sales. Note 3. Computation of sales. Debtors is equal to what is the credit period they've said for debtors? Debtors is equal to sales. Sales into debtors is equal to sales into 2 by 12. Technically credit sales. Anyway, there is no cash sales in the question. Into 2 by 12. How much was the debtor figure? Tell me the credit sale figure. Solve this and tell me the credit sales figure. Credit sales or overall sales, both are same only. 2 lakh 40,000. Credit sales or overall sales, 2 lakh 40,000. Any doubts on this? Credit or overall sales is 2 lakh 40,000 rupees. Any doubts on this? Clear? We are almost done with the question. Any doubts here? Any doubts on this? Go to the trading account. Any doubts on 2,40,000? Buy sales. Buy sales. Note 3. 2,40,000. Buy sales 2,40,000. Buy closing stock. We have calculated the closing stock. I think note 2. How much? 30,000. Closing stock is 30,000. Closing stock is 30,000. It's over now. Closing stock 30,000. Any doubts on this? Two opening stock in the balance sheet 21,000. Two opening stock 21,000. Any purchases figure and all is given? Okay. Two purchases and expenses balancing figure. We'll get it in a minute. Two purchases and expenses balancing figure. You'll have to be very clear on the interlinkages of the ratios. So it is not like your accounting. Here you'll have to be very clear on the linkages. Two gross profit, something is given in the question. Gross profit is how much? 15% is the gross profit. 15% of selling price. Basically 15% of sales. So sales we know 15% into 2,40,000. 15% of sales. Close the trading account total and get the balancing figure. 2,70,000 balancing figure. 2,13,000. 2,13,000. Any doubts on this? Gross profit 36,000 and purchases balancing figure 2,13,000. Opening stock plus purchases minus closing stock is COGS. It is not only purchases and other direct expenses. Some direct expenses can be there like wages and all. Any doubts in this? Come down by gross profit 36,000. Two expenses balancing figure. Two expenses balancing figure. Gross profit 36,000. Expenses balancing figure. I could have used stock turnover ratio also. If I had used that, I would have got COGS. From COGS, I would have got sales. Same number will come. They have drafted the question properly. So same number will come. Expenses balancing figure. How much? 17,000. P&L total is over. Any doubts on this? Again, a good question where balance sheet. See, the point is I can keep solving any number of questions. There's no linkage between the first question to the second to the third. You will not find much linkage. You will have to be very clear on your understanding of the ratios and linking. Any doubts on this? Clear? Can we proceed? Any doubts on this? Clear? I'll give you a minute or two. Go through the solution. Okay, I proceed ahead. 24 is homework for you. We'll move to question 25. I'll explain it. You are going to do the question. I'll only explain it. You will do it. Let's see this. T Limited has furnished the following ratios and information relating to the year ended 31st March 2021. Sales 60 lakh. They have given in the question. Return on net worth. What is the formula? We just now saw return on net worth. What is the formula? PAT divided by net worth, which is share capital plus reserves and surplus. So net worth, PAT divided by net worth is 25%. Rate of income tax is given from PAT, PBT. What is PBT? PAT divided by 1 minus tax rate. This we have seen when we did marginal costing also, and you could have seen this in income tax also. PBT is equal to PAT divided by 1 minus tax rate, or you will say PBT 100, tax 50, PAT 50. 50 is equal to so much. What is 100? Share capital to reserves and surplus in the net worth. In the net worth, The breakup between share capital and reserves. Breakup between share capital and reserves is 7 is to 3. Current ratio is given 2 times current asset by current liability. Net profit to sales. What is net profit to sales? Is PAT by sales. So this and this is the first ratio I'll use. I'll get the PAT with this. I'll get the net profit to sales will give me PAT. From the PAT I'll get PBT. From the PAT I'll get PBT. Inventory turnover based on what? COGS. Based on COGS 12 time. I don't know why they gave based on COGS. We do it only on the COGS only. Cost of goods sold is given in the question. Interest on debenture is 60,000. Trade receivable, trade payable. You are required to calculate the operating expenses for the year ended 31st March and prepare a balance sheet. They have not asked for trading P&L, but they have asked me to calculate what? Operating expenses. Listen for 2-3 minutes and then you'll start doing it. You are going to do a trading P&L, not in account form. You can do it in a statement form. What will the statement look like? You will write sales. You do it in some time, okay? Whatever I write will be there in front of you later on. Then you will do less COGS, gross profit, less operating expenses. This is what you have to calculate. EBIT less interest, EBT less tax, EAT. You will get EAT, you will get EBT. Interest is there in the question. Interest on debenture, interest on debenture, and you will get EBIT, operating expenses, balancing figure. This is on the trading P&L part in a statement form. In a statement form. When it comes to balance sheet, you have trade receivable, you have trade payable, you will also have inventory figure. You will also have inventory. How will you have inventory? Inventory turnover ratio. One assumption. Either receivable and inventory are the only current asset, or payable is the only current liability, Your current ratio is how much? 2 times. Either receivable and inventory and other current asset is 2 times of payable, or current liability is half of current assets, that is half of your inventory and receivable. One assumption you have to take. This will take care of current asset, current liability. It will take off current asset and current liability. How will you get debenture figure? Debenture can be calculated. 60,000 is 15% of the debenture value. 60,000 is 15% of the debenture value. 60,000 interest on debenture at bracket, what's it? At 15%. After all this is done, if I look at my balance sheet, current liability is done, current asset is done, debenture is done. I can calculate net worth. What is net worth? Is PAT by net worth is 25%. PAT by net worth is 25%. Get the PAT figure. Split that in the ratio of 7 is to 3. Split that in the ratio of 7 is to 3. Fixed asset other side is balancing figure. Fixed asset other side is balancing figure. I have explained you fully. Format and all is also written. So you should, so this side fixed asset will come in the end, balancing figure. Net worth breakup is share capital and reserves and surplus. Any doubts on this? Any doubts on this? I am giving you around 8 to 10 minutes. Start doing it. I'll explain after 10 minutes again. 8 to 10 minutes for you. The format and all is there in front of you. You can see the format if you want. So question revolved around computation of operating expenses as well as a balance sheet. Now coming to operating expenses, I've already given you the full answer and I could see most of you getting this correctly. Particulars and amount. Sales is given how much? 60 lakh less COGS is 18 lakh. You get gross profit 42 lakh less operating expenses. This is balancing figure. This is what we are required to calculate. Operating expenses is balancing figure. EBIT we don't know, less interest. Interest is given in the question how much? 60,000. Interest is 60,000. EBT less tax EAT. What's the net profit ratio given in the question? How much is the net profit ratio? Yes, participate, guys. 6.25%. So EAT 6.25% into 60 lakh, which is 3 lakh 75,000. 50% tax rate. So EBT 100, tax 50, EAT 50. So if 50 is equal to 375, this will be 750. This is 375. Reverse work EBIT 810. Operating expense 3390. Operating expenses 3390. This is what I could see in most of the notebook being there. Then the balance sheet is to be done. Liabilities amount, assets amount, liabilities amount and assets amount. Liabilities amount and assets amount. Now coming to the balance sheet part of it, here I had initial information which is receivable. Receivables is how much? 2 lakh. Payables is given. How much is payables? Payables is also 2 lakh. Now we had a ratio, inventory turnover ratio 12. So inventory turnover ratio is equal to COGS by stock. 12 is equal to 18 lakh by stock. Stock is how much? 1 lakh 50,000. That's the closing stock or average stock. Here we do not have a choice. Closing stock is 1 lakh 50,000. What is the current ratio given in the question? 2 times. I can either say current liability is half of 2 plus 150, which is 175, not possible. So in this case, current asset is double of 2 lakh. Our assumption is payable is the only current liability. We did another assumption in the earlier question where I said inventory and receivable are the only current asset. Here, our assumption is, let us assume payable is the only current liability. Current asset is equal to 2 into 2 lakh. 2 into 2 lakh, 4 lakh. 2 into 2 lakh, 4 lakh. The other assumption will not work. If you say half of 2 plus 150, that assumption will not work. In this question, only this assumption can work. Other assumption, if you take, what you will get? 175. Already payable is at 2 lakh. So I cannot have a negative amount and all. Any doubts on this? Any doubts on this? We did some question sometime back where we took the other assumption. Stock and debtor are the only current asset. That assumption was working well in that question. But this assumption here, if you take, it will not work. Because if you take that assumption, payable figure will turn out to be 1 lakh 75. Payable is already at 2 lakh. So this is 4 lakh, and this side other current asset balancing figure 50,000. 2 plus 150 plus 50,000. Then I have return on net worth. I have return on net worth. Return on net worth is PAT divided by net worth. How much is the percentage? What is the PAT figure? 3 lakh 75 divided by net worth is 25%. What is the net worth figure? Net worth is 15 lakh. Break it up as share capital reserves. What is the ratio they've said? 7 is to 3. 10 lakh 50. 4 lakh 50. 7 is to 3. 7 is to 3. So this side share capital 10 lakh 50. Reserves 4 lakh 50. Debenture. How much is the interest we have paid? 60,000. What is the rate of interest? So this is the debenture value. Fixed asset is balancing figure. Fixed asset is balancing figure. Liability side total is 21 lakh. Fixed asset is 17 lakh. Any doubts on this? Any doubts on this? A straightforward question only. I had explained it, then you have done, and then we have done it. Any doubts on this? Any doubts on this part? Can we proceed? Let's come to 26. GIG Limited has furnished the following information relating to the year ended 31st March 2022 and 31st March 2023. Share capital opening closing is same. Reserves and surplus 5 lakh increase is there. Long term loan opening closing same. Net profit ratio 8%. GP ratio 20%. Long term loan has been used to finance 40% of the fixed asset. Stock turnover to COGS. They should not have said COGS, but they've specifically mentioned that's okay. 4 times. Debtors is 90 days of sales. Company has cash equivalent of 1.5 months of COGS. Ignore taxation. You are required to prepare balance sheet in the following format. I am not even going to explain it, but what we are going to do is you have the balance sheet format. I'll be doing it in the screen in 2-3 minutes. I will start. You think through for 2-3 minutes and then see how you want to do. Only clue I can tell you is net profit for the year is increase in reserves. That will give you sales. Using that, you'll get COGS. Everything else you'll automatically get. One ratio you may struggle little bit, but anyway, you try doing it in your notebook. I am doing it in the screen. We will discuss it after 10 minutes. Okay. I will start in 2 minutes. You can start now itself. You can first write the balance sheet format and then start doing it. At any stage you get stuck, you can see the screen. Otherwise, you keep doing it on your own. If you get stuck, you refer it. Otherwise, please do on your own. Stock is 1250, debtors is 1562 500, and cash is 625. If you get anything different, let me know. Any calculation error, any doubts you have, let me know. 1250, 1562 500, and 625. These are the three numbers. Liability side is almost over. That was given in the question only. Asset side, three numbers are there. Now one item is pending in liability and asset side. Any doubts in any of these numbers? Fixed asset part, some of you could have got it, else I'll be explaining that adjustment alone. Till this, any doubts? 1250, 1562 500, and 6,25,000. Any doubts in any of these numbers? Can we proceed? Got till this numbers? Even some of you could have got the balance number also, but there is a possibility of some confusion in the fixed asset part. That alone I'll explain it. Any doubts in this? Can we proceed? Now, if you have done, it's okay. Otherwise, you listen and write this. Long-term loan has been used to finance 40% of the fixed asset. What this means is, whenever I purchased fixed asset, 40% of that came in the form of loan. To put it very simply, you write long-term loan equal to 40% of fixed asset. Whenever I buy fixed asset, some money will come from loan, balance money will come from equity. Long term loan is 40% of the fixed assets. 30 lakh equal to 40% of fixed asset. Get the fixed asset figure. Get the fixed asset figure. 75 lakhs. Fixed asset is 75 lakhs. Any doubts on this? Fixed asset is 75 lakhs. 40% of fixed assets. Fixed assets 75 lakhs. Clear? Any doubts on this? Understood? Can we proceed? So I get fixed asset 75 lakh. That's all. Creditors balancing figure. Creditors balancing figure 14 lakh. What is the total of the balance sheet? 1 crore. 1 crore 9 lakh 37,500. Any doubts on this? 1 crore 9 lakh 37,500. The easier part was this question balance sheet format is given very easy. Only thing is, unless you understand the first note, that is how you calculate sales and COGS. Once that is done, balance is more of a formality. Any doubts on this? Clear? Can we proceed? Done? 27 is homework. Let's come to 28. Following accounting information and financial ratios of PQR Limited to the year ended 31st March 2023. Gross profit, net profit, raw material consumed, direct wages, stock of raw material, stock of finished goods, financial ratio, debt collection period, all sales are on credit, current ratio, fixed assets to current assets, fixed assets to sales, long term loans to current liability, capital to reserves and surplus. If the value of fixed asset is 26, prepare a P&L and a balance sheet. Prepare a P&L and balance sheet. Go through the question for a minute or two and then we'll do it together. Okay. The question has asked us to prepare a trading, technically a P&L account, but yeah, trading account will come part of it and a balance sheet. Let's write the format first and then we'll see what information can be used. Let's start. Trading, or you can call it as profit and loss account itself. Profit and loss account of PQR Limited for the year ended 31st March 2023. Particulars amount, then balance sheet of PQR Limited as on March 31, 2023. Liabilities amount, assets amount. Liabilities amount and assets amount. Okay, let's look at the data. They have initially talked about GP margin, NP margin, raw material consumed is 20% of works cost, direct wages, stock, all ratios are given. Tell me which will be the starting point here. With the fixed assets, I will calculate current assets, I'll calculate sales. Once sales is done, it will help us in doing lot other things. Note 1, computation of sales. Note 1, right, computation of sales. Computation of sales. Fixed asset by sales is equal to 1 by 3. Fixed asset by sales is 1 by 3. 1 by 3. Fixed asset by sales is 1 by 3. How much is the fixed asset? 26 lakh divided by sales is 1 by 3. Tell me the sales figure. Sales is 78 lakh. Sales is 78 lakh. Any doubts on this? Clear? Can you proceed? Any doubts on this? Now, right, buy sales, buy sales, 78 lakhs, buy sales is 78 lakhs. Then we have some more information in the question which we can use. They have said gross profit is 15% of sales. So in the other side, leave some two, four lines to gross profit, to gross profit, to gross profit. How, what percentage? 15% into 78 lakh. 15% of sales, 11 lakh 70,000. GP is 11 lakh 70,000. 15% of 78 lakh. To gross profit, 15% of 78 lakh. Clear? Any doubts on this? Then balance is COGS. Now I assume COGS and works cost is same, because in the cost sheet format, if you see works cost, after that those 5 line items used to come, that will give you COP, then opening and closing stock used to come, and we used to get COGS. No other information. So the gap is the COGS. In that, 20% is raw material, 10% is wages, balance will be some other expenses. We don't know what are those expenses. So in the debit side, to raw material, we are not going to write opening and closing stock. To raw material, 78 lakh minus 1170. This is the COGS. This is the COGS into what percentage they've set? Into 20%. 13 lakh 26,000. To raw material, 1326. 78 lakh minus 11 lakh 70 into 20%. What's the next expense? To direct wages, 78 minus 1170 into what percentage? 10%. 6 lakh 63,000. To other expenses, 70%. 20% is raw material, 10% is wages, 70% is other expenses. 40, trading account is over. P&L will close it. Any doubts on this? We just got sales. With the sales, we got COGS. COGS is equal to works cost is the understanding here. Any doubts on this? Get a total 78 lakh. Come down by gross profit 1170. By gross profit 1170. Two expenses will be balancing figure. Net profit data is given in the question. To net profit, 8% of sales, 6 lakh. Balancing figure is expenses. 5 lakh. That's all. Your P&L part is over. Moment we got sales, we did working of every other item and completed this. Any doubts on this? Can we proceed? Clear? Any doubts on this? Done? Okay. Next, tell me which ratio should I use for balance sheet part. Fixed assets to current asset will give me current asset, and then we'll try to break it into subparts if possible. But fixed assets to current assets. Next, note 2, computation of current assets. Computation of current assets. Fixed asset by current asset. What is the ratio they've said? 13 by 11. 26 lakh by current asset is 13 by 11. Let me know the current asset figure. Current asset is 22 lakh. Break this into 3-4 parts. First is debtor. Other parts I'll explain. First is debtor. Question has mentioned something about debtor. Debt collection period how much? 60 days. All sales are on credit. I'm assuming 360 days in a year. 365 will lead to a lot of rounding off part. I'll take it as 3. Can I take 365? Yes, you can take. I'm assuming 360 days in a year. Debtors is what? 60 days. So debtors arrow mark down. 78 lakh into 60 by 360. 60 by 360. Debtors is 78 lakh into 60 by 360. How much? If you want, you can write an expanded formula and get to this. Debtor days is equal to sales. Debtors by sales into 360. Go to the other side. Automatically, the final number is this. Any doubts on this? Debtors is 13 lakh. We'll write this in some time. Is there any other current asset mentioned in the question? Stock of raw material 3-month usage. Now, till now we did not see stock of raw material, but here we are seeing. Very simple. Stock of raw material means raw material consumed into 3 by 12. Raw material consumed. Stock of raw material is on raw material consumed. If it is stock of FG, then it was on COGS. Stock of FG is normally on the COGS. And credit sales is on, sorry, debtors is on credit sales, creditors is on purchases. Stock of raw material will be calculated on raw material consumed. So stock of raw material, next item, stock of raw material. Raw material consumed. How many months they have mentioned here? 3 by 12. Tell me raw material consumed from the trading account. From the trading account, how much? 13 lakh 26,000 into 3 by 12. 3 months into 3 by 12. How much? Stock of raw material. Raw material is on raw material consumed. Raw material is on raw material consumed. Till now, none of the question had stock of raw material. First question where we see stock of raw material calculated based on raw material consumed. 2 raw material consumed is there in your trading account. 2 raw material consumed is there in your trading account. Any doubts on this? Some of you look a little confused. Is there a doubt? Any doubts on this? Can we? Which item? Stock of raw material. Question says 3 months usage. So 3 months usage means into 3 by 12. Usage means raw material used. Raw material used, which is raw material consumed, which is this part. Raw material consumed is 20% of works cost. So in the trading account, we have calculated raw material consumed 13 lakh 26,000 into 3 by 12. 3 by 12. What is 3 by 12? Is the raw material usage period. They have said 3 months raw material we will maintain. Any doubts on this? Clear? Next, stock of FG. This part they have clearly mentioned in the question. What is stock of FG? Tell me the works cost figure. 66 lakh? 30,000. Calculate this. 3 lakh? Any doubts on this? I'm breaking the 22 lakh into various subparts. Breaking the 22 lakh into various subparts. First was debtors, sales into 60 by 360, stock of raw material consumed into 3 by 12, stock of FG, 6% of COGS. 6% of COGS. They could have mentioned stock of FG using stock turnover ratio also, but they have said 6% of COGS. Is there any other current asset reference in the question? No other reference. Other current asset are technically cash balancing figure. Of the 22 lakh, subtract all of that. From how much? 1 lakh 70,000. Now, asset side part is over. Let's write this in the asset side. Fixed asset we know. Current asset breakup we know. Asset side is over. We'll have to close the liability side part. 170, 700. Clear? Done? So here in the asset side, fixed assets, how much is the fixed asset figure? 26 lakh. Current assets, we have the breakup. Debtors was whatever note number, I think note 2 or 3, whatever. Debtors is 13 lakh. Stock of raw material, 331 500. Stock of FG 3 397 800. Cash 1 lakh 70,700. Asset side part is over. We'll have to work on the liability side part now. Asset side part is over. Any doubts on this? 26, 13, 331, 397, 170, 700. Any doubts on this? Now, I will use current ratio. This will give me current liability. After current liability, I'll use long-term loan to current liability. This will give me long-term loan. Next, note 3, computation of current liability and long-term loan. Current liability and long-term loan. Current ratio is equal to 2. Current ratio is equal to 2. How much is current liability? 11 lakh. Breakup, I don't think so is possible for this 11 lakh. We'll write it as it is. No creditors, all that information is not there. Any doubts on 11 lakh? Clear? In the same part, long-term loan by current liability. Long-term loan by current liability, how much? 2 by 1. 11 lakh by current liability. Long-term loan by 11 lakh. How much is the long-term loan? 22 lakh. Any doubts on this? Any doubts on this? So write this here. Some 2-3 lines gap. Long-term loan, we got 22 lakh. Note 3. Current liabilities, we got note 3, how much? 11 lakh. Total, can you tell me the total of the asset side? 48 lakh. 48 lakh is the asset side total, which means this is 15 lakh, but don't write 15 lakh as it is. There's a breakup between capital and reserves and surplus. Capital to reserves and surplus is how much? 1:4. So write share capital, reserves and surplus. Share capital, reserves and surplus 1 is to 4. Split 15 lakh in the ratio of 1 is to 4. Balance figure in the ratio of 1 is to 4. They have given ratio of capital to reserves and surplus. If that was not given, I wouldn't have tried breaking this. I would have shared it as share capital and reserve net worth 3 lakh and 12 lakh. 15 lakh is the balancing figure. Split it in the ratio of 1 is to 4. Split it in the ratio of 1 is to 4. Any doubts on this? Split in the ratio of 1 is to 4. Any doubts on this? Clear? 15 lakh is the balancing figure split in the ratio of 1 is to 4. Clear? With this, we are done with this question. We'll take a break of 30 minutes. We'll resume again at 10 o'clock. Okay, let's continue with the discussion. We'll do few more questions on ratio analysis just to get more comfort. We're done till 28. I'll come back to some of these questions. I'll first pick the two little bit of challenging or the complex question, and then I'll come back to these. Let's do first question 31. This will have a little bit of unique challenges. You'll understand as we do. Using the information given below, complete the balance sheet of PQR Private Limited. Current
Sir,
ratio. Sorry. Yep.
sir, I think your screen is not visible.
Okay. Yeah, it is visible. It will be visible now. Current ratio
Yes, yes.
1.6 is to 1. Cash and bank balance 15% of total current asset. Debtors turnover ratio. Stock turnover in brackets OGS. Creditors turnover in brackets OGS. Gross profit. Capital gearing ratio, depreciation rate, and net fixed assets. Certain information has been given, and they have asked us to prepare a balance sheet whose format is given to us, saying share capital amount is given, reserves and surplus we don't know, long term debt we don't know, credit current liability breakup we don't know, creditors we don't know, provisions we don't know. Overall is 6850. Overall they have written, but the breakup is not there. Similarly, fixed assets opening WDV is not known, depreciation is not known, stock, debtors, cash and bank. Lot of information has been given in the question. Balance sheet format is given. Nothing much for me to explain initially. You first open the balance sheet format, but let's keep it as two amount columns: liabilities, amount and amount, one inner column and outer column. Liabilities, amount, amount, assets, amount, amount. Question 31. Liabilities, amount, amount, assets, amount, amount. Copy the format as it is, whatever they have given with the figures. Share capital. You need not write the question marks. I'm writing question mark also, but you don't write that. Okay, this is the scenario. We'll have to get all these question marks. Share capital, they have given reserves and surplus, we don't know. 12% long term debt, we don't know. Creditors, provision, overall is 6850. That amount they have given, but breakup, we don't know. Opening WDV, we are not aware. Depreciation, not aware. Current assets, not aware. So, a lot of information we have to calculate. Format given in the question. So, I'm following the format as it is with no changes. Just that I wanted one inner column and outer column to show the calculation. Done with the format. Can we start? Let's look at the ratios. Current ratio 1.6 is to 1. Let's use that. I know the current liability. Current liability is 68 lakh 50,000. Breakup, obviously, I don't know. I don't know the breakup of that, but 68 lakh 50,000 is given in the question. Note 1, computation of current assets. Computation of current assets. Except for the last working note, everything else will be simple only. In the last, in the end, you will see some challenge here. Current ratio is equal to current assets. I'll not be explaining all these part in detail. Only area I'll spend more time is that last adjustment. This and all you should be able to do on your own also. No need to even look at the screen. Outer column 1 crore 9 lakh 60,000. 1.6 is the current ratio given in the question. With that, we have got one computation done. 1 crore 9 lakh 60,000. Any doubts on this? Can we proceed? Cash and bank balance, self-explanatory. 15% of total current asset. Please write the cash and bank balance. 15% of, no need to do any working note also. 15% of current assets. 16 lakh 44,000. Self-explanatory. Nothing much for me to see in this cash and bank balance calculation. Any doubts on this? Can you proceed? Any doubts? Okay. Debtors turnover ratio 12 times. Do we have the sales information till now? Do we have the sales information? No, we'll see later. This is the trickiest part. The debtor turnover ratio will be the trickiest part. You will understand later. Stock turnover ratio on COGS 16 time. I don't know the COGS. Creditor turnover ratio. I don't know the COGS. GP ratio 20%. GP ratio is 20%. So I don't know the sales figure as of now. GP is 20%. COGS is 80%. Capital gearing ratio. What is the formula? Debt plus preference. Preference is not there in the question. Debt plus preference divided by share capital plus reserves and surplus. So the formula is debt by share capital plus reserves. Debt I don't know. Debt I don't know. As of now, debt figure is not available. If it was available, okay. Debt figure is as of now yet to be calculated. Just give me a minute. Okay. Debt figure is as of now calculated, yet to be calculated. Reserves figure is also yet to be calculated. Let me park it for the time being. This ratio I'll be able to use, but in some time. Depreciation rate 15% on WDV. Net fixed assets is how much? What is net fixed asset is? This question mark is 20% of total assets, which means current asset is 80% of total asset. Current asset is 80% of total asset. Net fixed asset is how much? 20% of total assets. Next working note, computation of note 2, computation of fixed assets and total assets. Fixed assets and total assets. Fixed assets and total assets. Total assets is equal to fixed assets plus current assets. Total assets is equal to fixed assets plus current assets. What did the question say about fixed assets? 20% of total. Fixed assets is 20% of total asset. So this side you can write 0.20 TA. Total asset 0.20 TA. Current asset you know. Please calculate the total asset. 1 crore. How much you said total asset? 1 crore. 37 lakhs. 1 crore 37 lakhs. Somewhere we are moving towards closure. 1 crore 37 lakh. Any doubts on this? Any doubts on 1 crore 37 lakh? Fixed assets is equal to 137 into 20%, or 137 minus current asset, whatever way you want to call. How much is the figure? We have now got a lot of question marks covered. Total is 1 crore 37, both the side, asset side and liability side. 137 is the total. Fixed assets outer column is 2740. Net fixed assets is 2740. Balance sheet is almost in place. Only thing is those internal question marks we have to calculate. They wanted some breakup and all. If question did not give me a balance sheet format itself, I could have closed it with this, assuming I'm not able to break it further. But here I'll have to somehow break it, and there is information to break it. Any doubts till this? What's the depreciation rate they mentioned? 15% on WDV. Now listen. The WDV is 100. Depreciation is 15. Outer column is 85. Outer column is 85. Tell me now, 85 equal to 2740. What is 100? 85 equal to 2740. What is 100? You will get some rounded off number. That's okay. 85 equal to 2740. Outer column is 85. 100 equal to question mark. 15 equal to question mark. 85 equal to 27 lakh 40,000. What is 100 you got? 32, 23, 529. 15% of that is 483, 529. 483, 529. Till this also it's okay. Great. We have got all these numbers. Any doubts on this? $85 equal to 27 lakh 40,000. What is 100? Outer column is 85. 100 minus 15. Now, can we calculate capital employed in this? Can we calculate capital employed? Fixed assets plus current asset minus current liability. Capital employed will be broken down into two: equity and debt, and there is some relationship between the both they have given. Next, computation of share capital, computation of reserves and surplus and long term debt. 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 And long term debt. Capital employed is equal to fixed assets plus current assets minus current liability. Fixed assets plus current asset minus current liability. 1 crore 37 lakh, which is the total asset. minus current liability 6850. 6850 na? 6850. Any doubts on this? 68 lakh 50,000. Any doubts on this? Break this into equity, debt. Equity includes share capital and reserves. Okay, equity and debt. What is the capital gearing ratio given in the question? So listen, what is capital gearing ratio is debt by equity is equal to 0.6 by 1. 0.6 by 1. Debt by equity is what? 0.6 by 1. 0.6 times means 0.6 by 1. Debt is 0.6, equity is 1. Listen, if the question use the word debt ratio, debt ratio means debt by capital employed. So debt is 0.6, equity is balance 0.4. If they use the word debt ratio, debt is 0.6, equity is balance 0.4. If they use the word debt equity ratio or capital gearing ratio, debt is 0.6, equity is 1 time. Denominator equity is 1 time. So please break it as 0.6 and 1. Break it as 0.6 and 1. Let me know the numbers. Debt is 0.6, equity is 1. 20, 2568, and this one 42. The breakup of this is share capital 25 lakh, balance is reserves. Okay, that is okay. We'll directly write it in the balance sheet. Any doubts on this? Debt equity ratio is given, or capital gearing, whatever name you want to call. Preference anyway is not there. If preference was there, then that would be added to the numerator in the capital gearing ratio. Any doubts on this? Any doubts on this? Debt equity ratio is zero point 0.6, zero point 0.6 by 1. 0.6 times means 0.6 divided by 1. Debt is 0.6, equity is 1. If they use the word debt ratio, debt is 0.6, capital employed together is 1. Capital employed together is 1. So what is debt ratio? Is debt divided by capital employed. What is debt equity ratio? Debt divided by equity. So I say play around these two ratios many a times. So 0.6 and balance is not 0.4. 0.6 and this is 1. If it's the other way around, it would have become 0.6 and 0.4. Let's close the balance sheet till this. Long term debt, note whatever number, I think note 3. What is the value you got for long term debt? 25, 68, 750. Reserves and surplus 42, 81, 250 minus 25 lakh. So almost there, but the internal question marks are pending. They have given stock, debtors, and somewhere creditors and provisions are to be calculated, and this was the reason why we have done this question itself. I wouldn't have done this question if this adjustment was not there. Any doubts till this? Can we proceed? Okay. Do we have the debtors turnover ratio needs sales and debtor? Debtors turnover ratio needs sales and debtor. Do we have sales in the question? No. Do we have debtors in the question? Yes, participate. No, no, amount. Do we have debtors amount in the question? I don't have both. So I cannot use debtors turnover ratio directly, because normally one of them will be there and we will use the ratio. Do you have COGS in the question? No. Do we have stock in the question? No. Okay. Till now, okay. Can I calculate stock and debtors put together will be how much? Is it possible? Stock and debtors put together, not breakup. Stock and debtors put together. Possible? Okay, now listen. Very key adjustment. Listen, you write it in some time. Okay, first I say debtor turnover ratio is equal to sales by debtor. How much is the debtor turnover ratio? 12 is equal to X Debtor is X, okay. Sorry, sales is X, okay. So my debtor is equal to X by 12. Debtor is equal to X by 12. I don't know the figure, I'll see in some time. Then inventory turnover ratio is how much given? How many times? COGS by stock. 16 is equal to, what is the GP margin? COGS is 0.8x. COGS is 0.8x divided by stock. Stock is equal to 0.8x by 16. Debtor plus stock. I have a number and somewhere answer to X will come. Write this. Computation of debtor and stock. Write till this. Debtor turnover ratio is equal to sales by debtor. X by debtor. Debtor is equal to X by 12. And other side stock is 0.8x by 16. X by 12. 0.8x by 16. Any doubts till this first? I don't know the figure for sales. I don't know the figure for COGS. I don't know the figure for debtor. I don't know the figure for inventory. So this is one of the most important adjustment of the question. X by 12, 0.8x by 16. Any doubts till this first? Any doubts till this? Can we proceed? Can we proceed? Now write debtor plus stock is equal to 1 crore 9,60,000 minus the cash balance 1644. 1 crore 9,60,000 minus 1644. 1 crore 9,60,000, which is the current asset total. In that cash amount we knew. We don't know what is debtor, what is stock. We are not aware of these two numbers. Debtor is X by 12. Inventory is 0.8x by 16. You can write along with me, equal to how much? 93 lakh. I'll convert, either you can solve it as fraction or convert into decimal. I'll do it in decimal itself. X by 12. X by 12 is 1 divided by 12 is, let it be more decimal to avoid rounding off gap, 0.083333x to avoid rounding off. To avoid rounding off gap, I can solve in fraction also. 1 divided by 12, 0.08333333x, 0.8 by 16, 0.05x is equal to 9316. To avoid rounding off difference, I am writing 33333, else you will have to solve it in fraction, whichever way you are comfortable. This is faster to do. 0.133333 x is equal to 9316. Let me know what do you get as x. X is the sales. Six crore 98 lakh 70,000. You can solve this in fraction if you want. That's up to you. You'll have to see 12 and 16. You'll have to find out the common number, all that your wish. Or I find it easier to explain this way. I've done it. 6 crore 98 lakh 70,000. Any doubts on this? Any doubts on this? 6 crore 98 lakh 70,000. Any doubts on this figure? This is the sales number. Sales number is 6 crore 98 lakh. Normally, we use only one ratio. Here we have to use two ratio together, form an equation and then solve it. So this was a tricky adjustment, not normally done. Any question we have done till now, we have never combined two ratios together. Any doubts on this? Debtor equal to 6 crore 9870 divided by 12. Divided by 12. How much you get? 58 lakh 22 500. 58 22 500. 6 crore 98 lakh 70,000. One of the most important part of the calculation. 6 crore 98 lakh 70,000. Important segment of the computation. Any doubts on this? Inventory 0.8x 0.8 698.70 divided by 16. How much? With this, asset side is over. That breakup we have got, and obviously the current asset total and all should match. Any doubts on this? 58 22 500 34 93 500. We had to combine two ratios. Again, I'm repeating, it's not a normal adjustment. We normally don't combine two ratios together. This is the first question where I had to do two ratios combined together, and there's one more problem where we'll be combining ratios. Any doubts on this? Clear? So the breakup, what is the stock figure you said? 34 93 500. Whatever is the note number, I don't know the note number. It could be 4 5. You write the note properly. Please number your notes and write it, okay? And 58 22 500. Everything is done. We just need to break the creditors and provision part. Any doubts on this? Any doubts on this breakup which we have calculated? Again, I'm repeating, stock turnover ratio and the inventory turnover ratio has been combined together. Has been combined together to compute these two missing information. Any doubts on this? Can we proceed? Okay. They have given creditors turnover ratio. What is the formula for creditors turnover? Normally it is purchases by creditor, but here it is COGS by creditor. Here it is COGS by creditor. Next working note, computation of creditor. Creditor turnover ratio is equal to COGS by creditor. Six crore 9870 into 0.8 divided by creditor. Six crore, it was 98 only, no? Yeah, 698 into 0.8 divided by 10. How much? 55. Provision is balancing figure. 12. Any doubts on this? One of the trickiest adjustment where we had to combine two ratios. We had to combine two ratios together to get to the solution. Any doubts on this? Two ratios have been combined together here to get to the answer. Any doubts on this? Clear? Any doubts on this? Done? Please go through the solution. I give a minute or two to you. Please go through the solution. Little bit of a tricky question. Okay. I proceed to another question, which is again going to be an extremely challenging question where we may have to combine more ratios together. You will understand what we are doing. Let's come to 32. From the following information, you are required to prepare a summarized balance sheet for Rudra Limited for the year ended 31st March 2023. Debt equity ratio 1:1, current ratio 3:1, asset test ratio 5:3, fixed asset turnover ratio on the basis of sales 4 times, stock turnover ratio on the basis of sales 6 times, cash in hand, stock to debtor, stock to net worth, capital to reserves, gross profit is 20% of cost. Rather than giving it on sales, they have given it on cost. COGS to creditor 10 is to 1, and interest for the entire year is yet to be paid on long term loan at 10%. Interest is yet to be paid on the loan at the rate of 10%. They have given a lot of information. You first go through it, then I'll explain it, and then we'll start doing this. Go through the question. Okay, let's see this question now. Debt equity ratio 1:1, which means debt and equity is same. Current ratio 3:1. Asset test ratio is given, which is the difference between your current assets and quick asset. Fixed asset turnover ratio on the basis of sales. Fixed asset turnover is sales by fixed asset is 4 times. Stock turnover is also on the basis of sales. On the basis of sales, which is sales by stock. Cash in hand is given. Stock to debtor, this ratio we have not seen anywhere, but they're saying stock to debtor is 1:1. Technically, both are same. Sales to net worth is given. Capital to reserves, that is between the whatever equity value you get, net worth value you get, the breakup is 1:2, capital and reserves. GP is 20% of cost, and COGS to creditor is 10:1. Interest is yet to be paid on the long term loan at 10%. Now, in this question, they have not given us any number for us to start. Only thing I know is cash is 5 lakh. Cash is 5 lakh. As I read, I understand debt and equity is same. Debt and equity is same. The value of debt and equity is same. Current ratio is 3:1, which means current liability is 1/3 of the current asset, or current asset is 3 times of current liability. I don't know current asset, I don't know current liability. Asset test ratio, I don't know quick asset, I don't know current liability. Fixed asset turnover ratio on the basis of sales. Do we know the sales number here? No. So here first I'm going to prepare a balance sheet where everything will be written as X, and then you will prepare another balance sheet. We'll prepare two balance sheet. One balance sheet with X, another balance sheet with proper value. Why are we doing two balance sheet? You will understand. Working note 1. Note 1. Computation of all assets and liabilities. Computation of all assets and liabilities. Let us assume sales to be, why is this assumption and all, you'll understand. Let us assume sales to be X. We are not going to do a proper balance sheet now. We'll just somehow get to the answer to sales, and automatically everything else will fall in place. Liabilities amount, assets amount. How much is the fixed asset turnover ratio given in the question? Guys, I want participation, please. Fixed asset turnover ratio 4 times on the basis of sales. What's the formula for fixed asset turnover ratio? Fixed asset turnover ratio is equal to sales by fixed asset. What is the ratio they have given? 4 is equal to X FA. So FA is equal to X by 4. Fixed asset is X divided by 4. 4 times rotation has happened. Fixed asset is 1/4 of that. Right? Fixed asset X by 4. Fixed asset is X by 4. If you have a doubt, then you please write this calculation. Fixed asset turnover ratio is equal to sales by fixed asset. You can write this. Fixed asset turnover ratio, sales by fixed asset. 4 is equal to X by FA. Sales by FA, X by FA. 4 equal to X by FA. Fixed asset is equal to X divided by 4. fixed asset is equal to x divided by 4. Any doubts on this? X divided by 4. Any doubts? Then next, right, stock turnover ratio is equal to, what is the formula normally? COGS by stock, but here they have not said COGS, they have said it on sales. Sales by stock, sales by stock. How much is the ratio they have given? 6 is equal to X by stock. Stock is X divided by 6. Stock is X divided by 6. Very, very tricky question. Trickier than even the previous one. Stock is X divided by 6. Any doubts on this? Now, right. Current asset, underline that. Stock X divided by 6. We'll write the amounts for these in some time. Debtor, something is mentioned in the question about debtor. Something is mentioned in the question about debtor. Stock to debtor is 1 is to 1, which means stock and debtor is same. 1 is to 1, so same X by 6. Same X by 6. Stock and debtor is same. Stock and debtor is same, X by 6. Any other current asset mentioned in the question? Cash is how much? 5 lakh. Clear? Any doubts on this? This side, net worth. When we do a proper balance sheet, I'll break the net worth into share capital, reserves and all. As of now, net worth. We are not getting into breaking this. Net worth. They've given some ratio for net worth. What is the ratio they've given? Sales divided by net worth is 4 times. Sales by net worth 4 times X by net worth. Net worth is equal to how much? Net worth is X divided by 4. What is the next item which will come in the liability side? Net worth we have written. What else can come in the liability side? Long term debt, for which they have mentioned debt equity ratio is what? 1 is to 1. Next is long term debt or debt. 1 is to 1 means same figure, X by 4. Same figure, X by 4. In this, some interest is yet to be paid. All that will be part of current liability. Any doubts on this? First line said debt equity ratios 1 is to 1. Debt equity ratios 1 is to 1, which means debt and net worth is same. Debt and net worth is same. Any doubts on this? Any doubts on this? Debt equity ratios 1 is to 1. Like stock and debtors was 1 is to 1. Debt equity is 1 is to 1. Debt and equity is same. Current liabilities. Current liabilities. How much is the current ratio? 3 is to 1. Listen now. More adjustment needed. X by 6 plus X by 6 plus 5 lakh. This is the current asset total. X by 6 plus X by 6 plus 5 lakh whole divided by 3. Whole divided by 3. X by 6 plus X by 6 plus 5 lakh plus 5 lakh whole divided by 3. Whole divided by 3. None of the items are there. Question did not give any information. They made it very complicated question, but a good problem. Once you understand the X calculation, everything is over. X by 6 plus X by 6 plus 5 lakh divided by 3. Why divided by 3? Current ratio given in the question is how much? They have mentioned the current ratio in the question as 3 is to 1. Write this now. We'll now write a total. Any doubts till this? Any doubts till this in the total, right? X by 4 plus x by 4. This 3 is technically 1 by 3, okay? This 3 is I'll have to do into 1 by 3 to that number. So x by 6 into 1 by 3, x by 6 into 1 by 3, 5 lakh into 1 by 3. This divided by 3 will become 1 by 3. Divided by 3 is nothing but 1 by 3. X by 6 into 1 by 3, x by 6 into 1 by 3, 5 lakh into 1 by 3. 5 lakh into 1 by 3. Till this, whatever I did was related to the FM part. Now onwards, it's only math. It is going to be math. X by 6 into 1 by 3, which is x by 18. Again, x by 18 and 5 lakh divided by 3. 5 lakh divided by 3. X by 4 plus x by 4 plus x by 18. X by 18 plus 5 lakh by 3 is equal to, technically, and you'll have to solve this now, is equal to x by 4 plus x by 6 plus x by 6 plus 5 lakh. We have to equate these two and get to the answer. This will give us the value for sales. I'll repeat again. Current liability x by 6 into 1 by 3, x by 6 into 1 by 3 and 5 lakh into 1 by 3. 5 lakh into 1 by 3. Any doubts on this? Any doubts on this? Clear? So this is how the equation looks like as of now. To avoid the rounding, to avoid the fraction working, x by 4 is 0.25x plus 0.25x plus x by 18, 0.0555 to avoid the rounding of gap, x 0.0555. Technically put together it's 0.111111. So I am just writing it in this way so that it's easier for us to solve. Else you will have to do the your LCM root and other things you have to do. I don't want to get into that now. 0.25 plus 0.25 plus 0.055555, 05555, 5 lakh divided by 1 lakh 66,667 is equal to you please solve this, you will get to know the sales figure. You can do it for whatever number of decimals is there in your calculator. No other choice, otherwise I'll have to do it through the fraction route, whichever way you want to do, that's up to you. My job was over the moment we prepared the balance sheet with x being there. This segment of the calculation you will have to manage. I'm getting 1 crore 20 lakh as X. If we don't round off properly, well, this should also be 0.3333. Just to, you will get 1 crore 20 lakh. It should be 0.33333. Can't help it. I don't have any other option here. It'll be 1 crore 20 lakh. You do it, I'll explain again one more time. So this is to avoid rounding off difference. I should not work with this. Ideally, I should do it with fractions. I've seen in the past some students struggling with working with fraction. That's why I've not done. But ideally, this is the way work. You see in the solution, you will see here. It is worked with fraction. Common denominator will become 36. Common denominator will become 12. And we should ideally work with fraction. I've seen students struggling with fractions sometimes. So that's why I've done it in decimal. Ideally, this question we should solve it like this with the fractions itself. I can show you how to do with fractions also, but ideally to do with fraction, here I did it with decimal because decimal is easier to do, just to save some time. How many decimal is whatever number of decimal your calculator can accommodate. So you can keep doing it till the 12th decimal. In my calculator, it's still the 12th decimal. It's the same number, 11111, 22222, or 33333. The same number will get repeated. Here the calculation says 0.61111111 plus 1,66,667 is equal to 0.05833333 plus 5 lakh plus 5 lakh. This is the simplified version, and finally I get X is equal to 1 crore 20 lakh. Any doubts on this? Any doubts on the calculation? I'll now show you what to do in fraction route. Okay, your wish. You want to do decimal, you want to do fraction, that's up to you. Any doubts in this? Any doubts on this? Can we proceed? Clear? Okay, now coming to the fraction root. Now 4, 18 and 3. There are three numbers here. I'll have to find out a number which is divisible by all the three. If I take number 4, 4 divided by 4 is possible, but 18 is not possible. If I take 18, 18 divided by 18 is possible, but 18 divided by 4 will not happen. So the common number to divide all of this is 36. 36 if you take, so first number, so I can do it like this now, right? Other option, 36. 36 is the common number. 36 is the common number. Common multiple. 36 is the common multiple. X by 4 will become 9x by 36. X by 4 will become 9x divided by 36. So 9x plus 9x. X by 18 will become 2x by 36. 5 lakh by 3 will become 60 lakh by 36. 5 lakh by 3 will become 60 lakh divided by 36. I need a number, common number is 36. X by 4 will become 4 into 9, 9x by 36. X by 4 into 9, x by 18 into 2, x by 18 into 2, and 5 lakh by 3 into 12 plus 60 lakh is equal to 4, 6, 6. What will be the common number for 4, 6 and 6? 12. X by 4 will become 3x by 12, 2x by 12, 2x by 12 plus 60 lakh. Plus 60 lakh. This is another way, whichever way you are comfortable, that's up to you. 9x plus 9x plus 2x plus 2x plus 60 lakh divided by 36 is equal to 3x plus 2x plus 2x plus 60 lakh divided by 12. This side 3 times, this side 1 time. 12 and 36 is cancelled. 3 goes to the other side. 9 plus 9, 18. 22x plus 60 lakh is equal to 3 into 21x, 1 crore 80 lakh. X will be equal to 1 crore 20 lakh. Whichever way you are comfortable. If you want to work with fraction, work with fraction. This last batch when I did with fraction, some struggled. So I've done it in decimal. Decimal is a challenge, work with fraction. Fraction is a challenge, work with decimal. That's your wish. X is 1 crore 20 lakh. X is 1 crore 20 lakh. Any doubts till this first? 1 crore 20 lakh. You either work with fraction or work with decimal. That's up to you. Any doubts on this? Okay, listen, I'm going to give you now 5-6 minutes. You have to prepare the balance sheet again now. Fixed asset 1 crore 20 divided by 4. Stock 1 crore 20 divided by 6. Debtor 1 crore 20 divided by 6. Wait. Net worth, you'll have to break it into two. Net worth, you'll have to break it into. What are the two items for net worth breakup? Share capital and reserves and surplus. What is net worth? 1 crore 20 divided by 4. 1 crore 20 and then you have to break it. Debt 1 crore 20 divided by 4. Current liability, current assets total you put divided by 3. That you have to break it as creditors is one item. Second item is interest payable. What is interest payable is on the loan, interest is yet to be paid. The question has said 10% long term debt is given in the question. Interest is yet to be paid on the long term loan at the rate of 10%. In the current liability, one of the item will be and the other item will be other current liability. Balance is other current liability. Balance sheet, I can do it now itself. Asset side is fully over, okay? Liability side, net worth has to be broken down and liabilities have to be broken down. Current liability has to be broken down. Now prepare note 2 or main working note. Balance sheet of Rudra Limited, whichever year they have asked. Wherever X is there, you substitute 1 crore 20 and complete the balance sheet. I give you around 5 minutes. Any doubts? First, wait. Any doubts on this calculation? Assets and liability side calculation. I'll explain maybe one more time. We had assumed sales as X, got everything in terms of X. Total current asset, total current liability, equated both. Either work in decimals or work in fraction, whichever way you are comfortable. Clear? Any doubts on this? Start doing it. 5 minutes for you. Okay, I wanted a balance sheet to be prepared, which is exactly the same format. Just that some breakup will be needed in the calculation. So fixed assets is X by 4, 30 lakh. Stock is X by 6, 20 lakh. Debtors is 20 lakh. Put together is 75 lakh. Net worth is 30 lakh, X by 4, but I'll have to break it up as share capital and reserves. 30 lakh, but I'll have to break it. To break this, they've given a ratio. What's the ratio they've given? Ratio of capital to reserves is what? 1 is to 1 to 30 lakh in this ratio. 30 lakh in this ratio, which is 10 lakh, 20 lakh. 10% debt. 10% debt is 30 lakh. 10% debt is 30 lakh. Current liability balancing figure 15 lakh or 1/3 of 45 lakh, whatever way you want to call. In that I have creditors, interest payable and other current liability. Interest payable is 30 lakh into 10%. Now creditor is on COGS. Normally the question gives GP margin on sales, but here they've given GP margin on cost. Doesn't really matter. Any doubts till this? Some of you have not done the creditors calculation. I don't know why. So sales is 1 crore 20 lakh. 1 crore 20 lakh. I break this as COGS GP is 20, COGS is 100. GP margin is given on cost here. GP is 20, cost is 100, sales is 120. 120 is equal to 1 crore 20 lakh. COGS is 1 crore and gross profit is 20 lakh. 1 by 5 of cost. 1 by 5 of cost. Cost is taken as 100. GP is 20. Sales is 120. We used to do this as a common adjustment when we did in cost accounting. Sales margin can be on cost, can be on sales. So COGS is 1 crore and creditors is, they have said COGS to creditor is 10 is to 1. So creditor is 1/10 of COGS. Creditor is 1 by 10 of COGS. Any doubts on this? Any doubts on this? Some of you did not do this calculation. I don't know why. Sales is 1 crore 20 lakh. Broken down as COGS and gross profit. COGS is taken as 100. Profit is taken as 20. Sales is 120. 120 equal to 1 crore 20 lakh. 100 equal to 1 crore. 20 equal to 20 lakh. So creditor number is 1 crore divided by 10, which is 10 lakh. Other current liabilities 2 lakh. Any doubts on this? Any doubts on this? Clear? Any doubts on this part? Done. Balance sheet is over. The important or the trickiest adjustment is how did we get to the sales number? Clear? I give you 2 minutes. Please go through that calculation again. In case you have a doubt, let me know. 2 minutes for you to go through that calculation of sales. Okay, we proceed ahead. I'll come to 33. I'll discuss it and tell you to solve the question. In case there is any help needed from my side, I'll explain, but otherwise major chunk of it you are going to do this. Following information and ratios are given in respect of Aqua Limited for the year ended 31st March 2023. Current ratio, participate along with me. What is the formula? Current ratio. Current assets by current liability. Current liability is there in the question. Current liability is 3 lakh 10,000. With this, you will get the current asset figure. You will have to break that as inventory, debtor, loans and advances and bank. Asset test ratio, what is the formula? Quick asset by current liability. This will give you quick asset. Balancing figure is inventory. So with this question mark is over. Inventory will be over. Inventory turnover ratio based on sales. You have got the inventory based on sales. Get the sales number. Get the sales number. Inventory turnover ratio based on sales. So this will give you the sales information. Sales into 70 by 360. Sales into 70 by 360. 70 by 360 will give you debtors figure. So debtors is done. Earnings per share. Now, what is the use of earnings per share? We are not sure, but somewhere this may come into picture. Earnings per share is 3.5. Maybe I get EAES and get earnings per share or number of shares, something will be there. Current liability 310, okay. Total asset turnover ratio based on sales. Based on sales. Based on sales, total asset turnover ratio, sales by total asset. This will give me total asset. This will give me total asset, and once I get total asset, fixed asset is balancing figure. I know the current asset figure. Fixed asset is balancing figure. So this item is also done. This item is also done. Cash ratio is the maybe okay. That's the reason I'm discussing this question. Cash ratio can be understood in multiple ways. One way of understanding this is cash and cash equivalent divided by current liability. We had a ratio called absolute liquidity ratio. I assume this is what they would have taken. Cash ratios, cash and cash equivalent divided by the current liability. Or I can understand cash ratios, cash as a percentage of total current asset. I'm not sure. Logical to me is cash and cash equivalent divided by current liability. That will give you cash and bank, loans and advances, balancing figure. Liability asset side is over. Asset side is over. Okay, you will do it. I'm not telling you to do. Be in listen mode, and then you're going to do it. Then proprietary ratio. Tell me the formula for proprietary ratio. Proprietor funds divided by total assets, which will give me this figure. equity share capital plus long term debt is balancing figure. Long term debt is balancing figure. Equity capital and reserves and surplus you will get together. Then equity dividend 1,75,000. What is the formula for equity dividend coverage ratio? ED cover. What is the formula? EAES. You will get EAES. EPS formula is EAES number of share. This will give you number of share. Number of share into 10 rupees is equity. Number of share into 10 rupees is equity. Reserves and surpluses balancing figure. Reserves and surpluses balancing figure. I'll explain again and then you'll start doing it. We have current ratio. This will give you current asset figure. Asset test ratio will give you quick asset. Current asset minus quick asset is inventory. Inventory will give you sales. Sales will give you debtors. Earnings per share last usage. Earnings per share is used in the last. Current liability, okay. Total asset turnover ratio, sales by total asset will give you the total asset, fixed asset, fixed asset, total liability, all will come. Cash ratios, cash divided by current liability. Proprietary ratio, proprietor funds divided by total assets. So total assets, I know I'll get the proprietor fund. Long term debt is balancing figure. Using the equity dividend coverage ratio, we will get the EAES. Using the EAES, we'll get the number of share, and using the number of share capital is number of share into 10 rupees. Any doubts on this? Any doubts on this? I'm giving you around 10 minutes, okay? 10 to 12 minutes for you. Start doing it. 10 to 12 minutes for you. Okay, I'll discuss it now. We are required to prepare a balance sheet here. So liabilities amount, assets amount. Format is given in the question. They have given equity share capital, reserves and surplus, long term debt, current liabilities. Current liabilities given in the question is 3,10,000. This side current assets. Current assets we have to break it up. It will be 3,10,000 into 4. This will be the current asset figure, which is 12,40,000. You need not write this 3,10,000 into 4, just for your quick discussion. And the breakup they want is inventory. Inventory is 12,40,000 minus quick asset. What is quick asset? Is 3,10,000. What is the quick ratio given in the question? Into 2.5 into 2.5, 3,10,000 into 2.5. How much is the inventory figure? 4,65,000. Inventory is 4,65,000. Then they've asked for debtors with inventory. With inventory, I get sales. With inventory, I get sales. You said inventory turnover ratio based on sales is how much? 6 times. Sales is 4,65,000 into 6. Into 6, how much? 27,90,000. Debtors is 2790 into how many days? 70 by 360. 542, 500. Cash is 3,10,000 into 0.43. 3,10,000 into 0.43. How much? And loans and advances is balancing figure. Loans and advances from 12,40,000. If you remove all these items, how much you get? 99, 200. Then I use the total asset turnover ratio. Total assets is equal to sales 2790 divided by what is the total asset turnover ratio? 0.96. 29 lakh 06,250. So this is the total. This side 29,06,250, and the balancing figure is fixed assets. The balancing figure is fixed asset with how much? 1666,250. Asset side part is over. In the liability side, we have this proprietary ratio. How much is the proprietor funds? They have said proprietary ratio is how much? So proprietor fund is 29,06,250 into 0.48 into 0.48. 29 0.06250 into 0.48, which is 95,000. Long term debt is balancing figure 29,06250 minus 310 minus 1395. How much is this? 12. 0.01250, and I have to get the equity share capital. Here we have equity dividend coverage ratio, which is EAES divided by equity dividend. The ratio given in the question is 1.6 is equal to EAES divided by 1 lakh 75,000. What is the EAS figure? 2 lakh 80,000. EPS figure is given in the question. EPS is equal to EAES by number of shares. 3.5 is equal to 2 lakh 80,000 divided by number of shares. Number of shares is how much? Number of shares is 80,000. So we go up and do 80,000 into 10, which is 8 lakh rupee. Reserves and surplus balancing figure how much? 5,95,000. Any doubts in this? Once I had explained it, it is more of a practice for you because this chapter focuses on a lot of different kind of question. Any doubts in this? Can we proceed? I'll move to the next question. We'll come back to those two questions which are in between. Question 29. I will explain it. You're going to do as we did the earlier question. Question 29. I'll first do the explanation part and then you can start doing it. Let's see this now. From the following information and ratio, prepare balance sheet and income statement. Income statement means rather than doing it as account form, you'll have to do it in statement form. Average stock given in the question. Current ratio 3 is to 1. Acid test ratio 1 is to 1. Current ratio is 3 is to 1. Acid test ratio is basically your current asset, quick asset by current liability. PBIT to PBT, they're selling PBIT divided by PBT is 2.2 is to 1. Somewhere it will help us. Average collection period 360 days in a year, 30 days. Stock turnover ratio, use sales as turnover. Fixed asset turnover ratio, working capital is given in the question. Net profit ratio, GP ratio, operating expenses excluding the interest part. Obviously, in operating expense, interest is not included, and long-term loan interest is given. Tax nil. Okay, let's understand this. I have average stock. Using the average stock and the stock turnover ratio. Using the average stock and the stock turnover ratio, we will get what? Sales. We normally get COGS, but here we are going to get sales. From sales, COGS is 60%, gross profit is 40%. From their operating expenses 9 lakh, profit before interest and tax will come. What figure you will get? Less interest, PBT. Now, PBIT by PBT ratio is given in the question. PBIT by PBT ratio is given in the question. Sales less variable, less your COGS, gross profit is done, less operating expenses is done, EBIT is done. EBIT by EBT is given, interest is balancing figure. Using the interest, you will get the loan amount also divided by 12%. Divided by 12% will give you the loan amount. Tax is not there. Income statement is done. Okay, income statement part is done. In the balance sheet, tell me which ratio can we use? Current ratio along with working capital. Current ratio along with working capital will give us what? Current assets and current liability. Asset test ratio will give me quick assets. Gap is inventory, which could match this number given here, may not match also because that is average stock. And for balance sheet, I want closing stock. They specifically use the word average stock. For all ratios, stock turnover, sales turnover, all that, I will use the average stock. May match, may not match. I'm not sure. If it doesn't match, doesn't matter. Whatever you get is closing stock. So current asset is done. In the current asset, inventory is done. Debtor you will calculate with average collection period. Debtor you will calculate with average collection period, and other current asset can be balancing figure. How will you calculate fixed asset? Fixed asset turnover ratio will give me fixed asset. In the liability side, I know current liability, I know long term debt. Balancing figure is net worth or equity or share capital plus reserves and surplus put together. I don't think breakup is possible. Any doubts in this? Clear? Start with an income statement and then do the balance sheet. You will be in a position to get it. Average stock may or may not match closing stock. May or may not match. I'm not sure. You start doing it. I give you around 12 minutes. 12 minutes for you to do this. Okay, this again is a simpler question. There was two challenging question alone I had to do. Here, first an income statement is asked in the question. So for the income statement, we start with these numbers. Sales is 10 lakh, which is the average stock, into how many times they have given? Into 5 times. 10 lakh into 5, 50 lakh. 10 lakh into 5, 50 lakh. COGS, GP is 40%, COGS is 30 lakh. Gross profit 20 lakh. Operating expenses given in the question how much? 9 lakh. EBIT 11 lakh. Either I can do EBT with the net profit margin, or I can say EBIT divided by EBT was 2.2. So 11 lakh divided by 2.2, 5 lakh, or you can do 50 lakh into 10%. 6 lakh is the interest component. Then we had to do a balance sheet. Liabilities amount, assets amount. In the balance sheet, multiple items to be calculated. I first write the fixed asset figure. They have given fixed asset turnover ratio in the question. How much is fixed asset turnover ratio? 0.8 times. Sales divided by 0.8 is fixed asset. 62 lakh 50,000. Current assets, working capital given in the question is 10 lakh. So CA minus CL is 10 lakh, and current asset is 3 times of current liability. 3 CL minus CL is 10 lakh. CL figure is 5 lakh and current asset figure is 15 lakh. So this side, current liability 5 lakh. Inventory is 15 lakh minus quick asset. What is quick asset is? How much is the quick ratio given? 1 is to 1. So 5 lakh. It matches 10 lakh. It may not match. Okay, average stock and closing stock may not match. Debtor figure 50 lakh into how many days? 30 by 360, how much? 4 lakh 16,667. Cash balancing figure 83 333. All put together 77. This side, long term debt. Long term debt, interest paid is 6 lakh. What is the rate of interest? 6 lakh divided by 12% is 50 lakh. And the other one is net worth. Net worth or proprietor fund or share capital plus reserves and surplus, whatever way you're going to call. What is the balancing figure? 22 lakh 50. Breakup I think is not there. 22 50. Any doubts on this? Clear? Done. So with this, my second segment of the chapter gets over. In between, some homework questions are there. You complete them. I've discussed most of the homework in the class itself, but some still questions are there. Question 30, when you do at home, part 1 you can do, part 2 you'll not be able to do. I'm yet to explain because that is part of working capital management chapter. Part 1 you complete it, part 2 you ignore it. Question 30 when you do at home, please complete whatever is missing question till 33, because part 4 is what I'll be doing in tomorrow's session. Till 33, in between some 3-4 homework questions are there. Please complete them and revise ratio. Ratio is very, very critical for all other chapters which we are going to do. And practicing any number of questions will not help because every question will be unique in its own form. So you will have to understand the linkages very clearly. Done. We'll end with this. In the last segment, when we did balance sheet preparation, I just wanted to highlight some of the common adjustments which we have done. Common is basically we would have done it in multiple question. There's one combination which is using the working capital and current ratio, using the working capital and the current ratio to compute current asset and current liability. A question may give you working capital figure and will give you current ratio figure. Combination of this together can help us in computing current asset and current liability. Let me see if I have an example on this. Okay, this is an example. If working capital of a company is 1,35,000, current ratio 2.5. Quickly tell me current asset and current liability. Do quickly tell me current asset and current liability. Working capital 135, current ratio 2.5. Current ratio 2.5. Quickly tell me CA and CL first. Other requirements we'll see later. Working capital given, current ratio given. Calculate current asset and current liability. Working capital and current ratio combination. Working capital and current ratio combination, how much? Current liability is 90,000. Current asset is, calculation is very simple. CA minus CL is 135. If the current ratio is 2.5, current asset is 2.5. CL minus CL is 135. 2.5 current liability minus current liability is 1,35,000. Current liability 90,000. Current asset 2.25. If liquid ratio is 1.5, quick asset is 1.5 times of current liability. That is the requirement of the MCQ. But the concept is, if you have current ratio and working capital, you will be in a position to calculate current asset and current liability. Any doubts on this? This is one common adjustment which we would have done in 3-4 questions when we would have done the problem solving. You could have done this in some 3-4 problems. Any doubts on this one? Second common adjustment is, they can give you stock information and can give you quick ratio and current asset. Quick ratio and current ratio. This combination can again help me in calculating current asset and current liability. How is it? Let's see here. Current ratio is 2.5. Liquid ratio is 1.5. Inventory is 960. Amount of current assets will be in lesson mode, nothing for you to write. If current ratio is 2.5, current asset is equal to 2.5 CL. Current asset is 2.5 CL. If liquid ratio is 1.5, quick asset is 1.5 CL. Quick asset is 1.5 CL. The gap between the two, is inventory. The gap between the two is inventory. So current asset minus quick asset is inventory equal to current liability equal to 9,60,000. In this question, both are equal. Inventory and current liability is equal. The gap between current asset and quick asset is inventory, and which is 2.5 CL minus 1.5 CL, which is matching 1 CL in this question. Okay, it may not match 1 CL and all, it is matching here. So current liability is 9,60,000. With current liability, I can calculate anything now. So this is second combination. They can give you inventory figure, they can give you current asset and current ratio and liquid ratio. Any doubts on this? Clear? This is the second adjustment. Third adjustment is, they can give you GP margin. With the GP margin and GP, I can calculate sales. With the GP margin and GP, I can calculate sales. From sales, if you deduct GP, you will get COGS, and with that, stock turnover ratio can be given. That can help you in calculating closing stock or the average stock. This is a third common adjustment which we have seen in many questions. There will be GP margin along with the GP margin and GP, along with the GP margin and GP, you will end up calculating the COGS figure. Let me see if I have a question around this. This adjustment, I don't have an example. And last example is using the proprietary ratio and the net working capital. We have seen question where they have given proprietary ratio saying fixed assets to proprietor fund to fixed assets. Using that combination, you can able to calculate fixed assets and the capital employed figure are the proprietor funds figure. Capital employed figure are the proprietor funds figure. An example for this is, okay, fixed assets to proprietor fund is 40%, net working capital 30 lakh. There is no debt capital. How much is the proprietor fund? How much is the proprietor fund? Nothing for you to do. You be in listen mode. The ratio given is fixed assets to proprietor fund is zero point 0.4. FA is equal to zero point 0.4 proprietor fund. FA is equal to zero point 0.4 proprietor fund. Then I can say capital employed slash proprietor fund. Capital employed slash proprietor fund, because there is no debt capital in the question, is equal to fixed assets plus current asset minus current liability. Proprietor fund is equal to zero point 0.4 proprietor fund. Current asset minus current liabilities 30 lakh. Solve and tell me what is the proprietor fund. Proprietor fund is equal to zero point 0.4 proprietor fund plus 30 lakh. 50 lakh rupees. It's a straightforward adjustment. Clear? So these are four common ones. Apart from this, anything extra can be there. Most trickiest ones are added in the example. This we did in one question where we had to form that x by 4, x by 6. So that is taken as one MCQ here. Whatever is the most trickiest adjustment you would have seen, that would have become MCQ. That is why I keep saying MCQ is very, very critical for you to complete your preparation. So if you want to quickly revise concept, quickly revise all questions, just the MCQ part is sufficient. Clear? With this, concepts are over. I just need to close that part 4 segment. Let's do that now. Okay. Let's come to question 34. Following information are available for Navya Limited along with various ratio relevant to the particular industry it belongs. Give your comments on strength and weakness of Navya Limited, comparing its ratio with the given industry norm. So the basic initial start says that we are giving you data of Navya Limited along with the data of the industry it belongs. You please comment on the strength and weakness of this company. Balance sheet as on 31/3/2017. Liabilities amount, assets amount. Balance sheet is given. Profit statement is also given. Sales less COGS, GP, selling and distribution, admin, EBIT, interest, EBT, tax and EAT. And these are industry norm. They have given current ratio. What we need to do is ratio, industry norm. We'll have to calculate for our company, and based on that I will give a comment could be that we are a superior company as compared to the industry, or we could be a weaker company as compared to the industry. We could have better ratios than the industry ratio, or we could have weaker ratio than the industry. We are going to compare our performance with the industry performance, our performance with the industry performance. In what ratio? They have given 8 ratio, I think. We'll directly do this 8 ratio. Current ratio, what's the formula? Current assets by current liability. Receivables turnover ratio. Credit sales by average receivable, if at all available. Inventory turnover ratio. Here it is sales by, because they have said based on sales. Sales by average stock or closing stock. Total asset turnover ratio. Sales by total asset. Net profit ratio. Net profit by sales. Return on total asset, in bracket they've said very clearly on what? On EBIT. On EBIT. So EBIT divided by total asset. Return on net worth. Net profit divided by net worth or equity shareholders fund. Total debt by total asset, as the name indicates, you'll have to calculate. So we'll have to calculate these 8 ratio now and then do a comparison with the industry. Now write 4 columns. Third column and fourth column will need more space. Ratio, industry norm or company comment, or you can call it as Navya Limited. Ratio, industry norm, Navya Limited, and comment. Current ratio, industry norm, Navya Limited, and comment. The industry norm is 2.5 times. Now, our ratio could be better than the industry, weaker than the industry. That is what we are going to comment. Tell me the total of current asset. It will be there in the balance sheet. Total of current asset from the balance sheet, excluding fixed assets. 52 lakh 80,000. I'm not writing formula. You can write formula also if you need. 5280 divided by current liabilities total. Current liabilities total. Guys, you'll have to participate. I don't have anything to explain here. 19 lakh 80,000. 19 lakh 80,000. 5280 by 1980. 2.67. Better than the industry. Then I'll write a final commentary later. Better than the industry. Industry is at 2.5 times. We have better liquidity than the industry with 2.67 times. This is what we are required to do in this segment. Second ratio. What's the second ratio they're talking about? Debtors turnover ratio, receivable turnover ratio. Receivable turnover ratio. The industry norm is 8. Credit sales by receivables. Average will not be possible. Credit sales by debtor. Credit sales by debtor. 1 crore 10 lakh. What's the debtor figure? 11 lakh. 10 times. 10 times. Are we better than the industry, weaker than the industry here? Higher the turnover, it is better. So this is also better than the industry. Better than the industry. We are having a better ratio as compared to the industry. We are able to rotate the debtors faster. Rotation of debtors is happening faster, and we are better than the industry. What's the third one? Inventory turnover ratio. Industry is at 9. Formula is not on COGS. Sales by inventory. Sales by inventory. Based on sales, question has said, what is that inventory figure? 33 lakh. Calculate. 3 point weaker than the industry. This is significantly weaker. Industry is at 9 times. Industry is rotating the inventory 9 times in a year, and we are rotating only 3.33 times in a year. We are weaker than the industry norm. What's the fourth one? Total asset turnover ratio. 2 times. Sales by total asset. Sales by total asset. 1 crore 10 lakh. Asset is denominator. 77 lakh. 1.43. 1.43. Our ratio is 1.43. Industry is at 2 times. They are able to rotate the asset faster. With 77 lakh, I should have done at least double of 77 lakh sales. I did not do. Weaker than the industry. Weaker than the industry. Next one is net profit ratio. This the formula is known to you, so I'm not writing the formula, directly the answer. How much is the net profit figure? 2,31,000 divided by 1 crore 10 lakh into 100. 231 by 110. 2.1% weaker than the industry. NP margin is lesser than the industry, which is weaker. All ratio till now higher the better. Current ratio higher the better. Receivables turnover ratio. If it has receivable days, then it's the inverse. Turnover ratio higher the better. Inventory turnover ratio higher the better. So all ratio we are weaker than the industry norm. Sorry, three ratios we are weaker. Next one is return on total asset 7% based on EBIT. Based on EBIT. EBIT by total asset. EBIT by total assets. EBIT by total assets. EBIT number is how much? 5,54,000 divided by 77 lakh into 100. 7 point. You can say better or you can say in line with the industry. We are almost in line with the industry, but ठीक है, slightly better than industry. Or ठीक है, better than industry. Better than industry. Return on total asset better than industry. For the next one, return on net worth. Technically ROE, return on net worth 10.5%. EAT or PAT, whatever name you want to call, EAT by net worth. EAT by net worth 2,31,000. Net worth is share capital plus reserves and surplus. How much is net worth? Okay, they have not given any reserves and surplus. 48 lakh. 231 by 48 lakh, which is 4.81% weaker than the industry. This was significantly weaker than the industry. Return on net worth weaker than the industry. And the last one was the last ratio? Total debt by total assets. 60%. Now this total debt is a little tricky part. You can take it as long term debt plus short term debt. You can also take it as outside liability. Not sure what is taken, but okay, we'll do only the debt figure. Debt is only debentures are there. You can take only debenture or you can take all of this also. Debenture, creditors, bills payable, other current liability can be considered as total outside liability. Let me see what is there in the answer. We'll follow that itself. Okay, they have taken everything. They have taken everything. That is debenture, total outside liability. They have followed the concept of total outside. Any approach is fine. Other ratio they specifically mentioned in bracket based on EBIT, based on this. This they have not clarified. So I can do total debt. Total debt is only debenture or total outside liability, which is debenture, creditor. Logic is creditor is also a debt only or liability only, and bills payable also is a debt for us, and other current liability. So adding all of that is how much? 29 lakh by 77 lakh into 100. By 77 lakh into 100 to express in percentage. How much? 37 point. 6%. This, if you have lower debt, it is beneficial. All other ratio higher the better. This ratio lower the better. We are having lower borrowing, that is better from a company point of view because it reduces the risk. So this is better than the industry. Better than the industry. Okay, after this is calculated, we'll end up summarizing this. I'm not writing that. You can write it later. The position of Navya Limited is better than the industry norm with respect to current ratio and receivables turnover ratio. We have written comment in every ratio. You'll write a final summary. However, the inventory turnover ratio and total turnover ratio is poor comparing to the industry norm, indicating it's inefficient to use inventory and assets. Firm also has its net profit ratio and return on net worth ratio lower than the industry norm. Total debt to asset ratio is lower, which suggests that firm is less levered and more by equity, resulting in less risky company. This is what the commentary we have to pass. In practical world, when I used to work in a rating agency, we were doing exactly the same thing. But the point is not just calculating and writing better, weaker. You have to then go ahead and find why is it better or why is it weaker than the industry norm. For example, net profit ours was 2.1, industry is at 3.5. Why is our net profit lower than the industry norm? Practical world ratios has a lot of more utility. It is not just computation. After computation, I will go ahead and analyze why is Navya Limited net profit margin lower than the industry. Could be I'm not pricing my products properly. Could be my cost structure is inefficient. I'll find out the reason, try to rectify that reason. That is the purpose of doing all this analysis. Just calculation doesn't serve any purpose. In the practical world, moment you give me the balance sheet, there are a lot of online tools available. All ratios will automatically come. Nobody does ratio calculation in the practical world. All ratios will automatically come from the tool itself. You are not required in Excel. You give me the balance sheet in a specific format, you put it, 100 ratios can be calculated, comparison with the industry can be done, and it can put a red color or a green color saying we are better, we are weaker. Everything will be done by the Excel. After that is where your role is. Your role is not calculating ratio. Here you are learning to calculate ratio because unless when you see the ratio in the practical world without knowing how it is calculated, you will struggle. So we understand calculation. After calculations are done, practical world extra analysis will be done. Clear? Any doubts on this? Any doubts on this? Also, one more thing, why this chapter becomes very, very critical and why I started with this chapter is one, I'll keep discussing one or the other ratio in every chapter. Some questions suddenly will talk about a ratio. That's one reason. Second, at CA final also, I say I will suddenly give a ratio name in one of the chapters. Suddenly, so in CA final, maybe in 50 question you will see some are the ratio getting discussed there. So I do around some 500 questions there. 10% of the questions, some are the other ratio will keep coming in. And in interviews, normally ratios are tested by the interviewer. So it becomes a very, very important chapter. One from a problem solving point of view, but a lot of practical implication is there. Any doubts on this question? Any doubts on this? Let's come to 35. ABC company sells plumbing fixtures on terms of 2 by 10 net 30. This term is something you will learn in depth when I go to an area called as your working capital chapter. But as of now, you can write what this means is you can just write this in your notebook. 2 by 10 net 30 mean 2% discount. 2% discount. 2% discount if payment is made in 10 days. 2 by 10 means 2% discount. 2 by 10 means 2% discount if payment is made in 10 days, comma, otherwise you pay in 30 days without discount. So when you come to Bharadwaj Institute, you ask the fees and the payment term. We say you 2 by 10 net 30. If I tell you 2 by 10 net 30, it means you pay the fees today or within 10 days, you will get 2% discount. Otherwise, you have to pay the fees within 30 days. 30 days is the normal credit period. But in case you are making it earlier, we'll give you discount. Now, over the last 3 years, they have given multiple items: cash, receivable, inventory, fixed assets, accounts payable, accrual, bank loan, sales, COGS, net profit. Considering opening balances of receivables and inventory as on 1/4/20, so this is an error, 2015, as on 1/4/2015, just correct that, 1/4/2015, as on 1/4/2015, or 20, it is 2014, maybe 2014, 2014, 2014. Basically, this is the opening data for 2015 year. Okay, the 2015, there is some closing data there. So 3-year balance sheet is there. Analyze the financial position and performance over the last 3 years. Are there any problem? Now, what you need to do, you are going to do. It's going to take a lot of time. You will do, and then I'll discuss. Particulars: 3 years. 3 years, you have to calculate certain ratio. What are the ratios you are going to calculate? I'll tell you, and then you will start doing calculation for all the 3 year. 3 year can show improvement in performance, can show deterioration in performance. That is the commentary we have to pass. Tell me what and all ratio you want to calculate. You have this information. What ratio should we calculate? Let's go by category wise. First is liquidity ratio. In liquidity, tell me which ratio you want to calculate. You can calculate current ratio, and second ratio you can calculate is quick ratio. This two ratio you calculate it. Okay, you do it later. I'll give you time. Current ratio, current asset by current liability for 2015, 2016, 2017. Quick ratio, quick asset by current liability for 2015, 2016, 2017. Is this the only thing I have to calculate? Can I use any other ratio? Anything you can do. This is just the normal discussion I'm doing. Next, second, capital structure. What ratio you want to use? Capital structure. You can calculate debt ratio, equity ratio, debt to equity ratio. Now, I'm not going to do all of that because all are having same purpose. So maybe you use a ratio called debt to equity. Debt to equity. The debt can be short term, long term debt, total debt, or including your other liability. I don't know what is there in the answer. What ratio also I don't know. Third, you do is debt to equity ratio, and fourth maybe proprietary ratio. Proprietary ratio will tell how much is the asset funded by proprietor funds. From the proprietor funds, how much is the asset there will come from the fourth ratio. Any doubts on this? This is the second category. Third category, we had coverage ratio. Coverage ratio, nothing is there. I do not have data on coverage ratio and all. Ignore it. Tell me profitability ratio in relation to sales. What ratio you can calculate in relation to sales? Sorry, NP margin, then GP margin. NP and GP margin. NP and GP margin. These two ratio you calculate from that category. Okay. So 4 categories done. Fifth category was on your EPS, DPS, market P ratio, earnings yield. All that category will not come into picture. So that 2 categories are eliminated. Then there was a ratio called ROA, ROE, ROI comparison. So I will do that ratio also. Return on asset after tax. Return on asset after tax. Return on investment. Return on investment. What is return on investment? EBIT by capital employed, or EBIT into 1. Okay, tax is not there. Tax is not there. Okay, ROI is not possible because EBIT is not there. ROI is not possible. Leave it. ROA alone you do. ROA and maybe ROE. ROA and ROE. No need to do ROI. ROI is not possible because I do not have the EBIT number at all. ROA and ROI. Can I do any other category? Whatever is feasible. Then debtor turnover ratio, or technically debtor days also you can do. Debtor turnover ratio. Here Credit sales, you do average data. Why average? That is why they have given the opening data even for 2014. Other places average not possible because I have to use all the 3 years. So debtors turnover ratio and inventory turnover ratio. I see these nine, and maybe total asset turnover ratio. In total asset turnover ratio, you're going to do only overall, no average concept there. No average concept. This 10 I feel you will have to do. Let me check in case anything else there in the answer. You do that also. But this 10 I feel would be there. Current ratio is there, asset test ratio is there, average collection period is there. Average collection period is debtors turnover ratio, inverse of that. Inventory turnover ratio is there. Total debt to net worth is there, which was debt to equity. Long term debt to equity they have given specifically, not needed, that's okay. Gross margin is there, net profit margin is there, asset turnover is there, return on asset is there. I think we have added return on equity. You have to do this for 3 years. You have to do this for 3 years. I'm giving you around 10 to 15 minutes. 3 years, do the calculation. These 10 ratio particulars, 2015, 2016, 2017. If you have space, show the calculation. If you do not have space, directly write the answer. After this is done, I will take you through the commentary part. Okay, commentary part. I'm giving you around 10 to 15 minutes. Start doing it. These 10 ratio, I've written it in the screen, what ratio you have to calculate. But 3 years, you have to do the calculation. Start doing it. So these were the ratios to be calculated. Assuming these are the numbers in front of you, the calculation is presented in the material, and 1 year calculation is presented. Other year calculation, same formula is to be used. Assuming you have these numbers, some up and down rounding of differences can be there, but these are the numbers. Now, current ratio. Now, nothing for you to write, be in listen mode, understand this. Current ratio, no major change, no commentary based on current ratio. This looks fine. This also looks fine, not major change. 0.43, 46, and 40. Average collection period is slightly going up, which means the receivables are not getting collected on time. There is some stretch which is happening. You could have calculated as debtors turnover ratio. Your answer will be in times. Here they have done it in days. Both are okay. 365 divided by that or 360 divided by that. Inventory turnover ratio is going down. Well, 1 year okay, but this year significantly went down. 8 becoming 6 means build-up of inventory is happening. Build-up of inventory is happening. Total debt to net worth, borrowing as compared to the equity is slightly going up. 1.38, 1.4, 1.61. Major problem as of now is inventory turnover ratio, average collection period. These two are problem. These two are okay. Total debt to net worth, more or less okay. Long term debt to capitalization is also, long term debt to capitalization is long term debt divided by total capital. You did not do this. Now comes the major worry. GP margin going down, NP margin going down. GP margin and NP margin is significantly going down. From 20% went down to 13%, and from 7.5% went down to 2.6%. Asset turnover is going down and ROA is going down. Return on asset is going down. So there are significant deterioration happened in the last four ratio in the 3 year period. In the 3 year period. So this is the commentary. Current ratio and quick ratio are less than ideal ratio, indicating company is not having. There's nothing like an ideal ratio. This comment is not very right. Let's not worry about. Receivables are going slower. Although the average collection period is still very reasonable. Inventory turnover is slowing as well. Why is it slowing? That 8 time has become 6 time, indicating relative build-up in inventory. Increase in inventory and receivable with the net worth not going up. Why net worth is not going up? Net worth can go up only when you make profits. Profits are going down every year. So debt to net worth is going up. The borrowing as compared to the net worth is going up. Long-term debt to total capitalization has not changed much. Both the GP and NP have declined substantially. Relation suggests that the company has incurred more relative expense. Build up in inventory resulted in decline in asset turnover ratio. Decline in profitability has resulted in sharp decline in return on asset ratio. ROA ratio in my answer is in I have done it in times. Ideally, it should be in percentage. This is the ICI answer. We should convert into percentage, but we have to technically pass comment on each of this item, which is what this segment of the chapter was all about. This type of question very rarely tested in exam, but still we have gone through so that you understand how full-fledged ratio analysis is done. Practical world, this table will be given to you. They'll give you this table, Excel will give you this table. Our job is to understand this and pass comments, understand why something has gone up, link to ratio. GP margin going down, it can lead to NP margin going down. GP margin going down can lead to NP margin going down. NP margin going down can lead to ROA going down. So that linking we have to also establish in the practical world. Clear? Any doubts on this? Okay, last question on this. Explain the ratio that can be used in each of the following situation. Again, nothing for you to write, be in listen mode. A bank has approached a company for a loan of 50 lakh for working capital purpose. So company has said, give me a loan of 50 lakh rupees. What ratios will bank look at is what the question is wanting us. We have seen so many category of ratios, so many ratio. Working capital related, what ratios did we see? One, there was, I think, that current ratio could be looked at, quick ratio could be looked at, maybe the liquidity ratios, maybe the liquidity ratios is something I will look at. And if I still want to see more, then I want to also check the turnover ratio related to debtor, inventory and creditor, seeing that whether the build up is happening, not happening, because many company what they can do is receivable continuously going up. It will look as good current ratio, but receivable continuously going up is bad also. So bank mostly will look at your liquidity ratio, short term solvency ratio. In case it is related to working capital, they want to analyze more, then they may look at the turnover ratios related to debtor, inventory and creditor. Long term creditor wants to know long term liability payment, which ratios do we have for long term liability? Short term liquidity is liquidity ratio, long term liability in the category we had. What is for long term liability? Second category of ratio, capital structure ratio, which is for your liquidity ratio, short term solvency. The second one was capital structure ratio, long term solvency. Long term creditor will look at long term solvency ratio. Additionally, he may also look at coverage ratio. What is coverage ratios? Whether debt service coverage is sufficient, interest coverage is sufficient. Long-term creditor will look at capital structure ratio or leverage ratio to ensure the stability and structure of the firm. Additionally, he may also look at debt service coverage ratio and interest coverage ratio. Shareholder wants to know whether he should hold or sell his holding in the company. We saw certain ratios related to market point of view. We had a ratio called price earning ratio, dividend yield ratio, earning yield ratio, earnings per share, dividend per share, payout ratios, retention ratio. Along with that, I may also look at ROI, ROA, ROE. These are the category I may want to look at whether company is doing well or not. And based on that, I may decide, should I sell shares of Infosys or continue with Infosys? Should I buy shares of TCS or should I sell it? So that decision making I can do once I do the analysis of the ratios related to profitability from a owner's point of view. Finance manager wants to know effectiveness with which the resources are used. Which category is this? Turnover ratios. Turnover ratio measures the effectiveness. The shareholder would like to use profitability ratio to measure the profitability, return on equity, EPS, dividend. And activity ratio is capital turnover ratio, current asset turnover ratio, fixed asset turnover ratio, stock turnover ratio, debtors turnover ratio, creditors turnover ratio. With this, the discussion of this entire chapter gets over. Primarily, you will have to remember the formula, but logic is what is more critical rather than just directly remembering the formula. Every category of ratio had its own logic. Like coverage said, source of payment divided by what are we paying. When we did turnover, we said sales divided by the relevant item. When we did profitability ratio related to sales, sales was the denominator and whatever is the name of the ratio, that was the numerator. Like that, every category had its own logic. Be clear on the logic and then do this. Any doubts on this? Any doubts on this chapter? With this, this entire chapter gets over. I'll be moving to the next chapter. Any doubts on this? Clear?